branded soft drinks business, over a $2 billion transaction. So if it's in that sweet spot of domestic consumption, local champions, we're very, very excited to invest in China today.
Are you seeing signs of M&A revival? And what do you think it will take to see a real reversal in sentiment when it comes to the Chinese market?
I think the biggest catalyst, positive catalyst for Chinese private equity, the industry, would be a clearer path to liquidity, to monetization. The stock markets need to open up so investors can exit their positions more easily. And the M&A market needs to continue to expand. It's going to be more probably sponsor to sponsor in the next 3 to 5 years. The strategic bid from international companies is probably not going to come back as quickly in China. But as the Chinese stock market improves, that path to liquidity, I think, is going to be critical for investors.
Joe, let's take a look at some of the macro.
Hello everyone, good morning to all of you. Happy Diwali once again to all of you. आज अपना इंडियन मार्केट क्लोज है, ठीक है. टुडे इज द इंडियन मार्केट इज क्लोज. एनएसई बीएसई इज रिमेन क्लोज. एमसीएक्स भी क्लोज है. मॉर्निंग सेशन, इवनिंग सेशन ओपन होगा 5 बजे, तो 5 बजे ही ट्रेड करेंगे. कल का एक बार अपडेट दे देता हूँ. कल 5 मिनट टाइम फ्रेम पे मैंने आप लोगों को कुछ लेवल बताए थे. निफ्टी तो 5 मिनट में आया नहीं किसी लेवल पे, थोड़ा बहुत सेल ऑफ जरूर आया था बट रेंज के अंदर ही था, एग्जैक्ट लेवल पे आया नहीं. बैंक निफ्टी, कल मैंने बताया था बैंक निफ्टी फ्यूचर 5 मिनट टाइम फ्रेम पे रेजिस्टेंस पे था, साइड में जाया, नीचे एक पॉइंट ऑफ इंटरेस्ट था, वहाँ पर काफ़ी देर रुका लेकिन फाइनली ब्रेक ही कर दिया था लोअर एंड की ओर, तो काफ़ी अच्छा मोमेंटम था. अगेन आई एम सेइंग दैट आज मार्केट बंद है. एनएसई बीएसई इज रिमेन क्लोज टुडे एंड एमसीएक्स भी मॉर्निंग सेशन बंद है और इवनिंग सेशन ओपन रहेगा. शाम को 5 बजे ओपन होगा इंडियन टाइम के अकॉर्डिंग. 12:30 लंदन सेशन, जो लोग फॉरेक्स में ट्रेड करते हैं, फॉरेक्स मार्केट ओपन ही है. एंड 5 PM यूएस न्यूयॉर्क सेशन, 7 PM यूएस मार्केट ओपन और 8 बजे क्रूड ऑयल की इन्वेंट्री. तो अभी फ़िलहाल के लिए हम गोल्ड, फॉरेक्स में और बिटकॉइन ही देखेंगे, ठीक है. लेट्स सी कुछ मोमेंटम मिलता है तो वहाँ पर.
Exposure to the US and are looking to diversify. There are lots of investors in the US that have very small allocations to Asia today. And I think that's going to start shifting as well with the incremental dollar of investment. They want diversification. They want access to the growth that people are seeing in Asia. And I think you're going to see more and more capital flow to this part of the world.
And that was KKR co-CEO Joseph Bay. Still to come, AI data centers are driving a massive surge in new energy demand. We'll discuss how the green industry can meet that challenge in an exclusive interview with BNP Paribas Global Sustainability Head, Jane Ambakshia, will be joining us. Keep it here with us. This is Bloomberg.
In case you missed it on Balance of Power.
I'm sure you're having a ball and you don't want this to end anytime soon, but I'm just wondering how long you think this is going to go on.
This is a very frustrating exercise for us. It's political games being played by Democrats in the Senate. They're talking about the Obamacare subsidies, for example. That's a December 31 policy issue. We were always going to negotiate that and debate it and deliberate over it in October, November. They're trying to pretend that's the issue of the day. It's not. It's a red herring. It's a distraction. They're not doing their jobs.
Would you consider a promise to bring that negotiated legislation to a floor vote, up or down? We'll make sure that happens before the end of the year.
There's a lot of conservatives who have real problems with the Obamacare subsidy. Premiums have skyrocketed since it was created in 2010. They're up like 60%. So something's not working. There's real reforms that are needed. But it's a complex issue that takes a lot of time for members on both sides of the aisle and in both chambers to negotiate. They're trying to short-circuit all that right now. That's not how this process works.
Don't miss Balance of Power live every weekday.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either. But tariffs, franchises, and IPOs. How much?
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones, Erica Ayers-Badon, Robin Arzón, Justin Tuck.
Stay tuned. You won't want to miss it.
Welcome back to Insight. Now, according to Bloomberg NEF, climate tech companies raised over $20 billion in funding in the third quarter of this year. That's already above the full-year total for 2024. Clean power was the best-funded sector, and it reflects the emergence of a new driver, the surge in power demand from data centers. Many companies are vying to become enablers of this AI expansion. Let's get perspective from Jane Ambakshire, Global Head of Sustainability at BNP Paribas Asset Management. Jane, welcome to the city. Good to have you with us.
Thank you.
Talk to us about how BNP and also your clients are thinking about sustainability.
It's a pleasure to be here. Thank you. Sustainability has been one of our priorities for decades, and we're really looking at it in two ways on behalf of our clients. First is as investors from a bottom-up perspective. How can sustainability risks and opportunities impact the companies we're investing in, the countries that we're investing in? So we spend a lot of time and effort working across our investment teams to make sure we have the right information, the right insights to bring that into how we're allocating capital. But to take a step back, most of our clients are long-term investors. Insurance companies, pension funds, sovereign wealth funds, and they're looking at market performance for the coming decades. And from this perspective, the energy transition, biodiversity loss, social inequality, these can introduce systemic risks that they're worried about and that they want their partners and their asset managers to be tackling.
So are you saying that despite the negative headlines we're getting, there's actually greater momentum, there's greater commitment from your clients, from governments?
I mean, I'm not sure I would phrase it that strongly. Certainly, we see the energy transition is inevitable. It's happening. What's at question is really the pace and some of the regional dynamics around the transition. So we see huge interest from a number of our clients. Some have specific targets around sustainability. Others are less focused on meeting specific sustainability objectives, but they want to make sure they have the best outcomes from a portfolio perspective. And they expect us to understand and integrate relevant financial risks.
How is that playing out? Talk to us about the investment flows, both in terms of the retail investors and institutional as well.
Yeah, so it's been up and down. But this year in Asia Pacific, for example, we're seeing increased interest focus on nature and tracking deforestation. Across the board, the number had increased in terms of the number of investors that were focused on these areas. But it might not always be a huge headline. It might not be something that they're leading with necessarily, but it's something that I think quietly we're seeing more and more investors really become more sophisticated in terms of how they're tackling some of these topics.
So that's in Asia. Compare that to, investors in the US and Europe. How is that looking?
Yeah, well, if we start with Europe, we definitely see a huge portion of investors that have pretty specific sustainability policies or objectives and have very clear expectations in terms of their asset managers, in terms of both the products and services that we're able to provide them with, but also how we're using our influence in terms of our own proxy voting policies or our corporate engagement commitments around sustainability. So that's something where we've seen some more recent headlines in Europe in terms of asset owners articulating their expectations for their asset manager partners. Of course, in the U.S., we've seen a slightly different dynamic unfold over the last year with the political context around sustainability. So we've seen, a bit of the opposite in the U.S., where asset owners and managers have been less quiet around some of their sustainability commitments. But what's interesting, if you look at Climate Week in New York, for example, a few weeks ago, was actually the biggest ever in its 16-year history, with over 1,000 side events.
A surprise, given the headlines that we're seeing.
Right. So it was a surprise. And I think that there is still a lot of kind of work going on across a range of sustainability topics. And what we're seeing is a bit of a transition in terms of Asia-Pacific, of course, really emerging from a really strong leadership perspective on a lot of different areas. Continued strong leadership in Europe and articulation of expectations with some simplifications along the way. And then in the United States, of course, we have a more fragmented landscape, but still a huge number of corporate and financial institutions that are doing important work on sustainability because it makes business sense for them to do so.
When we talk about sustainability, we also have to talk about sustainability in power, in energy, with a lot of talk to do with AI and data centers. How should we be looking at powering these data centers with clean energy, green energy? Where are we with that?
I mean, of course, it's a huge challenge and a huge opportunity, and something that everybody's watching, and we will see continued progress. And I think it's a big, both a technology and a policy-related opportunity. And I think financial institutions need to play a role there as well in terms of having a seat at the table and looking for solutions and opportunities from a financing perspective. I think what we talk about less, perhaps, is also the opportunities that AI present in terms of tackling some of the climate and nature challenges. And that's another area where we're putting a lot of focus across the BNP Group.
Right. So what's exciting? I mean, how can AI help? I mean, what are you excited about when you speak to investors and take a look at the technology out there?
Yeah, there's a whole range of topics. On the one hand, there's a company we're involved with called Kairos, which are looking at methane emissions, of course, the most potent greenhouse gas. And they've created a large language model really focused on satellite imagery, looking at how do you track methane emissions, which is being applied as a regulatory tool, but also as an investment tool. Another really cool company that we're involved with is called Nature Metrics. It's based in the UK, and it's environmental DNA. So basically, you can sample water or soil and put it through the lab and basically look at the genetic sequencing and understand all of the species which have been active in that ecosystem in the last week. And I actually did a tour of one of their labs and learned how to sequence the DNA of an onion with my kids. But I was talking to one of the scientists there, and she was in her 30s. And she said when she was studying biology, they went out into a boat in Lake Ontario in Canada, would dip the nets in the water and basically have clipboards and catalog all of the species that they were finding. And now they just scoop up some water, sequence it in the lab, and I mean, it's transformative in terms of how efficient they can be. So if you think about the fact that more than half of GDP is linked to ecosystems and nature, reliant on nature. And if we think about the role for investors, companies, and policymakers then to track the health of ecosystem services, to be able to have this kind of technology is incredible in terms of increasing the efficiency to be able to set targets and track them.
Are you concerned, though, that we'll be unable to power, these data centers that enable AI to be used to solve some of these problems? We're talking about insatiable appetite. We're talking about a doubling of, energy demand by 2030. That's a huge amount.
It is a huge amount. And if you look at China's recent NDC and commitment going into COP30, for example, it included a 30% commitment to have clean energy sources in the power by 2035. So, I mean, it's progress, it's movement in the right direction. But you're right, we're not there yet. And I think we have to deal with these competing challenges around increased demand for energy and how we supply it in a sustainable way. And we haven't figured it all out yet.
And what's the biggest concern for you when it comes to that? Yeah, not there yet. I mean,
yeah, it's around the locking in of high carbon sources and some of the trade-offs that we need to make in the short term. And I think that's why some of these policy discussions are so critical now in the coming kind of short-term years, because we're locking in power sources for decades.
Earlier we talked about continued commitment in sustainability. We're suddenly seeing that in terms of sustainability debt issuances. The numbers have been quite staggering and quite surprising. What are your own expectations, and would Asia be driving that as well?
Yeah, I mean, this is perhaps another area where we don't see as many of the positive headlines. But in fact, sustainable debt issuance in Asia this year in 2025 has already exceeded 2024 issuance. So we're definitely seeing a trend in the positive direction. I think one of the additional interesting things is the ongoing kind of expansion of the different sustainable taxonomies. So as we look at, the fact that we've got, more than 30 or even 50 sustainable taxonomies around the world, we're seeing in Hong Kong, for example, we have the first taxonomy to specifically introduce elements of physical risk. So looking at adaptation, resilience are different areas where we haven't seen a lot of debt issuance yet, but I think that will be a growing area. And of course, transition is another area where we're having a lot of discussions around how do you measure that, how do you make sure that some of the commitments are transparent, trackable, measurable, et cetera. So I think definitely we're going to see more on that front, and that Asia Pacific will lead the way.
And speaking of commitment, COP30, I mean, how optimistic are you that we'll see some tangible results?
Yeah. I think we have measured expectations going into COP30. Of course, the majority of countries have not yet submitted their NDCs, their nationally determined contributions, which is unfortunate. I mentioned, China, of course, has an absolute emission reduction target out to 2035. So a reduction of 7 to 10% from a peak, which should be around now. So, I mean, that's very, very clear. And I think setting a good example in terms of having accountability and transparency in the right direction. But as I mentioned, look, things are moving in the right direction, but not at the right pace. And so I think that's something that we'll be looking for coming out of COP. Some of the specifics around carbon trading mechanisms, around progress on Article 6, clearly linked to nature-based investing, which is a theme that we're very focused on, many in the region are very focused on, around how do we create the right incentives. So I think that is a tangible area where I think we'll see some progress coming out of COP. I think it's important to note as well that the UN Principles for Responsible Investment are hosting their annual meeting the week before COP in Brazil. And you've got over 5,000 signatories, $125 trillion in assets signed on to the PRI. And so I think that's a strong signal as well, the fact that that's taking place in the region the week before COP. So I think that should help to create some momentum in terms of the financing challenges.
You talked about how it's not moving at the right pace. Can you accelerate that pace without the leadership of the U.S.?
I mean, that's what we're working on and looking to figure out as a community. And I think it's coming back to the fundamentals of why are we working on this, right? There's environmental and social crises we're looking to avert, as well as economic resilience. Right? It is in our interest as a global financial community to mitigate the worst impacts of climate, biodiversity loss, and systemic inequality. And we're here to create value for our clients at the end of the day, and those are priorities that are set. And so I think, the political environment evolves over time. But as long-term investors, we need to really stay focused on those fundamentals. So what is the right environment to bring together capital allocators, public policymakers, regulators, companies together in this forum? And so COP30 is one of them. This week in Singapore, we have the Sustainable Finance Advisory Panel for MAS, which is why I'm here in the region. Of course, MAS has shown a ton of leadership in terms of bringing together different stakeholders to tackle these challenges. So I think as others step back, others need to step in, and that's really the exciting part of what's going on right now, to see how do we shift some of those dynamics to continue to improve and address the challenges at the right pace.
Jane, great insights. Thank you for joining us today.
Thank you for having me.
Jane Ambakshire, Global Head of Sustainability at BNP Paribas Asset Management. Now, a quick look at the markets. Let's take a look with India still on holiday. We're watching 1-month Indian rupee NDFs, according to our Markets Live team. Rupee forwards are jumping on a local media report that New Delhi and Washington are closing in on a trade deal that could lower tariffs for Indian goods to as low as 15%. We'll be watching when Indian markets return from holiday tomorrow. We're also tracking Indonesian assets ahead of the central bank's latest rate decision due after our show. A majority of economists expect Bank Indonesia to cut rates for a fourth straight month, part of its pledge to go all out in supporting economic growth. President Prabowo Subianto is targeting 8% annual growth by the end of his term. And before we go, here's a look at our guests for tomorrow. We'll discuss the outlook for fixed income with PineBridge Investments' Omar Slim. Former ECB President Jean-Claude Trichet also joining us live from the Bund Summit in Shanghai. Plus, we'll discuss JSW Steel's growth strategy with its CEO after their second quarter earnings miss. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.
Everybody is calling Abu Dhabi or the UAE home, a place of learning, a place of knowledge. It's also the capacity to innovate, to invent. The vibrancy of the city is this element which is also gluing people together.
Global connections are vital for business expansion. Nearly 1 in 2 business leaders say decisions made on their own usually turn out to be poor.
When we go into a new region, networks matter, experience matters. Culturally, there are a lot of differences from region to region. We are just trying to find the right partner. Somebody reliable, somebody that is as invested as we are.
Widen your global network. Search Turning Point, brought to you by HSBC and Bloomberg Media Studios to find out more.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no. I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Lizzie Burden outside Windsor Castle, England, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
in case you missed it on Bloomberg Tech Europe.
Well, I would argue that our odds are pretty good at winning a big market share. But of course, some incumbents will manage to reinvent themselves, right? I think Jamie is on to something really exciting. He's trying to do it now. Solomon was trying with Goldman Sachs, but then kind of Marcus, was thrown out when the fintech valuations dropped down. A lot of banks stopped their aspirations in fintech, and now they're waking up to that fintech never died.
Don't miss Bloomberg Tech Europe every month.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Losing shine. Gold extends losses in Asia following the biggest drop in 5 years as investors lock in gains after an unprecedented rally. J.D. Vance hails progress in the Gaza ceasefire deal during his trip to Israel, but the U.S. Vice President won't set a deadline for Hamas to disarm. And mixed messages. U.S. President Donald Trump reiterates he's hopeful of a deal with China, but also signals a meeting with his counterpart Xi Jinping may not happen at all. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Versace in Dubai. If you woke up this morning and just looked at where the S&P ended, you would think it was a very calm, not tumultuous session at all for these stock markets. Not the case. A tremendous amount of volatility going through with plenty of comments geopolitically, with President Trump suggesting that this meeting with Xi may or may not happen. The meeting with Putin may or may not happen. We also had a massive slide in gold and silver. And so we're waking up this morning to perhaps a market that's a bit in hangover mode, some stabilization coming through. S&P futures leaning positive now. I should actually mention that Dow, despite all of the volatility, did make a record high yesterday, even though we're paying close attention to the post-close results from Netflix and also the slide in Alphabet yesterday, too, on the tech side of things. So those have been key drivers, as we know, in the run-up to all of these stock markets. The USD also dropping a little bit today, despite all of the volatility around safe havens yesterday. Mild bid for the USD, but I will say that some of the currencies trading versus the US, so some of those high beta emerging market currencies like the South African Rand sold off in tandem with the price action in gold, which leads me to what happened to gold. This morning, we are seeing now some stabilization, some green on the board, but of course, yesterday, a massive sell-off, almost 5 standard deviation move in the price of gold, a drop of 5.5%. Silver also down more than 7.1% in the session too. And wild also moves in the Asia session. We're going to talk more about that shortly. But bottom line is, yesterday we've been talking about the massive run-up in gold, in silver, and that it was outpacing some of those technicals. Perhaps was due for a bit of a pullback. But the question is this just a minor correction or the beginning of a more sustained sell-off? So let's talk about that. Precious metal stocks are in focus this morning after gold and silver posted their steepest sell-offs in years. This comes as investors lock in profits and question some of those really rich valuations. That's bringing Garfield Reynolds, who leads our Markets Live coverage in Asia. Garfield, what exactly happened yesterday in gold and silver?
Well, I mean, what happened was very much a sell-off that everybody was wondering, when it would come. The moves in gold and silver had become so very overstretched, and without there being anything obvious to drive moves of that scope, other than just sheer momentum. There've been all those pictures and video footage of people queuing up around the world to buy gold, physical gold. And it felt like the market was sort of doing the same thing. Everybody was just queuing up to buy gold. Now, even if you might think that you expect gold over the next year or so to move higher, you would be telling yourself it can't keep on going up like this, and sure enough, it stopped going up and it came crashing down. There's plenty of signs that people decided to take some of the money off the table that they had already made, which makes a lot of sense. The big question now is, does that turn into a vicious cycle where sales beget more sales, or does it simply allow the market to reset and we look to determine whether those drivers that have helped to send gold to the record levels that it reached, i.e. strong demand from central banks, strong demand for gold as a haven against geopolitical and recession uncertainties, and also lower interest rates.
Yeah. One of the things that our colleague Anthony Stevens pointed out this morning is the worst performing sector yesterday were, well, not really sector, but type of trade yesterday was momentum trades. And if you look at, say, what has happened to gold, to crypto, to Bitcoin, even to the unprofitable tech basket, what you're seeing now perhaps is a pullback, and all of these
As I reach a milestone in my life, I'm humbled.
NVIDIA chips that have been blocked, then put back on, that they were shrugging off. They want to make sure that they can have access to a lot of this, as well as there have been threats in the past. And Maria Bartiromo asked the president about this over the weekend. What about the Chinese companies that list on U.S. stock exchanges? That's been a rumor of a threat potentially that this administration can pull. Maybe they want that taken off the table.
So this week is the meeting before the meeting. It's the meeting between Treasury Secretary Scott Bessent and his counterpart in China, apparently over in Malaysia, before the big get-together a week away.
So I think this is really where we can finally establish and read the tea leaves on what was agreed upon before the two leaders sit down. And you make this point a lot. Usually it wouldn't be left to the last week before the premier leaders meet. But in this juncture, they are. So whatever comes out of He Fang and Scott Bessent's meeting is likely what's going to be agreed upon between President Trump and Xi Jinping.
The US and China, the relationship between the two, are the epicenter of some of the price action over the last week. This morning, we're focused on one thing in the pre-market, Amazon. Not much movement, but AWS very much in focus this morning, identifying a problem causing widespread disruption affecting the likes of Perplexity, Coinbase, Robinhood, and potentially, snow day for adults. Disruptions reported across multiple platforms, corporate messaging service Slack, conference calling firm Zoom. I think this is the kind of thing that people might want to wake up to on Monday morning.
Absolutely, because potentially if you're trying to order an Uber or a Lyft, there's going to be challenges on getting to work, to your point of being maybe a snow day for adults. This is a problem in the U.S. East Coast. So anyone that's working on Wall Street, this is something that you need to take a look at. They are working on it, but they've had thousands and thousands of requests that there's a ton of shortages. It's degrading the services for several of these companies. So we're going to work with this disruption Monday morning.
And just for the record, if it wasn't for Anne-Marie, I wouldn't be sitting in the seat this morning because AMH called the car for me because the Lyft service wasn't working.
It was working for me. I had service.
So there you go. Equity futures on the S&P positive so far. We're higher by 0.3%. Coming up this hour, Ross Kostrick of BlackRock as stocks add to last week's gains. Terry Haynes of Pangea Policy as President Trump lists demands for China. And Innes McPhee of Oxford Economics on whether AI is masking an investment recession. We begin this hour with stocks inching higher as investors await a week of earnings and a delayed CPI report. Ross Kostrick of BlackRock writing, we expect the economy to remain resilient. Fiscal tailwinds, monetary easing, AI momentum and favourable seasonals should support stocks into year-end. Russ joins us now for more. Russ, good morning, sir. Is there anything about the credit risk, the credit issues of the past few weeks that undermines that argument?
Good morning, Jonathan. I think you've got to be aware of the credit markets. But just to be clear, if you look at the broader aggregates, we really haven't seen anything that is that disruptive in credit markets. And we went through a similar incident back in March of 2023 with the regional banks, as you'll remember. So I do think you always want to be aware of the credit markets. But as you mentioned in the introduction, there are three factors right now that are a tailwind. The economy has been resilient. You've seen economic estimates come back, earnings estimates with that. The Fed is cutting into strength, and the AI momentum in the near term looks pretty solid. So as you think about the next, call it 3 to 6 months, in the absence of any new news, I do think that takes the market higher.
So, Russ, as you noted back in 23, there was a concern over regional banks, but largely, almost exclusively over interest rate risk. Here we are 2 years later, focused on credit risk and the risk that maybe the cycle is turning. Russ, is there something else that you would look for that suggests that maybe there's no evidence of that at all, that these are idiosyncratic issues, that if you look more broadly, things still look pretty good?
Well, look, I think there are a couple of issues. The first is you have to acknowledge that some of the stress you've seen so far has happened with companies that are more geared to lower income consumers. And there is stress with lower income consumers. We've seen that for some time. That's been occurring since rates were going up over the last 1 to 2 years. So that is a pocket of stress. However, if I look at the broader economy, if I look at the wealth effect, if I look at where the labor market is, if I look at where disposable income is, do I see an economy that is evidencing the type of stress that would get you really worried about credit markets? Probably not. Again, pockets of concern, places you want to be aware of, but in aggregate, you still have a very resilient and robust economy, which should be supportive of not only the credit market, but also the stock market.
So, Russ, let's build on some of this. So you see reasons maybe to be comfortable with the idea that this does not migrate up income cohorts and ultimately topple the broader economy. With that in mind, Russ, what would you isolate? Parts of the equity market you would avoid for now, and what would you lean into?
Well, it's interesting. The parts of the equity market that you've done well to avoid have actually been the safest parts. This has been really going back to July of 2024, episodically a period of lower quality rally. In other words, high beta companies with less profitability have also been leading. What's been lagging? Companies that are stable but not evidencing much earnings growth. So areas like staples, for example, we've been underweight for some time. What do we like? We do like companies, one, that are geared to the AI theme. We've liked that for several years. We've kept that. We will trade around it, but it's still a theme in the portfolio. But the other is, again, looking for where do we going to see that cyclical impulse show up in earnings. And that is in select industrials. It is in select consumer names. And again, I think part of that is a play on an economy that's much stronger than people expected back in April and May.
When you think about consumer staples and also some of these companies that you say don't have a ton of earnings growth or you haven't seen it just yet, isn't the concern looking forward that they're going to challenge to generate revenue with the tariff impulse that everyone is saying we could expect at the end of the year in 2026?
Well, the tariff impulse, I think, hits the market in a lot of ways. And the truth is, look, there's still a lot of uncertainty. Clearly, there's a concern about how disruptive tariffs might be on inflation and also on company margins. So far, companies have done a remarkable job of navigating that by changing where they source, by being nimble in terms of how they price their products or services. So it's not as if it is not an issue, but you look at the earnings growth we saw in Q2, the early indications we're getting in Q3. So far, again, I think that narrative of companies being able to navigate the existing tariff environment regime, whatever you want to call it, I think that is still intact.
So, Russ, could we call time on the tariff uncertainty and struggles that this market has had?
No, I don't think you can call time on it. And again, I think it actually is indicative of a broader trend which is that really since the pandemic and certainly since inflation kicked in 21 and 22, we've been in a market which in some ways is fundamentally different from the 10s and the aught years, and that macro volatility has been higher. And that's particularly been true in inflation. And that's meant that when you build a portfolio, you think about how you're allocating, you have to think about it differently. Bonds have been very effective in a portfolio, for example, as a source of income. On the other hand, they are less effective as a hedge than they were 10 years ago. So, I would put the tariff issue in the broader context of the macro environment's more volatile than it was 10 years ago. And that has to be part of how you build the portfolio. One example, to my mind, this is why gold is at 4,200 an ounce.
So, Russ, just to build on that gold position, are you saying that's a substitute for Treasuries?
No, I don't think it's a substitute for Treasuries, but I do think it is a more effective diversifier than it might have been 10 years ago in an environment where investors are more worried about store of value. They're worried about the long-term fiscal impulse, not just in the U.S., in Japan, in France, in the UK. They're worried about the dollar. So how do you think about positioning a portfolio for those types of risks? Gold is, to my mind, one of the parts of the portfolio. Now, the reason I say it's not a replacement for Treasuries is, the old model of a 60-40 portfolio. Very few people are going to have 40% of their portfolio in gold. But I do think as part of that mix, it definitely diversifies some of these risks we're dealing with more today than we were 10 years ago.
So, Russ, let's just sit on that. 10s have come down to 4. We've seen a big rally at the long end of the curve develop coming out of the summer. 2s have come down to around 350. We saw that really start to accelerate after that weak July payrolls report back in early August. Russ, what's your advice to people now looking at the yield curve the way it is?
We continue to be mostly in the belly of the curve. We've gotten a little bit longer in our duration. Generally, we're pretty close to benchmark. So another way to put that, we're not taking a ton of duration or rate risk in the portfolio right now. We like the carry. As I said a few moments ago, part of what we've been doing in fixed income beyond the Treasury market is thinking about what does that broader portfolio look like? Securitized, some EM, having a portfolio where you can clip that 6% coupon without taking a lot of rate risk. Again, something you could not have done 5 years ago.
Russ, appreciate your time. Thank you, sir. Russ Kostrick there of BlackRock, breaking things down. Still comfortable being long equities. Equity futures this morning just about positive by 2 or 0.3%. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. Widespread internet issues are being reported after Amazon Web Services, the world's largest cloud provider, suffered a massive outage. Amazon is investigating the issue, which is impacting dozens of platforms, including Snapchat, Coinbase, Perplexity, Robinhood, and Verizon. Shares are lower on the news. Meanwhile, Israel says it has resumed a truce with Hamas in Gaza after fighting over the weekend. Each side accused the other of breaching a deal brokered by President Donald Trump. The IDF warned it would respond firmly to any violation after launching strikes against Hamas in Gaza and suspending aid shipments. Some aid supplies have now resumed, but the key border crossing of Rafah remains shut. And French bond yields are rising after S&P Global Ratings downgraded its sovereign credit score. It's an unscheduled move that highlights the nation's fiscal issues and places its debt at risk of forced selling by some funds. S&P Global downgraded the country from AA- to A+, saying the nation's budget uncertainty was elevated. That's your Bloomberg Brief. John?
Yahara, thank you. Not a good weekend for the French. French bonds, French banks, French museums.
French jewels. The French jewels literally being ripped from the Louvre, as well as in terms of the downgrade. Yeah, it's been a rough few weeks for Emmanuel Macron.
Yeah, brutal. We'll bring you an update on that jewelry theft a little bit later in the programme. Up next on the programme, President Trump's list of demands.
One of the things I want is China's going to buy soybeans. I want China to stop with the fentanyl. Very, normal things. I don't want them to play the rare earth game with us.
Up next, we'll catch up with Terry Haynes of Pangea Policy, live from New York City this morning. Good morning. Equity futures this morning positive by 0.26% as we head into a key week for inflation data. We're finally going to get our hands on this at the end of the week. CPI drops on Friday, and this sets us up for the following week. The following week, a Fed decision next Wednesday. Then after the close on the same day, we'll have numbers from Microsoft, Meta and Alphabet. So really, earnings season begins. We've got a flavour of things this week. Netflix, Tesla, but earnings season really begins next Wednesday.
And then, of course, we have to wait weeks for when earnings season really begins in terms of the equity market and where it's going in the direction of travel with NVIDIA. Obviously, we want to know how these big tech players are advancing and the fact that they're spending billions of dollars in this CapEx boom to build out AI. And what do they have to show for it?
Back end of October gets really interesting. Lots of tech earnings, a Fed decision and a meeting between the President of the United States and a Chinese leader. Under surveillance this morning, President Trump's list of demands.
I have a very good relationship with President Xi of China. We're having disputes on things. They're paying us a lot of money, tremendous amount of money in tariffs, and they'd probably like to have it be less, and we'll work on that, but they have to give us some things too. One of the things I want is China's going to buy soybeans. I want China to stop with the fentanyl. Very, normal things. I don't want them to play the rare earth game with us.
So here's the latest this morning. President Donald Trump naming soybeans, rare earths and fentanyl as top priorities for the U.S. ahead of fresh trade talks later this month. Bloomberg's Tyler Kendall joins us now from Washington with more. Good morning, Tyler.
Hey, John, good morning. So none of these topics are necessarily surprising, but they do give us an outline to look out for as both sides re-engage ahead of that November 10th broader deadline for the tariff truce. Now, the White House does maintain that threat of an additional 100% levy does remain on the table, but President Trump himself said in an interview over the weekend that rates that high are not sustainable. Now, interesting enough, we know that this all came about because of that new unveiling by Beijing when it came to new export controls on critical and rare earth minerals. But people familiar tell us that behind the scenes, Beijing has actually been working in recent days to tamp down on at least some of the concerns that included here in Washington on the sidelines of the IMF meeting, where Chinese delegates told their counterparts that this new tightening in export controls wasn't intended to disrupt any normal trade flows. Of course, though, this has been an issue at the center of the conversations, and there's still a lot of big divides, including the U.S.'s own actions when it comes to some of those semiconductor chips related to the supply chain here. And that's why our analysts at Bloomberg Economics have long pointed to fentanyl, that topic, as being the one where we might see the most immediate impact. Of course, 20% of the tariffs on China currently are linked to the issue. But, John, it really does seem like soybeans are becoming the most pressing issue as U.S. farmers across the country are sounding the alarm that they're running out of storage space for unsold soybeans. A senior administration official tells me that they are looking at other export markets. They are working overtime when it comes to talking to these countries in Southeast Asia or even Africa to take in U.S. soybeans if China doesn't come to the negotiating table on the issue, and fast.
Tyler Kendall. Tyler, thank you. And Marie, these numbers. The U.S., almost a fifth of China's soybeans imports a year ago. And this export season, not bought a single crop.
Zero. And this is why there's been a little bit of tension as well. You can see from the Agricultural Secretary, Brooke Rollins, that text message that she sent Scott Bessent, the Treasury Secretary, when it came to Argentina. You're announcing this swap line, a financial helpline to Argentina. At the same time, they're sending soybeans to China, which maybe our own farmers could have been sending. There's a lot of questions on, is this really America first?
Argentina, Brazil, filling the gap down in South America. Terry Haynes of Pangea Policy writing this: China had best show movement on rare earths and other hot button issues, or the US is capable of broader direct movement against China's economic interests. Terry joins us now for more. Terry, welcome to the programme, sir. Now, my initial reaction to reading that quote is, what's left to tariff? So what's left to do here?
Well, good morning, all. I think what's left to do here, frankly, is to understand that the economic issues of the moment, soybeans and fentanyl and the rare earths, are part of a broader geopolitical struggle, and I think that's the reason why we're not going to see any serious movement on this anytime soon. We'll probably get some action on soybeans. We'll get another nod on fentanyl. They'll continue rope-a-doping on rare earths, and in return, what you get from Trump is not a calming effect by saying tariffs are unsustainable, because what Trump and Bessent have always meant by unsustainable is that they're unsustainable for China. So it's not an attempt to calm, it's an attempt to tell China, look, we're perfectly willing to keep ramping this up if you want to, but if you don't, then you need to back off now.
But Terry, hasn't it shown that it is unsustainable what we're dealing with right now, especially when it comes to farmers? It's unsustainable for the United States as well?
It's not a pretty picture by any means, and I don't mean to minimize the problems that American farmers have at all. But this takes place in the context of a much greater geopolitical chess game, and the export markets for soybeans are one small part of that.
So China is holding on to rare earths. They're not buying U.S. soybeans. What do they want out of the United States besides lowering the tariff threshold?
Well, they'd like to keep talking, and they'd like the United States to go away, akin to 2019, 2020. What the Chinese very likely hope for is that they get some sort of small deal with Trump that gets trumpeted as a big deal. And what ends up happening is that the United States then goes away on bigger issues. And I think this time out, Trump's not inclined to do that. The reason I think that is because that's very clearly what he's signaling. I mean, they see the rare earths issue as a threat to military plus Western economic power and influence and ability to continue, frankly, and they'll defend that, and so this thing isn't going away anytime soon.
It's not going away, but what you're describing is the contours of a maybe small deal on three specific issues that could be done between Hurley Fang and Scott Bessent. Why do we need President Trump meeting with Xi Jinping?
We need that because both Trump and Xi Jinping want that meeting to be able to show that jaw is better than war, and they're continuing to talk. And in this case, any kind of seeming rapprochement between these two leaders, lifts all boats, whether it be in China, which wants respect and wants to be seen as an equal, or the United States, where Trump knows he's going to get a pretty large market bounce out of a continued rapprochement.
Terry, this bout of escalation really started with China a number of weeks ago. They flexed their superior rare earth refining capacity. That's a move that does not come without risks. And Terry, I just wonder from your standpoint whether you believe that was a strategic mistake on the Chinese half.
I think it was clumsily handled at the very least. So I think I'll mostly agree with you on that. But also I found the timing interesting because what you had in this situation is in the broader geopolitical context, you've got a Gaza brokered peace, which right now, of course, is teetering a little bit. But you got that. You got the U.S.-Argentina bailout, which, from a geopolitical perspective, is a pushback against China in South America. And you've got Russia under a lot more pressure, not only because they're not winning in Ukraine, but because the price of oil and other things imperil their ability. That together describes a Chinese and client state proxy defeat. So China, among other things, is reminding everybody that they're still here.
Terry, before we let you go on China, today is day 20 of U.S. government shutdown. We're just mentioning it now, 23 minutes into the program. When do you think the government will actually open?
I got early November after the New York City elections. What I think about this is that this is now morphed into a struggle for the broad center of the American public, who's more reasonable. There's a lot of evidence out there that Democrats aren't winning that battle right now. And what Republicans see an opportunity to do now is kind of use the kind of no kings amuse-bouche plus the Mamdani election in New York City to continue to paint Democrats as extremists. So I think this goes on for a while.
Terry, just quickly then, you don't see that as a coincidence of the calendar. You actually think that's a connected story, what's happening in New York City and what happens in Washington?
Oh, absolutely, because what they'll end up doing is, and this gets teased all over the place and has been for a while. Trump mentioned it over the weekend, I think, too, is that, this is the face of the Democratic Party. That's what these people are up to. And notice, by the way, and not incidentally, that, neither Schumer nor Jeffries nor anybody else in New York wants to stand up to them. This is your Democratic Party, folks, as compared to us, who are leading on, already leading with the public on economy and crime and a bunch of other major issues.
Terry, appreciate it. Thank you, sir. Terry Haynes there of Pangea Policy down in Washington, D.C. Please, you brought up the shutdown. Haven't talked about it. Completely off the radar of the market at the moment. 3 weeks and counting. And it looks like, according to Terry, it could be another 2.
Punchbowl this morning talks about the cash crunch. Federal employees are slated to miss their first full paycheck this week. They are scheduled to get paid October 24th. That covers October 4th, October 13th pay periods. Government was shut the entire time. So you need to watch the 4 Democratic senators in Virginia and Maryland. At some point, they're going to cave.
We're going to get some CPI data. It might be a while before we get some payroll reports. Coming up on the programme, Amy Gower of Morgan Stanley on what's next for gold's record run. Plus, Yahira has your morning movers with Boeing in focus. For all the drama of last week, the S&P 500 higher by 1.7%, the biggest weekly gain since early August, and the gains continue this morning, up by 0.25% on the S&P, on the Nasdaq up by 0.3%, on the Russell. Some outperformance for smalls this morning, up by 0.7%. Let's turn to the bond market. Switch up the board. 2s, 10s, 30s. 2-year bond yields down for a third week last week. Likewise on 10s. Yields down across the board. 2s this morning high by just a single basis point, 3.4698. 10s just north of 4% after dropping south of 4% through last week. I want to turn to gold to bring you an update. Gold so far this morning, shaky on Friday, positive today, up 0.1%, closing out the week for a 9th consecutive weekly gain, the longest weekly run since 2020. If we make it week 10, it will be the longest weekly stretch of gains going back to 1980.
It's been absolutely unbelievable. And you see some profit taking happen over the weekend from Friday to this morning, but still gold is up, even though everyone's talking about, improved sentiment when it comes to credit quality in the United States, less concerns going into this big meeting between Beijing and Washington. And still, there is still that appetite to get your hands on gold.
42.56. We'll get Morgan Stanley's view in just a moment. 3 hours away from the opening bell. Let's get you some single names, some morning movers. Let's cross over to Yahira. Hey, Yahira.
Hi, John. President Trump's latest comments on U.S.-China trade are helping to lift rare earth stocks. We are seeing critical metals up nearly 10% in the pre-market, while U.S. rare earth, MP materials also higher after they all suffered some losses in Friday's session. But today's gains, of course, come after President Trump said he doesn't want Beijing playing the rare earths game with the U.S., listing the minerals among his top issues ahead of trade talks this week. And we have a potential deal incoming, and that is causing shares of Hologic to rise 2.8%. Honor reporting that Blackstone and TPG are in advanced talks to buy the medical device maker in a deal worth more than $17 billion, including debt. And this is significant because if it goes through, the deal would rank as one of the biggest private equity takeovers globally this year. And we are also seeing a lift in Boeing shares, up 1.6%. Honor reporting that the FAA has approved a boost in their 737 production to 42 jets a month. The increase could start as soon as November, with plans to eventually hit 47 jets a month, with investors seeing higher output as key for Boeing's comeback and in its rivalry, of course, against Airbus. John?
Yahira, thank you. Appreciate it. More from Yahira a little bit later this hour. On a radar this morning, President Donald Trump laying out his top demands for China ahead of trade talks later this month. The president insisting Beijing stop playing the rare earth game, curb fentanyl exports and resume purchases of American soybeans. Elsewhere, French bond yields rising after S&P downgraded the country to single A+, citing fiscal woes. The decision raising the risk of forced selling, France losing the country's AA credit rating at 2 of the 3 major credit firms in just over a month. And finally, Japanese stocks closing at fresh all-time highs as the LDP signs a new coalition deal with the Japan Innovation Party. The move putting LDP leader Sanae Takaichi to become Japan's next Prime Minister.
Really interesting story because she is conservative on social issues, but actually she wants to have more fiscal firepower when it comes to how she would like to govern as Prime Minister. Very similar to a platform she'd like to extend when it comes to Abenomics. This makes me think that this is going to set her up to have a very good relationship with the Trump administration, because Trump talks a lot about how it was during Abe's reign that he really had this close relationship with Japan. That's the politics. On a market perspective, I think we're trying to work out how close the relationship will be with the BOJ. Just a touch of yen weakness coming back through. Dollar yen this morning, 150.77, and positive on that currency pair by
0.1%. Let's turn back to metals. Gold trading in a narrow range after a sell-off in precious metals on Friday. It's coming off a 2-month surge that has brought prices up over 60% so far in 2025. To discuss, Amy Gower, lead metals and mining commodity strategist of Morgan Stanley, joins us now for more. Amy, welcome to the programme. What a year for you and the team to track this story. Gold to the year today is up by more than 60%. Can we just reflect on Friday's price action? A massive trading range. What was the explanation for you and the guys, you and the team, as to what was behind those big moves going into the weekend?
Yeah, look, I think it's been a very, very big move. As you say, it's been a couple of months really of gold moving up to about $1,000 in that period since we had that more dovish pivot from Fed Chair Powell at Jackson Hole. So I think it's not surprising that we have a bit of volatility, especially when we're seeing that across other asset classes as well. And what we often see is if we do see other assets pull back, gold is often swept up alongside that as well. Just because it's often used as a source of liquidity. We saw silver, platinum, palladium as well, all down even more. And I think this precious metals trade has been kind of all driving itself. And so as those pulled back, we had a bit of weakness as well in gold.
Amy, can we reflect on the pillars of this trade and how it started, the more recent rally over the last few years? A lot of people have pointed to the so-called diversification trade sparked by the war in Ukraine and the prospect of Europe confiscating Russian assets, triggering this diversification of central bank holdings, of the dollar exposure, taking on more gold. Amy, do you think the recent price action is more indicative of reaching a more speculative phase of this story?
Yeah, no, I think it's a good way to think about it. So 2022, 23, even much of 2024 was driven by central banks really upping their purchases of gold. And we still see this, but I guess it's reached a more stable level now. And so the big shift this year has been the exchange traded funds. And what we do see is that they are much more linked to what the Fed is doing, what interest rates are doing. So actually exchange traded funds have been selling gold for the previous 4 years and really only turned to net buyers this year, and that has really accelerated since we had that pivot from Fed Chair Powell. And then, of course, as you say, that there is, as gold does better, investors start to look at it more, rethink, how much gold is in their portfolio as well. So I think a lot of those discussions are going on, and as the price continues to work, I think people continue to look at it and try and increase their exposure.
Amy, as a number of banks have 5K on gold next year, we're in an environment where risk on, risk off, everyone continues to get crowded into this trade. Give us some context. Where have we seen this before in the past?
So I think we saw, I guess, similar moves in gold in 2020, where we had a big run up in price, and then actually that was, I guess, eventually pulled back as other asset classes took over and carried on going. I think that the difference this time around is that gold is rallying alongside everything else. So it feels like everything is doing well all at once, and that makes it maybe slightly different to previous rallies. And I think at the moment, probably the most risk to gold is, if we did see other asset classes also starting to pull back, because everything seems to have become a bit more related. So, I would think if we did get a more meaningful pullback in equity markets, for example, gold would not be immune to that, particularly as it's often used as a source of liquidity.
Gold seems to be lifting all boats. Silver is also having an absolute moment as well, also up on the year, double digits. Do you see that being part of the momentum of the gold trade, or is that its own story?
Yes and no. So silver, I guess, sits somewhere between gold and copper. So it has an industrial demand base. Particularly it's used in solar panels, which has had huge growth over the last few years. We do care about mining production, I guess, in silver as well, and that is mainly as a byproduct. So you don't tend to get much reaction on the supply side to prices. So we've had this industrial deficit for silver, but then also it's benefiting from investors buying exchange traded funds in silver, which are backed by physical metal. So you've kind of had this perfect storm coming together. And then more recently, it sort of had its own physical shortages as well. So there is a lot of metal in London, there is a lot of silver in the vaults, but a lot of that is now already pledged for exchange traded funds. So the amount of sort of freely available metal has really shrunk, and that's come alongside good demand in India seasonally, demand a few months ago as we in New York. thinking about whether there might be potential US tariffs on silver. So there's been lots of pulls on that metal while the physical availability has been quite tight. So yes and no, it is linked to the gold story, but it has its own drivers as well.
Amy, we'd love to finish up by talking about more broadly, you mentioned the miners, more broadly about the commodity story and how the miners might respond to that. I believe you also tracked oil back in the day, and both oil and basic resources had a bit of a bust over the last decade or so that I think injected some real discipline into the operators, both in the oil patch and for the miners as well. Amy, particularly the mining companies, how disciplined are they this time around not to react to the big rally we've seen across the board?
Yeah, look, I think perhaps more a preference for buying supply growth versus building it yourself. And I think there's a couple of challenges there. One is, if you want to start a new mine today, the process to get those mines approved has become much, much longer. And so even if prices are good for now and maybe for a few more years, by the time that metal comes to market, we could be in a completely different market environment. So I think that's one challenge. And then, as you say, there's been challenges in the past with debt levels and spending at the wrong time, and then supply all coming on when we didn't need it. So I think we are generally seeing capex discipline and perhaps companies trying to grow their own growth by acquiring assets or other companies rather than developing internally, and that probably will stay. I would say in gold we are seeing more feasibility studies being refreshed and updated, so clearly people are taking a look, companies are taking a look, but I think it could be some time before we see the volumes in the market.
I mean, there's a massive push domestically here in the United States, as you're well aware of, to boost production of certain materials, particularly rare earths. There's also a massive copper deposit in the United States that Rio and BHP have wanted to explore for a long, long time. You mentioned things like regulation, permitting. Is enough being done to speed up the timeline for some of these issues?
Look, I think we're certainly moving in the right direction, and it's not just the US, other governments around the world are looking at which projects can they prioritise, can they make the path a bit smoother, and I think, look, there is always a process to develop a mining project. You need to think about land rights, water rights, how you're going to bring the material in, bring the material out. So I think, look, it should be a process that takes some time, but certainly to sort of try and compress some of those timelines gives companies a bit more certainty and allows them to deploy capex with confidence. I think that's the key. So I think, moving in the right direction, but probably permitting timeframes are still quite long.
Amy, thanks for making time for us. Appreciate getting some time to lean on your experience. Amy Gower there of Morgan Stanley, who leads some of the coverage of mining and metals.
And this is actually going to be a huge conversation today in Washington. The Prime Minister of Australia will be making his way to the Oval Office, and Kevin Rudd, the ambassador, was talking about the fact that Australia equals the periodic table. But having the rare earths and having metals, but knowing how to actually mine them is another thing, and they're trying to offer themselves this help to kind of bring these two countries closer together because of the fight the United States is having right now with China.
A huge focus for this White House, particularly, as you say, going into that meeting. Let's give an update on stories worldwide. Let's head over to Yahira Anand to get your Bloomberg brief. Hey, Yahira.
Hi, John. Amazon Web Services says most of its operations are succeeding normally after a widespread outage. The disruption from the world's largest cloud provider impacted a range of services, including AI companies, government agencies, and financial platforms. AWS identified a problem with a regional gateway on the U.S. East Coast that caused the issue. Shares are higher 0.2%. Meanwhile, Apple's newest iPhone is off to a strong start. Counterpoint Research saying the 17 version is outselling the 16 by 14% over its first 10 days on the market in both the U.S. and China. Analysts attribute the boost to the phone's improved display, more storage, and the upgraded A19 chip, plus a well-timed upgrade cycle for users who got their last phones during the pandemic. And the Louvre will remain closed through Monday after thieves stole several pieces of jewelry in a daring daytime robbery. On Sunday, robbers broke into the museum's Apollo Gallery and used angle grinders to break into high-security cases containing French crown jewels from the Napoleonic era. 8 of the 9 items in the cases remain unaccounted for, and police are still searching for 4 perpetrators. That's your Bloomberg brief. John?
Yahira, thank you. 9:30 in the morning. 4 minutes in and out.
This is what I find so shocking. How is this possible? Especially, you have tourists there. The museum is open. How do you do this in just a few minutes and not get caught? I don't know, it's unbelievable.
Thomas Crown-esque. There's going to be a movie on this one.
It definitely will be a movie.
Up next on the programme, AI driving growth.
Almost half the growth in the US economy so far this year has actually come from this AI-related capex. Recognise that it doesn't go on forever, and there are limits to how strong you can see this performance go on for.
In just a moment, we'll catch up with Innes McPhee of Oxford Economics, live from New York City. You're watching Bloomberg TV. Kicking things off this Monday morning, just about positive by 0.2% on the S&P 500. Your equity market picture looks like this. Positive on the Nasdaq too, up by 0.3 on the Russell. The small caps up by 0.6. Earnings through the week from Netflix and Tesla. Then on to the big ones next week. Microsoft, Meta, Alphabet, all reporting next Wednesday, the same day the Federal Reserve reports its latest interest rate decision. Under surveillance this morning, a focus on tech, AI, driving growth.
Almost half the growth in the US economy so far this year has actually come from this AI-related capex. So it's almost as large as total US consumption spending. So this is the first time we've really seen that scale of capex driving GDP growth like this. Recognise that it doesn't go on forever, and there are limits to how strong you can see this performance go on for, and how long it can last as well.
So here's the latest this morning. Investors looking for signs of strength beyond AI, with a busy week of earnings still ahead. Innes McPhee of Oxford Economics saying outside of AI, the world and the US are in an investment recession, but it's unlikely to become a broader downturn. Innes joins us now for more. Innes, good morning and welcome back to New York.
Morning, John.
Can you break down the numbers for us? So what is AI, and basically what does the rest of the world look like?
Yeah, so I think the first thing to mention really is that a lot of people are focusing a lot on the AI investment numbers, and they're not necessarily thinking about the imports associated with them. So the net impact on growth is actually quite small, just from the investment portion. Outside of AI, of course, investment's been contracting for a couple of quarters, but we don't need to get too worried about that. Investment recessions are relatively common. Go back through the G7, for example. They're about twice as common as normal recessions. So one doesn't necessarily lead to the other. I think the key point for growth really is how these tech stocks are doing, the wealth impact on the high-end consumer, and how that's actually driving growth, not necessarily just the AI investment.
This goes to the bifurcation of the US economy right now. The low-income cohort is really, really struggling, and has been for a while, a number of years. Is there any reason to believe that's going to migrate up to upper-income cohorts as well?
I think that's the real uncertainty. Remember that low-income households, the bottom 20% of the income distribution, are only about 9-10% of overall consumer spending. So it's manageable if it stays there. But they are driven by very different things than the top end. So there's not a direct move from one to the other. We are, of course, in a very regressive tax environment in terms of tariffs, but also in terms of the One Big Beautiful Bill. That will see low-income consumers have their income fall by 2-3 percentage points, whereas at the top end go up by 2 or 3 percentage points. So I'm not sure that there's a direct link between the two. I think we've got to watch the stock market really to worry about that contagion.
How far does the stock market go to explaining how we can have an economy where employment levels have dropped off to the extent they have, and retail sales have remained right up there?
Well, I think that's a big part. But remember, with the labour market, we're seeing two shocks. And this is the thing we've got to get a bit used to in economics, actually, is we've had 20 years of demand-side shocks and supply-side been relatively benign. Nowadays, though, of course, we're seeing much more adverse supply shocks. And that's what's happening in the labour market. We've got negative supply-side shocks alongside a cooling in demand. And that's how you can have this no fire, no hire labour market.
When you talk about this investment recession and the fact that we're not going to have a real recession, can the U.S. remain exceptional even with this investment depression almost?
Yeah, I think it can, because ultimately, let's think about the three big shocks in the world at the moment. First, you've got deglobalization, the impact of tariffs. That clearly is going to impact the surplus countries, Germany, Europe, China, much more than it is Europe. There's a strong correlation in our forecast revisions over the last year, given trade balances. Secondly, On the AI side, clearly the US is not only benefiting much more at the moment in terms of the investment and consumption picture, but should also do so in long term in productivity. And then thirdly, on the sort of policy dynamics, the US is not constrained in its fiscal position, whereas you look around the world, there are a lot of economies who are at the moment. So if anything, there's more upside, I think, to the policy stimulus in 2026 for the US.
Given this backdrop and the investment we are seeing in AI, how important is it going to be these tech earnings that are upcoming?
I think it's really crucial, actually. It's a rally that, for some is built on these earnings. If there's any sort of pullback in the market, really might well pull out the rug from underneath those high-end consumers. I don't see that happening at the moment, but that, I think, is the key risk.
Do you think it's become more important than the Fed decision? And by important, I mean more important for the economy. The earnings we get from the mega tech players next week versus what Chairman Powell's got to say.
Well, this is probably my unpopular opinion, but I have to say I'm not sure that Fed rate cuts really mean a huge amount for the economy, certainly not in the next 6 months. Well, if you look at the structure of debt in the economy, it's far longer now than it has been in the past. We've got a situation where, as in most rate cutting cycles, we're seeing rates come down, but the long end of the yield curve rise, so steepening happening. So financial conditions aren't pulling back or easing as much as many people might think just by looking at the Fed funds. Whereas obviously equity stocks are having a much bigger impact on overall financial conditions in that first phase of pass-through.
Interest rates are going to come down again next week. Most people think they're going to continue to come down. Are you suggesting that's not going to alleviate some of the issues in the labour market?
Yeah, I think that, fundamentally, Fed rate cuts don't have a huge impact on employment, certainly not in the next 6 months. And remember that a big part of what's going on in the labour market is a supply shock, and central banks can't really touch that.
What kind of risks is the Federal Reserve embracing if they're going to be lulled into an easing cycle by misdiagnosing the labour market to the extent that, obviously, based on what you've said, you think they are?
I wouldn't say that they're going to make a huge policy mistake or anything like that. Ultimately, we're talking about moving at 25 basis points, and ultimately from a stance that's pretty restrictive by all measures to something that's a bit more of a grey area. Who knows where neutral is? So it's not like we're going to go, in most forecasts anyway, into a period where we'll have really, really loose policy. So I don't think it's going to be a big mistake, but clearly it's something they can correct pretty quickly on either side.
At least not this side of May. The other side of May, once we get new leadership of the Federal Reserve, who knows what the future holds? How's that debate playing out in Europe? What kind of conversations are you guys having looking across the pond to the US at the moment?
I think there's a lot being talked about institutional quality of the US and whether that plays some sort of role in the obvious decline in the dollar that we've seen so far this year. To be honest, I think that's a little bit overplayed. Who knows who we'll see as the next Fed chair. But if they move rates by, let's say, 50, 100 basis points relative to where the market has them priced now, I'm not sure that's actually a massive change, to be honest with you. And frankly, we've got a very data-dependent Fed at the moment. Maybe a Fed that looks a little bit more towards the forecast and thinks where policy should go and what impact it should have would be a good thing.
Especially given we don't have much data at the moment, and it's good to see you. Innes McPhee there of Oxford Economics, breaking down the contribution coming from AI investment and what we could see from this Federal Reserve going into May when we get that change at the top of the institution.
And overall, what he's talking about is that AI investment. What does it mean for the top cohort spenders? Because right now they continue to spend and drive the growth in this economy, which is why I'm also interested in what firms like Procter & Gamble have to say this week. They were talking about $1 billion tariff hit last time they reported earnings. Where are they seeing consumers spend now? And are you seeing any of those high-end consumers potentially looking to maybe go out and buy deals at places like Walmart?
True. Just quickly, what's the latest on the leadership race at the Fed? I have to say, if you'd asked me a few months ago, I thought they were going to push this through pretty quickly, but it's taken a while.
So I think the reason why there's less urgency now than there was over the summer is because the Fed is already cutting interest rates. So it's giving the White House some breathing room to take their time and decide what exactly they want to do. Also, remember, Jay Powell has yet to make it clear publicly, and I don't think he's made it clear yet to the president or the Treasury Secretary, that he is going to step aside from the Fed. We know that he's leaving the chairmanship, but will he give up his governor seat?
He has cut once already this year. That was last month, and he's set to cut interest rates again this year. That's going to happen potentially next Wednesday. I think most people believe that's exactly what's going to happen next Wednesday. Coming up on the programme, we'll catch up with Sarah Hunt of Alpine Saxon Woods. We'll speak to Henrietta Trays of Vader Partners, David George of Baird, Tom Titsouras of Strategas from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance up next.
There is more inflation risk in the system than markets are currently pricing in.
It's getting a little bit bubbly again in October.
I think the risks to inflation are not really skewed to the upside.
Inflation is going to start becoming a concern if financial conditions remain as easy as they are and the Fed continues to preemptively cut rates.
To me, the big risk is that the Fed does too much too quickly.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P added some weight to last week's rally. Yes, last week's rally, even with all the drama. A week of gains. Up another 1% this morning, up 2 on the Nasdaq. In the bond market, 2s, 10s and 30s. You will get some CPI data later this week. 2s at 3.46, 10s at 4%. That inflation data drops coming this Friday.
Finally, we have some data coming out of the U.S. government, given the fact that we are day 20 right now today in terms of a government shutdown. But that's all we're going to get. We actually don't know when we're going to get the labor market reports because we don't know when the government's going to open. Even so, we have other data coming out in terms of earnings from the big tech players. We're going to get some of them this week, like Tesla, and Intel, and then we have others coming next week that are going to be really important. And then, of course, the trade story. It's starting to take a simmer now. The president has outlined his demands, and the Treasury Secretary is going to sit down with his counterpart ahead of this meeting. And it does seem like both sides are slowly backing away from the hot, heated rhetoric we saw over the past 2 weeks.
Let's just stand the earnings. GM, Netflix, Tesla. Typically, I'd ignore Intel. I'll be very honest about that. And now I'm very focused on it. Does someone from the White House join the call this week? I mean, I'm joking. But there's a massive focus now for the White House and this administration.
Well, I don't know. I'm not joking. Maybe someone from the White House does join the call, at least minimum. So there's going to be someone that's going to look at what Intel reports, right? Because the United States now has an equity stake. They have, their hands in the game, in the cookie jar of this company. They want to see what they report. I'm more going to be fascinated about how the CEO, the CFO, the C-suite talk about the U.S. government stake in the company. And also, since that U.S. government stake, are they starting to get more calls from potential customers? I'm sure they are.
I'm surprised by how quiet China has been about the administration's involvement in Intel. And I've been waiting for this moment for the Chinese authorities because Intel gets a lot of revenue from that country. Been waiting to see what Chinese authorities have got to say about increased state involvement in some of these tech players and how much access they'll continue to get to the Chinese market.
I think, though, the problem Beijing would have is, you're just doing what we've been doing for years. So they can't really poke fingers at the United States because they just, in some measure, took a page from their playbook. But it's going to come down when it comes to things like Intel. This meeting is going to come down. I know we're going to talk about soybeans and fentanyl, but really the most potent weapon China has in the United States is rare earths. And what the United States potentially could give to China is more access to advanced technology.
And the tension around that has really whipsawed this market over the past week or so. Equity futures on the S&P positive here by 0.2%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods, with Wall Street looking to turn the page on credit risk. Henrietta Trays of Vader Partners as US-China trade friction eases. And Tom Titsouras of Strategas as the flight to gold continues. We begin this hour with stocks inching higher as investors look past credit concerns. Sarah Hunt of Alpine Saxon Woods seeing the wall of worry becoming somewhat steeper. She writes the following: credit is usually the culprit in stock market sell-offs. Add to that concerns about equity market valuations, and we go a pop higher in volatility and lower in yields and equities. Sarah joins us now for more. Sarah, good morning.
Good morning.
Have we got a credit problem or an isolated fraud issue?
That is the big question. And I think that is something that is going to come under increasing scrutiny. You saw what happened with the regional banks. You saw some of the business development companies have some issues with their stock prices because people start to worry about that whole private credit boom and what is underneath the surface where you can't see it and whether or not that's going to be a problem. Right now, it looks to be somewhat isolated. But every time there's another thing that comes out, it becomes a bigger problem. And that sort of goes to Jamie Dimon's comment, right? So I think that is going to be the issue, and how much that continues for the next couple weeks, months, days. It really depends on whether or not something bigger happens.
Did you find it odd that the diamond comment became the headline for last week? At the same time, earnings knocked it out of the park on Wall Street and stocks finished the week higher.
Not really, because it sort of goes to that list of things that people are concerned about. And I think that people have been talking about private credit and talking about some of those illiquid areas of the market and whether or not there are going to be issues in there and you can't see what the valuations are for a while. So it's more that once something comes out, then it becomes a bigger problem. So I think that part of that was just the fact that something did happen and everybody was a little bit worried about that happening. So it's not surprising that that got latched onto.
It's hard to make the argument right now, looking across the banks, that net charge-offs are spiraling out of control, non-performing loans are increasing. I don't see much of that at all. Now, it's not to say that it can't happen.
Right.
And I can see why people are worrying that we go from 0 to 60 pretty quickly. I understand all that. But is there anything else outside of the issues we've discussed that support the need to worry?
I think the issue in credit is not with the big money center banks, which reported first and reported really good numbers. I think it's more down in the regional banks and in some of those private credit areas. And I think that that's the concern. And to the extent that that's not the biggest spending cohort, to your point earlier, then it's not that it doesn't matter. It's more that who's caught up in it and how bad is it going to be. And if it's not that bad, it's not going to matter. If it's a few banks that have a problem here or there, it's not an issue. But this sort of reminds me of the issue with Treasuries last year when it was like, oh my goodness, now all of a sudden these banks that you wouldn't have thought of have a gap because of the mark-to-market problem. So it really depends on where this goes. If it stays somewhat small and contained, I don't think it's a big issue. But it's definitely one of the things that people are concerned about.
It's staying small and contained, at least at the moment, is what it feels like. Do you think all this spend and focus on AI investment can kind of put pest infiltration to the side?
As long as that continues and it doesn't look like that's got a crack in it, right? Because every time you see a crack in the AI story, whether or not there was something that went around, I think, last week about how many hits this happened and whether or not that was smaller than it was and what does that mean? And I think that anytime you get a question about that, people start to question the premise of why valuations are so high. On the other hand, we do have rates coming down, and that makes a difference as well. Whether or not it makes a difference to the economy as such, it definitely makes a difference to investors and to the stock market, because lower rates do make room for those multiples.
Jonathan asked this question last hour. Is it more important to hear from the tech mega giants than it is from the Federal Reserve?
It's both, but right now, if there's any slippage in earnings from the tech guys, I think you're going to see a more wobbly, more volatile market, because with the lack of data and with the assumption that the Fed's going to cut at the end of this month, I think that right now that is not as much of an open question. But if you see anything in the earnings, or if you see any concern in the earnings on the tech side, or a slowdown meaningfully somewhere that can't be explained by we don't have this capacity to give people something, then I think people really start to worry about what that looks like and that spend direction looks like.
Have you got a company you'd be more focused on than others? Next Wednesday, the same day the Fed meets, we'll have Microsoft, Meta, Alphabet, the rest will follow. Is there one that stands out more than others?
I think it's the compendia of those who are spending the most, right? So it's all of them. And if anybody says something odd and everybody else doesn't say it, then I think it's okay. If you get a bunch of different comments that are like, well, we're pulling back a little bit here, or the year-over-year spend is going to be X instead of X plus 10, I think it's really going to be a question of what they say collectively, because collectively that huge spend in the top of the, basically data center market is what's been driving a lot of this stuff. So everybody kind of has to be on the same page, I think.
There's two very different approaches between China and the US. Of course, those two countries will become the focus of attention over the next week when the two leaders get together at the end of this month. China's shooting for efficiency. We saw that with DeepSeek at the start of the year. America at the moment, based on what we're hearing from these companies, is just shooting for massive capacity, investing tons and tons of money. Is there an approach that, as an investor, you feel more comfortable with?
Well, I think that right now it's harder for the U.S. to jump in and do the efficiency thing. They're going to have to, because the reality on the ground is the power that's needed for currently what is extrapolating from the demand is way bigger than we have. So there has to be an efficiency argument ultimately. And I think that there will be. The question is going to be, who does that affect the most? And I think at the moment, right now, it's just a race to get all the chips on the board. It's sort of like the dark fiber in 2000. It's like, we just need to put fiber down. We just need to put fiber down. And at some point, that has to work together. And I think that there will be efficiency in the United States, because I think there has to be. And the innovation will get there, because you just don't have, power prices are already higher. It's already an issue. It's only going to get worse. And I think that that's something that will end up being solved. How exactly and who benefits the most, I'm not sure yet.
Yeah, how exactly is it going to be solved? Because obviously, potentially government regulation would have to come into play. When you think about the trade talks. That's, I'm sure, part of your wall of worry. Were you given some comfort over the weekend by the president's comments?
I think it's really difficult. A comfort just in the de-escalation, right? The words themselves are not as important as the tone. And if the tone is de-escalation on both sides, that's probably better for markets. It was when the tone started to get very hot on both sides that markets got very wobbly. And I think that that's one of the things where we just can't know the outcome, and what they say and what actually happens on the ground are not necessarily going to be the same thing, because it almost never is when people are doing negotiations. So we won't know what the final terms are in any near term, but the idea of less fighting versus more fighting is better.
But when you look at a meeting like that, are you concerned that it just bleeds into 2026 if it doesn't go well, some of this hot rhetoric?
Well, all of the tariff stuff is bleeding into 2026, right? Like in April of this year, we were all convinced that something was going to happen, and it was very short term. And now all of a sudden that has been pushed out throughout the entire year. So now, yes, it will bleed into 2026. And I don't think that's necessarily a concern as much as it's reality on the ground. That piece of the wall of worry is going to continue to have to be climbed. And not just with China, but in general, China is obviously one of the biggest issues.
Just quickly, what's your favorite sector right now and why?
Well, I think if you look at some of the places like defense, which has already run a lot, but you've got some big thematic stuff that's not just AI, right? So Golden Dome, so some of the spending that's going to come that you know is coming is very helpful. So there are areas in the industrials and defense that are going to play into that. And I think that this is a very good time to be looking at longer term thematic investing, because you know that there are places where they're going to continue to spend.
Least favorite?
Least favorite is tough. Consumer is really hard right now, because I think that a lot of the low-end consumer is having a hard time. So consumer is mixed, and even high-end consumer is not perfect. So I think that there's some issues there. But it's interesting that the iPhone is finally getting that upgrade cycle that Dan Ives has been looking for. So I think that there's some good news in that regard.
Dan Ives has been waiting for a while for that. Let's put it that way. Sarah, it's good to see you.
Good to see you,
Thank
too.
you. Sarah Hunt there of Alpine Saxton Woods. We'll bring you more on that Apple data later this hour. Let's get you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahira. Hey, Yahira.
Hi, John. Amazon Web Services says most of its operations are succeeding normally after a widespread outage. The disruption from the world's largest cloud provider impacted a range of services, including AI companies, government agencies, and financial platforms. AWS identified a problem with a regional gateway on the U.S. East Coast that caused the issue. Meanwhile, a cargo aircraft skidded off the runway into the sea at Hong Kong Airport, killing 2 ground crew in a patrol car. The plane's 4 crew members were rescued and taken to the hospital. The airport authorities said weather and runway conditions were suitable for flight operations at the time of the accident. The cause of the crash is under investigation, and the plane's black boxes have not yet been recovered. And French luxury giant Kering has agreed to sell its beauty division to L'Oreal in a $4.7 billion deal. The two companies will also work together to create, develop, and distribute fragrance and beauty products for Kering's top-line luxury brands. L'Oreal is the world's biggest dedicated cosmetics and beauty group. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. More from Yahira in about 15 minutes' time. Up next on the programme, coming to the negotiating table.
One of the things I want is China's going to buy soybeans. I want China to stop with the fentanyl. Very, normal things. I don't want them to play the rare earth game with us.
Incredibly reasonable. Asked from the president, how achievable is it in a meeting he'll have with the Chinese leader later this month? Henry Trays of Veda Partners joins us next, live from New York City this morning. Good morning. Easing into a brand new trading week, equity futures just inching higher by 0.2% on the S&P 500, on the Nasdaq up by a third. Under surveillance this morning, coming to the negotiating table.
I have a very good relationship with President Xi of China. We're having disputes on things. They're paying us a lot of money, tremendous amount of money in tariffs, and they'd probably like to have it be less, and we'll work on that, but they have to give us some things too. One of the things I want is China's going to buy soybeans. I want China to stop with the fentanyl. Very, normal things. I don't want them to play the rare earth game with us.
So here's the latest this morning. The Treasury Secretary Scott Bessent confirming trade talks between the US and China will take place in Malaysia later this week. The move bringing both countries together ahead of the November 10th trade truce deadline. Bloomberg's Tyler Kendall has the latest. Good morning, Tyler.
Hey, John, good morning. So this is certainly giving us an outline on what to look out for ahead of those planned talks later this week in Malaysia. And then, of course, President Trump's expected face-to-face sit-down with Chinese President Xi Jinping on the sidelines of the APEC summit later this month. Now, the White House maintains that threat of a 100% additional levy remains on the table. But President Trump himself over the weekend had said that rates that high are not sustainable. It is considered to be a softening of tone as we actually got some indications that China is also working to tamp down some concerns. People familiar tell us that this past week on the sidelines of the IMF meeting here in Washington, the Chinese delegation told counterparts that its recently unveiled curbs on critical and rare earth minerals are not expected to disrupt normal trade flows. Now, critical and rare earths have really been at the center of the talks, and they will continue to be, but we're really starting to see the pressure ramp up around another area, and that is, of course, around soybeans, as U.S. farmers across the country are now sounding the alarm that they are running out of storage space to keep their unsold soybeans, as China has not made a single purchase when it comes to U.S. supplies. Just for some quick context, China accounted for more than $12.6 billion worth of U.S. soybean exports last year alone. Now, John, a senior administration official tells me that the Trump administration is working to find other export markets and also other uses for U.S. soybeans. But I'll also throw one more dynamic on your radar that we should keep in mind here, which is that this official confirms that an expected aid package, an economic assistance package for farmers in the wake of this trade war is currently on hold because of the government shutdown that is only going to add fuel to this fire going forward.
Tyler Kendall with the latest down in Washington. Tyler, thank you. To build on that story, Henrietta Trace of Veda Partners joins us now for more. Henrietta, welcome to the programme. Pretty reasonable, obvious, intuitive ask from the President of the United States: buy our soybeans, stamp out fentanyl production, ease the flow of rare earths to the world, not just the United States. Henrietta, what does China want in return?
Well, China's in a pretty strong position here because, as Tyler was just laying out, the president has two choices. He can either negotiate a way to bring tariffs down and give China what they want and get a deal for China to buy our soybeans, or he can negotiate with congressional Democrats. And he's choosing to go with President Xi here on this one. So the primary endeavor has to be to find a way to get soybean purchases made from China again. And then we'll see if they actually deliver. They famously did not deliver in the phase one deal reached in Trump's first term. But the choice here, I think, is really telling that the president would rather engage with President Xi of China and try to get a purchase agreement sometime in the next couple of weeks, rather than negotiate with Democrats. So I think
that's not entirely fair, is it? We're waiting on this is a clean continuing resolution, which, you know, when I remember during the Biden days, they would come on television and say it's the Republicans that are holding the government hostage. It's a clean continuing resolution. We have a number of Democrats, 3 of them, that continue to vote for it. Isn't it also on the Democrats to, at some point, open up the U.S. government? We're going to have another week where federal workers don't get paid.
Sure. And so they've tried 11 times to vote for that very same bill, and nothing is moved. So the alternative is try to negotiate with President Xi. And so I think that's what the president of the United States is preferring to do instead of offering different terms to
isn't
Democrats.
This also John Thune and Speaker Johnson? Isn't it their job to be negotiating with the Democrats, less so the executive branch?
Yeah, absolutely. Especially Senator Thune. He's the only one who actually needs to negotiate with the Democrats here and get some sort of additional vote to shake loose. My time on Capitol Hill throughout last week showed very clearly that the Republicans in Congress are taking their direction from President Trump, and they're awaiting any kind of indication from him that he wants to throw out new ideas. And that's obviously not coming. I don't expect it to come at all this week. They'll have a Republican gathering at the White House on Tuesday, and then he'll leave town for Asia. So the government's going to stay shut down. I'm not expecting any breakthrough here. And as I mentioned, I think he'd prefer to negotiate some sort of off-ramp for soybean farmers with President Xi than change the terms of the current deal in the U.S.
As I mentioned, federal employees are slated to miss their first full paycheck. There's a great outline on some of these pressure points this morning from Punchbowl News. Do you think with federal workers missing paychecks yet again that you can have maybe see the senators from Virginia and Maryland vote for the clean continuing resolution?
That's the Republicans' hope. Their thought is that you can maybe peel off 3, 4, 5, 6 more Democrats to get the final 60 that you need. The Democratic strategists that we speak with throughout the week, last week as well, are saying you're not going to get this bill passed with just 60 votes. You're not going to be able to just peel off Virginia and Maryland. You're going to need to get, 70, 75 members. And I think what's interesting here is that there are a number of Democratic farm state senators who could be compelled to vote for a farm aid package, such as New Jersey, which you don't often think of as a farming state, but it absolutely is. So there's a way out here that I think ties some sort of negotiation over ACA subsidies with the farmers' bailout package, because they need it, and they're obviously not getting it while the government's shut down. They've run out of ways to pay for a whole host of these things, including federal employees.
You're obviously tracking the polls as well. Who's winning in the court of public opinion?
Man, what's funny? I don't think that the public particularly cares about the shutdown. And that's why you're not seeing the president unduly focus on it. The Democrats think they're winning. Republicans think they're winning. And about 9 points of independents thinks that Democrats are winning. But in general, it's basically a third, as some Republican strategists told me last week as well. So as long as there's not a tremendous amount of pressure, the TSA is not, quitting en masse or just not coming up to work, that will eventually start to happen, presumably. But for now, it's not a priority.
That's one of the more traditional pressure points, Henrietta. Right now, I'm with you. Wall Street doesn't care either, by the way. A lot of guests come on the programme, we don't even talk about it. When do we get to that point? When do we reach the limit of this, and where do you see that on the calendar?
I think the calendar is the right way to focus on it. You got to get through this meeting with President Xi, see if Trump's able to shake out some sort of deal on soybeans. And if that fails, then you move to Congress again. And it's going to be around that first week of November. So I'm expecting us to be shut down through Halloween. Sometime between November 1st and November 7th is an ideal sticking point when things really starts to get painful for everybody involved.
Henry, we saw some funds being moved around the Pentagon to make sure active duty servicemen and women were able to get paid. Can that happen again on their next pay period?
We don't know how long it can last. There's about $8 billion in R&D funding that's already legally subject to oversight and law restrictions. I mean, we famously fought a war 250 years ago to prevent the power of the purse being anywhere other than with Congress. So there is a serious amount of concern, especially from the appropriators, on where this money is coming from. It's going to run out, I suspect, by the end of this month. They're getting very inventive. They are stretching the law to the extent that they're able. But there's a lot of things that we need money for. Federal troop pay, WIC, SNAP, and obviously farmers.
So it sounds like this is all going to come to the head at the end of the month, early in November. If it doesn't, and the government continues to chug along while being shut, what do you think the ultimate pressure point is? Is it 2019 and FAA saying that a number of planes are going to be delayed in some key airports around the United States?
Yeah, I think that's a perfect lever to be focused on. I think the military pay issue is going to start to become a problem. This is a comprehensive shutdown, so there's no agencies open right now. So the data that the street is waiting for will also stop coming. It all starts to build and pressure on itself. I don't think there's any one silver bullet here that's going to neatly resolve this. I think a combination of a farmer's bailout, funding for the troops, missing the November 1st date when everybody's, ACA subsidies get hiked when they go on the exchange. That combo is really what's going to start to pressure it. But there, as you pointed out earlier, the Republicans really need President Trump to engage in the fight. And right now he sees no reason to.
Another guest suggesting we've got to wait until November. Henrietta Trace of Ada Partners. Henrietta, thank you. That was Henrietta Trace calling for a shutdown that reopens in November. Terry Haynes of Pangea in the last hour saying exactly the same thing. So we've gone without the September payrolls report, and based on this, might have to wait for the October one as well.
Right. And you wonder if the data is going to be reliable, given the fact that it's going to take a long time to collect some of this data, because not everyone was deemed essential that they were able to come back for the CPI report. So at some point, when are we going to get a really clean read? I think that's going to be in a few months' time. It has to be, 30, 60 days after the government reopens, a really clean read on what's been going on in the labor market. At the same time, the Fed's still going to cut interest rates.
It's going to take a while. Terry's point was rather different, though. Terry thinks that the Republicans want to leave the spotlight on the Democrats for the New York City mayoral election. Just the idea that the beating heart of capitalism, American capitalism, could have a socialist mayor in New York. And that's going to be the reality, according to the polls that we've seen.
Absolutely. He is leading in the polls. I think the debate also showed that this is someone that is splitting the others are basically splitting the vote between Sliwa and Cuomo, and it's Mandami's to lose.
Up next on the programme, we'll catch up with David George of Baird with an upgrade for regional bank Zions. That conversation up next. Lots of negative headlines about credit. Never good. Cockroaches. Never good. Your equity market was higher by 1.7% on the S&P last week. Small caps are up by 2.4%. The equity rally continues. Again this morning, up 0.3%. On the Nasdaq 100, up by 0.4%. On the Russell, smalls up by 0.7% this morning. In the bond market, 2s, 10s, 30s, 2s around 350, kind of anchored around those levels at the moment. Let's call it 347. Up a single basis point of the session through last week, lower. Likewise on 10s. The data of the week, CPI, coming up on Friday, going into the Federal Reserve decision the following Wednesday. So next Wednesday. Let's finish on gold if we can. What a rally we've seen for gold over the last few weeks, the last 2 months. 9 consecutive weeks of gains for the precious metal. And if we make it week 10, we're looking at the longest weekly winning streak going back to 1980.
It's absolutely unbelievable what's going on with gold, especially since no one in the market is saying this is the top. They're saying actually it's going to be 5K next year. And what's so surprising about this trade is risk on, gold goes up. Risk off, gold goes up. It's become this store of value for a number of different issues happening around the world at the same time. Fed cutting interest rates, concerns about global fiscal issues in countries like Japan and in Europe, and then as well as this slow turn story we've seen since Russia's invasion of Ukraine of more central banks wanting to get their hands on the precious metal.
Certainly reached a more speculative phase, that's for sure. Gold this morning, 42.63, following a really volatile session on Friday into the weekend. Into the session this morning, 2 hours away on the equity side of things. Let's get you some morning movers with some single names. Here's Yahara. Hey, Yahara.
Hi, John. We start over in France with PNB Paribas shares plunging 8% to a 6-month low after losing a U.S. court case over allegations that helped finance the Sudan government amid a genocide. A jury awarded $20 million to 3 plaintiffs, but analysts are warning that it could face a much bigger settlement, potentially in the billions of dollars. BNP says it plans to appeal. Meanwhile, President Trump's latest comments on U.S.-China trade are helping lift the rare earth sector, with critical metals up 8%, while U.S. rare earths and MP materials are also surging after they suffered some losses on Friday. But today's gains come, of course, after President Trump said he doesn't want Beijing playing the rare earth game with the U.S. and listing the minerals among his top issues ahead of trade talks this week. And we end on Weight Watchers. This is a company that has been making strides after emerging from bankruptcy back in July. Shares are up nearly 5% after it announced a partnership with Amazon Pharmacy to deliver weight loss medications, including injectable GLP-1 treatments, directly to its members as demand for those drugs continues to soar. John?
Yahara, thank you. That stock up by close to 5% in early trading. On a raise out this morning, President Trump listing rare earths, fentanyl, soybeans as his top issues with China. The US is set to hold talks with Beijing later this week in Malaysia as the trade truce nears its end on November 10th. Elsewhere, positive news for Apple's upgrade cycle. According to Counterpoint Research, the iPhone 17 is outselling the 16 by 14%. The firm comparing the two devices over their first 10 days on sale in both the US and China. And finally, an update for you. Amazon Web Services saying its cloud service is recovering after a major disruption overnight. The issue affecting a range of customers, including government agencies, AI companies, financial platforms, and other sites such as Coinbase and Robinhood.
So it sounds like things are proceeding as normal now this morning. It's not even 9 a.m. So I think a lot of people were excited. I was getting some viewer notes that you called it a snow day for adults. Well, get out of bed if you haven't gotten out of bed already. You can't just blame it on that now. It's 7:30 in the morning and basically Amazon is like, we figured this out.
I mean, this is what you'd want to shut down, right? Zoom, without a doubt. Slack, without a doubt. Cut it off, take the day off.
Or Zoom shut down, CEO calls, get to work. Get back to your desk.
In-person
physically.
meetings. Is that a conspiracy this morning?
Take an Uber, take a taxi,
you sound like
take
Jamie
a city
Dimon.
bike.
Let's turn back to Wall Street. And not Jamie Dimon, but his more recent comments. Credit fears easing after loan blow-ups for regional banks such as Zions and Western Alliance. David George of Baird upgrading Zions to outperform, calling the pullback, quote, excessive. David published that note going into Friday's session. He joins us now. David, welcome to the program, sir. It's good to see you. Let's just start with how disciplined this company has been, Zions exclusively, with loan growth over the last few years. Can you just frame things for us, David, before we get into it?
Sure, of course. Good morning, John. Good to see you. So Zion's it has grown, and this is, I think, fairly indicative of the banking industry broadly. Loans since COVID have really only grown in the 2 to 3% area. And if you think about going into the GFC, as market participants are always kind of trying to fight the last war, a number of banks were growing construction loans in the 15% plus area. So as we think about credit broadly, John, there's just not any bubbles that we can really see on bank balance sheets. We're obviously vigilant and keeping an eye on things. But again, like we said in our Friday upgrade of Zion's, for the bank to lose $1 billion in market cap over a $50 million fraud loss, we think was more than excessive and provides an opportunity to buy the name here.
Clearly, David, people are still jittery after the events of a few years ago. A few years ago, around the regional banks, it was about mismanaging interest rate risk. And I guess there's a fear in general that people have mismanaged credit risk somewhere. And David, I understand where that's coming from. We had a period of very easy monetary policy, very easy fiscal policy, and people are making the case, as they often do, that the worst of loans are made in the best of times. David, you're not ignorant of that fact. I know that. I've known you for a long, long time. If there are pockets of weakness somewhere, where would you be looking and what would you be avoiding?
Yeah, I think that really, to answer your question, John, I think it's going to be broad-based, your traditional consumer and corporate loans. So it's going to manifest itself the next downturn or the next normalization, I would call it, would be in credit cards and home equity and mortgage. And then on the commercial side, it would just be in your traditional C&I, commercial and industrial loans. And it's not going to be, I think, in CRE. I think those problems have been largely identified and reserved for, and we're kind of working through those problems now. So I think it's going to be just something that's broad-based. And we are of the view that credit cannot get any better and that it will normalize. But to suggest that we're on the precipice of a disaster on bank balance sheets, we just think that is misplaced.
Let's go with what we know so far. So Tricolor, First Brands, the exposure to fraud that we heard from Zion's and Western Alliance. Is there a common thread there, David, already across those things? Or is that sample, that data pool, still too small?
I don't think we should minimize that, obviously, John. And fraud is something that, as you both know, it's the kind of thing that manifests itself when we get late into an economic cycle. And as you said earlier, we have had a lot of tightening of monetary policy, and that tends to operate with a lag. So it's very reasonable to think that we will see some credit issues, and these frauds certainly are not to be ignored. But again, I think it's important. Everything needs to be in context and contextual in nature, and it's all a function of what market cap has been taken out of these stocks relative to what the actual financial and ultimate loss exposure is going to be.
John mentioned Tricolor. The Treasury Department in 2019 and the Wall Street Journal did an opinion piece about this last week, identified it and designated this company as a community development financial institution. So it was eligible for special grants. Do you think there was an oversight issue with Tricolor, then potentially there's going to be oversight issues with other companies like that?
Yeah, I'm not sure, Anne-Marie. I don't think that's something that it would be something that would be that I would be particularly concerned about. I think in this case, this was a situation where it was just flat out fraud. I think collateral in this case was double pledged or triple pledged. And I think it was just a fraud situation more than anything, rather than anything deeper than that as it relates to CR loan mandates or anything like that.
What we saw last week with Zion, do you think all of that was exacerbated by Jamie Dimon's comments for everyone to be lurking and careful about pests potentially in the credit space?
It could be. Jamie certainly has a way of making headlines every time he speaks, and for good reason. Obviously, he's a great CEO, has done a phenomenal job over the course of his career. But it's important to note that there have been a lot of comments over the last 10, 15 years about 7% Treasury rates and hurricanes and so forth. So again, it's important to have everything in context and to just kind of calmly think about these numbers and then just kind of frame those from a risk reward standpoint as it relates to the stock. So we're trying to help our clients make money in stocks. And when there's an opportunity, either on the short side or the long side, we want to try and be in front of it. And that's what we're doing here.
Well, I give you credit for upgrading the stock going into Friday, David, when everyone else was freaking out. That stock rallied on Friday and it's up again this morning. David, Anne-Marie mentioned JP Morgan's Jamie Dimon. I'm going through your coverage list of the 20 companies on the Bloomberg you cover, 11 buys, 8 holds. You know where I'm going. 1 sell. Underperform, JP Morgan. David, talk to us about that. What's underpinning that call?
Yeah, it's really important, John, as we think about covering these stocks, and it is to differentiate between stocks and companies. And to be clear, JP Morgan is probably the best company we cover if you just think about its product breadth and consistent performance really throughout the last 25 years that we've covered the stock, and we've been constructive on it most of our career. But from our perspective, when JP Morgan gets to 3 times tangible book, it's simply unattractive to us on a risk-reward basis. We think that there's much more value in a stock like Zions or Fifth Third or First Horizon or Huntington or PNC, where you can buy those stocks at 8 times earnings rather than JP Morgan at 15 times earnings. So I think it's a question of whose earnings are worth more. And from our perspective, JP Morgan, and for good reasons, great company, but it's just too expensive and is relatively overowned in our opinion, John.
David, you mentioned Fifth Third, a call that you had months and months ago. Fifth Third and the prospect of them turning up, getting together with Comerica. For many in this space, and we've heard it for a long, long time, this is the start of more to come. Is that how you see it? And who do you think's next?
You know, we do. Clearly, I think we're at 4,500 banks. There's still too many banks. And I think the regulatory framework has gotten much more conducive for bank M&A. So in the case of Fifth Third Comerica, that's a 6-month close, which is really remarkable if you think about it. If this deal was announced during the prior administration, it would be at least a 12-month, if not longer, closing process. So we do think there's more deals to come. On our list, we think First Horizon is the most likely sale candidate. We think that there's a number of potential buyers that would be interested in First Horizon, and it's a $25 to $26 private market value from our perspective. And Comerica, as you mentioned, was one of our top takeout picks. And we're very constructive on that Fifth Third Comerica merger. That Fifth Third has got excellent retail banking acumen, and we think that's going to be very complementary to Comerica as those companies come together in the first quarter of 2026.
David, appreciate your time. As always, buddy. Thoughtful note going into the weekend. Thanks for sharing it with us. David George there of Baird, and what's happening with the regionals and why so much more constructive on certain names like Zions after the sell-offs. The difference between companies and stocks. Can have a good company doesn't mean you've got a good stock based on how it's priced, and that's how he thinks about JP Morgan at the moment.
Right. When JP Morgan, when he said the 7%, though, had flashbacks when the Fed was hiking interest rates, how different we are in a place right now than 2023. And Jamie Dimon made those comments on Bloomberg TV, how to stomp out inflation, they're going to have to keep hiking. We never saw 7% interest rates.
He's a risk manager, and I think he likes to anchor people's minds to the extreme and then try and get everyone to manage people, thinking about the wide range of risks. And ultimately, that's why you get these flashy headlines. I find it very distracting sometimes, and certainly the 7% story was somewhat distracting.
Imagine how distracting it is for him to go to bed when he's concerned about all these things. Hurricanes, 7%, credit cockroaches in the market.
In markets, there is always something to worry about.
True.
Equity futures on the S&P 500 firmer by a few tenths of 1% with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. President Donald Trump says the U.S. could purchase Argentinian beef in an attempt to lower prices for American consumers. U.S. beef prices have been high because of drought and reduced imports from Mexico. Trump has been working to help Argentina bolster its currency with a $20 billion credit swap line and additional financing ahead of midterm elections for his ally, President Javier Milei. Meanwhile, President Trump says the U.S. will halt all aid to Colombia and impose fresh tariffs on the country. Trump accused Colombian President Gustavo Petro of being an illegal drug leader, claiming drug trafficking has become the country's biggest business, with leadership doing nothing to stop it. Petro responded by posting that Trump is being deceived by his advisors. And the federal government shutdown continues, nearing its 4th week. The Senate is set to reconvene and vote later today. Republicans are pushing a continuing resolution to reopen the government at current funding levels. Democrats want a deal to extend health care subsidies due to expire at the end of the year. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, going for gold.
In a world of positive real yields, you're not supposed to love gold. So there's something else at play here. What I worry about is people speculating on it now that you've had a pretty big move.
had a major move. Up next, Tom Titsouris of Strategas, live from New York City. You're watching Bloomberg TV. Take a sneak peek of this week, and this week is really about setting things up for next week. So this week we get talks between China and the US, but that's about setting things up going into the end of this month when we have talks between the US and Chinese leader. Take a look at the earnings from GM, Netflix and Tesla, Intel. That's an appetizer for next week when we get Microsoft, Meta and Alphabet, and CPI on Friday. That sets up an awkward Federal Reserve meeting the following Wednesday. Next week when the Fed gets together, we could have inflation with a 3 handle, no employment report, and they still reduce interest rates. And that's widely what's expected into next week. Into this week, here's the price action. Equity futures on the S&P 500 firmer by 0.25% after a really solid weekly gain. I've mentioned a few times the S&P 500 was higher by 1.7%. That weekly gain, the biggest since early August. Up again this morning. On the Nasdaq by 0.3%. On the small caps, the Russell up by 0.7%. Turn to the bond market. 2-year and 10-year bond yields down across the board through last week. This morning, just a little bit higher on 2s, 346.77 on 10s, around 4%. Some money starting to drift back into Treasuries. Remember all the freak out that people had early August? The Fed would cut, maybe they'd go too early, the long end would sell off. That hasn't been how things have developed. Yields have rolled over again as we exited the summer through September and into October. 2-year yields at 346, very close to the lows for the year. That's the story in stocks and bonds. Let's talk about precious metals. Under surveillance this morning, going for gold.
In a world of positive real yields, you're not supposed to love gold, so there's something else at play here. Gold is central bank diversification. That's really been happening since 2022. There's a lot of geopolitical uncertainty. I think gold makes sense in a portfolio as a hedge against some of these risks. What I worry about is people speculating on it now that you've had a pretty big move.
We've had a major move. Here's the latest this morning. Gold bouncing off a sell-off in precious metals on Friday. Ongoing economic uncertainty keeping the commodity close to all-time highs. Tom Titsouris of Strategas writing, we suspect that gold is telling markets that the US yield curve needs to steepen in order for tens to maintain their status as the primary safe haven. Tom joins us now for more. Tom, welcome to the program. Understand the theory, but based on the price action, does it back it up?
Yes, absolutely. I think the price action is telling us that there are overflows into safe havens, and those overflows are going into gold rather than treasuries. You know, we've gone through a period, we'll call it 15 years, where anytime there was a bump in the night anywhere around the globe, whether it started in the US or it started in France or anywhere else, the flows into 10-year treasuries were just astronomical. And that's just not happening this time. Yes, you're getting some safe haven flows as we're seeing stories about bad loans and worries about systemic credit risk. And so 10-year yields are rallying, but they're not rallying as much as you would see in previous cycles. And so gold is getting the overflow of that safe haven flow. And that's really the big reason why you've continued to see this momentum trade in gold, in my opinion. Obviously, there's folks following into that, but it's the overflows from lack of appeal from the traditional safe haven that I believe is really the big driver in gold right now.
Tom, if you think of how deep these pools are, the gold pool just isn't deep enough to be the alternative to treasuries. I've heard that directly from Goldman too when they've come on the program, which is why you've seen this massive exponential move in gold. Can it really replace treasuries, Tom, given the depth of the pool and available liquidity in the treasury market compared to, say, gold?
Absolutely not. It can't. And so eventually, if these fears of credit contagion, if they really were to spread and we start to see more signs of pests in the attic and stuff like that, then you're going to see 10-year treasury yields not just dropping below 4%, but rallying down to close to where 2s are right now. And that's not happening yet, but there's just the gold market's not big enough. The precious metal market's not big enough. The entire sovereign G10 market's not big enough. Treasuries are going to have to be the final outlet if there is that type of risk.
Tom, you're looking a lot about what gold is doing in terms of the treasury market. Are you also concerned about de-dollarization and countries trying to get their hands on gold because they don't want to touch U.S. dollars?
Well, there's two reasons why we said the U.S. curve has to steepen here in order for the flows into gold to stop. One is that if there's an economic contraction in the credit cycle, which everybody's focused on right now, the other scenario is that we have strong growth in the U.S., the Fed eases into that, we have loss of Fed central bank independence, and de-dollarization just amplifies this. And so the curve has to steepen just to accommodate that. So two scenarios, a weak economy and a strong economy, both would suggest that one, gold is going to continue to see flows, and two, the U.S. Treasury curve, in order to compete with that, needs to be steeper. We just don't know whether it's going to be a strong economy or a weak economy. But in both scenarios, yes, absolutely, you see the curve should steepen and gold should continue to see safe haven flows. But the de-dollarization story is another reason why gold is rallying or picking up those overflows into safe havens that would otherwise go into treasuries.
So you don't think we're seeing gold move into a speculative stage? You think there's going to be more flows? How much higher could we see gold go?
Well, I'm probably not an expert on the precious metals market, but I will say this, that near term we look overbought. But if you think about all the potential flows into gold over the next, let's say, year, a reasonable estimate of 5,000 per ounce, I mean, that's not unreasonable at this point in time, because you're going to continue to have central bank buying, because you're going to continue to see the global, we'll call it trade environment, deglobalize, and there's going to be less demand for dollars. That's absolutely true. You're very likely to see inflation reaccelerate next year, driven by service sector inflation, not tariffs and goods inflation, but service sector inflation, as the U.S. economy begins to stimulate and reaccelerate ahead of midterm elections. So all of those would suggest there's a fundamental driver for gold to push higher. But near term, I would argue that we're probably overbought here, because the flows definitely seem speculative very near term.
So, Tom, that's gold. This is where the bond market move gets interesting, for me at least. If you believe that's going to happen, we've got a bond market rallying into potentially hotter inflation prints, and a Federal Reserve that, given how it's communicated over the past month, is willing to ignore those hot inflation prints. Now, if the Fed's willing to ignore hot inflation, Tom, will the market, will investors?
No, I don't think so. So I think in that scenario, you're talking about, yes, there's credit concerns, but they're manageable. The real issue is that the U.S. economy begins to reaccelerate. And in that scenario, the curve bear steepens, with tens pulling away from twos, but eventually twos pushing higher as well, as the market probably takes one of those rate cuts from 2026 and just takes it off the table. So you get a bear market steepener, everything's pushing higher, but tens push higher at a slightly faster clip. That's our base case forecast for this year, with tens forecast to end the year back around that 430 zone. And next year, tens pushing back up close to 5%, as the market realizes that the fear is gone. There is an economy that is still reasonably healthy, and Treasury yields have to push higher to accommodate the slightly higher pace of inflation and still slightly higher pace of growth, too.
That's an understandable argument for higher bond yield to the long end. Tom Sisoris of Strategas. Tom, thank you, sir. Today, though, not seeing that steeper curve. We're seeing a flatter curve, led by a move at the front end. Yields up by just a basis point. 10's just about unchanged. 2s to 347. 10's to around 4% in the bond market so far this morning.
What's so interesting about the CPI report, looking at the surveys, CPI year over year, 3.1%. And yet, the following week, the Fed is likely going to be cutting interest rates without the labor data that we know that they have a bias towards right now, but with hotter CPI.
No jobs data for September. Based on what we've heard from the policy analysts this morning, no data for October either coming up. It's going to be a while. It's going to take a few months.
They're going to be flying blind. We will not get the jobs data, but we will get in the increase following months is potentially continuous CPI data. And that's going to continuously basically show potentially that it's a hotter print. The Fed's going to keep cutting into that.
Lots of earnings this week. Some data as well. CPI coming out on Friday. That delayed inflation report. Up next, we'll catch up with Victoria Fernandez of Crossmark, Dan Niles of Dan Niles Investment Management, David Seaford of Nomura, George Bory of Allspring Global Investments.
I'm still optimistic, actually, that we are not talking about an overvaluation. I wouldn't say that the whole market is overvalued.
We've heard about all the AI infrastructure investment, and that's continuing to drive earnings.
If you look at what's been happening in the AI stocks, we've got all the classic symptoms of a bubble. I do think it is a bubble.
Broadly speaking, the markets are holding up okay.
In situations like this,
it's always okay till it isn't okay.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The rally continues live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equities higher by a third of 1% on the S&P 500. On the Nasdaq 100 up by 0.4. Outperformance on smalls. The Russell up by 0.8. In the bond market, pretty snoozy so far this morning. Might not be at the back end of the week. 2s at 346, 10s at 4% at the back end of the week. CPI data finally released, delayed from the last few weeks. We'll get that this Friday, October 24th. And in the lead up to all of that, you'll get some earnings from GM, Netflix, Tesla, and Intel. And you'll get more of a conversation between the US and China.
Right, we're going to get more of that conversation because the Treasury Secretary is going to be sitting down with He Lifeng, his counterpart, the vice premier, before President Trump and Xi Jinping sit down. The contours of the deal or agreements, remember this truce ends November 10th, is going to be around what the president outlined last night in Air Force One. Rare earths, fentanyl, and soybeans. The issue is, Jonathan, is it going to be some grand bargain? Most people say that this story is going to continue until 2026.
Let's take rare earths. There is an argument that China made a bit of a strategic mistake by flexing its muscles around its superior refining capacity on that issue. Why? It's going to accelerate US production, one. You're going to see that anyway. And two, it may well push the Europeans closer to the Americans on this issue.
They almost already are. They are talking about the fact that they're having these discussions on the national level and the European Union level about what they need to do to combat what they're going to be calling China's weaponization of rare earths. We also got data over the weekend. China's shipments of these magnets down for a second month. So it's not just the rhetoric, it's actually happening in real time in terms of the exports.
Things might have calmed down just a bit compared to where we were, but things are still simmering going into those negotiations. Equity futures this morning firmer by a third of 1%. Coming up, we'll catch up with Victoria Fernandez across markets. Stocks are rising to begin the new trading week. Dan Niles of Niles Investment Management with key tech earnings on deck. David Seaford Nomura as we're counting down to the CPI report on Friday. We begin this hour with stocks edging higher as investors look for more rate cuts. Victoria Fernandez across markets seeing it playing out differently. She writes the following: I anticipate that fewer cuts are ahead of us than the market is expecting. Victoria joins us now for more. Victoria, welcome to the show. Let's put some numbers on that. What's the market looking for? What are you expecting?
Yeah, well, we see, Jonathan, the market's expecting 2 cuts to come in. I was actually thinking that we would only see 1 more additional cut this year, and then probably not the 2 early next year that the market is pricing in as well. A lot of that leading to the coming from the fact that I think you're going to see the balance of risk shift back a little bit towards the inflation. You and Anne-Marie were talking about the CPI number, about the 3.1%, and that the Fed trying to cut leading into higher inflation. I think when you have a lack of data, especially labor market data, which is where they were so focused, but yet you're getting inflation data saying that that's higher, perhaps that balance, that shift in the balance of risks leads them to the point where they can say, you know what, maybe we hold off here. Maybe we don't do anything because we don't know what we're doing. We are flying blind here at this point in time, and we get 1 less cut. That could be one of the reasons we might see a steeper curve and we see yields move a little bit higher, as Tom was referencing earlier.
So here's the problem, Victoria. Chairman Powell's expecting the same thing. Said in Jackson Hole, we could see higher inflation prints, essentially a one-off, but not all at once. Victoria, the message I took away from that is get ready for hot inflation prints, maybe through the remainder of this year, but this is the Federal Reserve that's going to ignore it. Why do you see it somewhat differently?
Yeah, I just don't think you can completely ignore the fact that inflation is moving higher, because I don't think it's going to be just a one-time adjustment. I do know, obviously, oil prices are coming down. There's some concerns around extra supply there. That will have downward pressure on inflation. I see that. But when you look at some of the other areas, you have service inflation moving higher. It's not just goods inflation. That's not tariff related. So if we're having non-tariff related issues drive inflation higher, and we've actually seen rents go higher. Redfin was talking about rents actually moving higher when that's supposed to be a huge component of what brings CPI down. Then I think you're going to have more pressure on that side. And if it's not tariff related, then I think the Fed has to take a different approach to how they're looking at inflation, especially if they're not getting data on the labor front, or if the economy holds up. You're looking at Atlanta Fed GDP now, 3.8% on GDP. So if you're having that strong growth, if you're having earnings and margin growth where it's expected to be 13% margin growth, then the labor market should hold up pretty well. You're also seeing monthly job break even around 30,000, according to the New York Fed. Without unemployment moving higher, I think it's going to be harder for the Fed to make a sound argument for those cuts if inflation moves higher.
Victoria, though, when we look at tariffs, do you think it is more than just a one-time shock?
I do think it's more, Anne-Marie, and it's because of the fact that it's not just in the goods sector where we're seeing that. I totally understand if we're saying all inflation is coming from goods. It's from the issues where we're going to have tariffs. That's the issue. We can look through that. But it's just not. That's not what the data is showing us. I think it's really important on this CPI number we get on Friday to dig down into the weeds and see where things are really coming from. If it continues to be on the services side, then I think you have to take a little bit of a different approach, look at it through a different lens, and say this is something that's building. It's not just one time because of tariffs.
How uncomfortable is next year going to be, though, with your case of inflation basically remaining sticky and a new regime at the Federal Reserve?
Yeah, it's interesting because when I look at what you're calling the new regime at the Federal Reserve, I really feel like the heart of that is all around banking regulation. And with what happened last week, that is going to start to shift. I know everyone said, oh, the administration is trying to get new people on there to lower rates more, to bring mortgage rates down. We know there's not a direct correlation between short rates, Fed funds, and mortgages. We know it's the longer part of the curve. I think more of what the administration was trying to do was get to where we could get banking regulation. And that's going to be a harder hill to climb now because of some of the issues we're seeing with the regional banks with private credit. So I do think there's going to be some shifting in how the Fed approaches things, but I'm not sure that it's going to make a huge difference in how they move with Fed funds.
You mentioned the banks. Let's stay on the banks. So we had a bounce back on Friday. And for those of you just joining us this morning, good morning to you. We've got a bounce back again this morning. Zion up by 1.8%, Western Alliance advancing as well. What we know so far, Victoria, some isolated issues, possibly. And I put the emphasis on possibly. Tricolour, First Brands, and some fraud-related issues revealed by the likes of Zion and Western Alliance in the last week or so. Victoria, is that building up to anything? What's the common thread between all of that, if there is one?
Yeah, we're not seeing, I don't think at this point in time, this huge thread that's tying that all together. It does seem, and I'm not going to use that other I word that I know you don't like, Jonathan, but it does seem like it's more kind of one-off for some of these companies. And they're smaller in the sense that, it was less than 1% of the assets for Zion. So it's not a huge credit issue that is going to build into a financial crisis that we see typically before a recession. We've liked big banks for a long time. And one of our reasons is because the strength of the balance sheets are stronger because a lot of the riskier debt was moving to private credit. So I think we have to watch private credit, see what's happening in that element, and if we see defaults go up. But expectations for defaults are not rising significantly right now. That's something we need to watch. And credit spreads, did they widen out a little bit last week? Yes. But guess what? At the end of last week, we were right back to where we were about a month ago on investment grade credit. So I don't think we're getting warning signals right now that it's a broader issue. Credit, I think, is where we have to really watch, look at those spreads and see what happens there.
Victoria, just from the outside looking in, if I was a layperson away from all of this and had no idea what anyone was talking about, and then I listened to this story and how it's played out in the last week, I get that people are saying it's in private credit and these are issues for other people, but I'm hearing this and seeing it in the banks. I'm seeing it from JP Morgan themselves. I know it's not a big issue in terms of how big their balance sheet is. It's nothing compared to what they were talking about just last week. But Victoria, are we overlooking the potential that if it's one place that we're all exposed to it?
Well, I do think we're overlooking some of the flags that have been waving, and we've been talking about that for months. We've had these conversations with you guys. We've had them with our clients. There are little elements that we have to watch. You can't just ignore them all and say, great, it's a risk on market. Everything's great. Earnings are great. Let's just move on. This is what we're calling a high risk bull market. And it's because of these elements you're talking about. You have to pay attention to these. They have to be something that you watch. Right now, it's not telling us we have to have huge concerns, that we need to do huge shifts in our portfolio, but it is definitely something you cannot ignore. You have to watch it and see if you start to see signs that tell you there are bigger things ahead.
Idiosyncratic. I said it for you, Victoria.
I wasn't going to use the word, Jonathan.
I said it for you. I've never liked that word.
I thought maybe you're thinking institutional.
No, idiosyncratic. When enough people say the same word again and again and again, it kind of undermines the definition of the word. Right? One-off. Right. How many times are people coming on the programme saying it's a one-off? One-off issues quickly pile up to become one big issue.
Right, and then it's multiple one-offs, and then it's actually one huge snowball. I hear you.
Victoria, thank you. It's good to see you. You didn't use it. Victoria Fernandez across Smart Global Investments. Thank you very much. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Let's cross over to Yahara Anand for more. Hey, Yahara.
Hi, John. Amazon Web Services says most of its operations are succeeding normally after a widespread outage. The disruption from the world's largest cloud provider impacted a range of services, including AI companies, government agencies, and financial platforms. AWS identified a problem with a regional gateway on the U.S. East Coast that caused the issue. Meanwhile, President Donald Trump has announced plans to meet with Russian President Putin in Budapest in the coming weeks to discuss an end to the war in Ukraine. Ukraine's President Zelensky is expressing caution, though, over the venue due to Hungarian Prime Minister Viktor Orban's Russia-friendly stance. Zelensky says he'd still consider an invitation to Budapest if it's in a formal setting where the three leaders can meet. And the Los Angeles Dodgers are heading back to the World Series after sweeping the Brewers thanks to Shohei Ohtani's historic Game 4 on Friday night. Meanwhile, the ALCS shifts to a winner-take-all Game 7 after the Blue Jays defeated the Mariners 6-2 on Sunday. That series will conclude tonight in Toronto to decide who faces the Dodgers in the World Series. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. What that guy is doing,
Ohtani.
It's insane.
He's unbelievable. He's unbelievable. I want the Yankees to bring him over.
I'm trying to communicate this to the Europeans, what it would be the equivalent of when it comes to, say, European football. It's like being both Gianluigi Buffon and Lionel Messi at the same time.
At the same time. It's unheard of. Honestly, it's unheard of.
Incredible. Up next on the programme, the Morning Calls Plus, Dan Niles of Niles Investment Management, as we look ahead to key tech earnings. That conversation just around the corner from New York City this morning. Good morning.
Right now, if there's any slippage in earnings from the tech guys, I think you're going to see a more wobbly, more volatile market, because with the lack of data and with the assumption that the Fed's going to cut at the end of this month, I think that right now that is not as much of an open question. But if you see anything in the earnings, or if you see any concern in the earnings on the tech side, or a slowdown meaningfully somewhere, then I think people really start to worry.
Typically, the big data point of any given month is the payrolls report. Well, you're not getting that. It's not CPI. Arguably, the biggest data point this month for the economy and for the stock market is the earnings from major tech players later on over the next few weeks.
And for whether or not the high-end consumers can continue spending. Let's see. Everyone keeps saying what the mega cap tech companies have to say when it comes to earnings. It feels like everything is hinging on these earnings reports, and especially now, given that we're in this data desert from the U.S. government.
Equity futures positive here by 0.3%. The Nasdaq up by 0.4%. Outperformance on small caps. The Russell up by 0.8%. That's the price action into the opening bell. 1 hour and about 14 minutes away. Let's get you some morning calls. First up, William Blair initiating coverage on USA Rare Earth with an outperform, believing the company may get a sizable investment from guess who? The US government. That stock is up by close to 9%. Your second call from TD Cowen upgrading Ally Financial to buy, highlighting its credit and margin strength. And finally, Loop Capital upgrading Apple to buy with a street high target of $315, seeing a material upside for iPhone estimates. Let's stick with Apple. The 17 appears to be reinvigorating its upgrade cycle. According to Counterpoint Research, the new model has outsold its predecessor by 14% in its first 10 days in the US and China. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, it looks like some better news for the iPhone and for Apple.
Yeah, look, I think China has always been a big market for Apple, and this refresh cycle probably is going to be no different. And the way to think about it is, like, for someone like NVIDIA, they have completely de-risked from China. It reflects in their guide. In the case of Apple, because they are so deeply integrated in terms of the supply chain, in terms of the jobs for the Chinese market, that it's very unlikely that, they will be completely banned or prevented from selling into the China market. So from that perspective, I think it makes sense that you are seeing a refresh cycle there.
And Mandeep, is it the start of the upgrade super cycle that Dan Ives of Wedbush has been waiting for so many years?
Not yet. We don't think so, simply because Apple doesn't have, a good large language model strategy. Neither do their chips can run these models on device. Until that happens, they are behind Android ecosystem. That's where, the Google Pixel devices, even though they don't have a lot of market share, they do very well in terms of the capabilities, because at least you've got, a native LLM that's running some of the functionality. So Apple needs that.
Better news for that company. Mandeep, appreciate your time. Mandeep Singh there of Bloomberg Intelligence. Apple up by 1.4% in the pre-market. Let's stick with tech. Investors looking ahead to Mag 7 earnings, with Tesla kicking things off on Wednesday. Dan Niles of Niles Investment Management writing, the higher the AI bubble takes stock valuations, the more painful the decline is going to be for investors on the other side. Dan joins us now for more. Dan, good morning, sir, and thanks for making time for us. We appreciate it. Let's just think about how you see valuations currently and whether we risk undermining those valuations with the earnings we'll receive in the next few weeks.
Valuations are high, no matter how you want to look at it. Price to sales on the S&P 500 is above the 2000 bubble peak. Market cap to GDP, which is Warren Buffett's favorites, is above the 2000 peak. I don't think it matters. I think you're going to see valuations extend further. I'm very bullish. I think the market goes to new highs before Thanksgiving. There's one simple reason for it. It's easy money. The Fed's going to cut. I think, Jonathan, you had it right in a prior segment where you said the Fed's going to look at any inflation data, say it's transitory. They've convinced themselves it's that way, just like they did in 2021. And they're going to cut at least twice this year, potentially another couple of times next year. And then don't forget, you're going to get a new Fed chairman in May. President Trump's going to appoint him, and that chairman's going to want rates even much lower than where the current trajectory is. So unfortunately, and I say unfortunately because I think this bubble could inflate a lot higher, the fall on the other side of that is going to be vicious, much like we saw in 2000. But right now, you got to be bullish and try to take advantage of this, because you don't know how much higher than this can get. Much like Alan Greenspan famously said, irrational exuberance in 1996, the S&P then doubled over the next 4 years before it finally broke. I think you have to look at it the same way this time.
Dan, you touched on something important, and I do wonder to what extent it's still underappreciated, just how easy money could be next year. There's a massive focus on financial conditions now. I understand why. But do you think people are still struggling to appreciate just what 2026 is going to bring?
Absolutely. And this is the reason. Think about it this way. If I told you, hey, Jonathan, we're going to get a global pandemic, your first thought isn't to rush out and buy stocks. Well, that's exactly what you should have done, because the S&P finished the year up 14%. But why? It's because you jammed up into the U.S. economy about half of GDP between what the Fed did and the U.S. government did in about 2 years. Money supply was up 25% year over year. And to put it into perspective, during the Richard Nixon era of high inflation in the 70s, money supply's fastest growth was up 12% year over year. So I think that's what's going to happen. And that's why I look at the valuations and I go, they're just going to keep extending, because you can find some measures where the market doesn't look as expensive. You can look at PE measures or free cash flow. But, the top level things that I tend to look at and go, well, companies are over earning right now, probably. There's no way you can't come to the conclusion all metrics are extended. It's just some are more extended than others. But as we've seen in the past, it just doesn't matter when there's a ton of money coming into the markets. And don't forget, the Fed's probably going to quit quantitative tightening as well at the end of this month because of some of the credit issues you rightly brought up, such as First Brands and Tricolor, et cetera. They're going to quit the tightening. that's going to act like another rate cut in some ways on top of the 25 we all know we're going to get.
So, Dan, let's go with the credit issues as well. And let's pair that with the period coming out of the pandemic and through the pandemic too. This was something we were talking about. Lots of money flushed into the system. Fiscal policy was easy. Monetary policy was excessively easy. And confidence in markets was sky high. And as you often hear from credit investors, the worst of loans made in the best of times. Now they're starting to worry that maybe we're seeing the consequences of that period in Tricolor, in First Brands. And people get nervous. There's always something to worry about in markets. Dan, you know that. People get nervous. There's more to come. What would you say to them this morning?
Well, here's the thing. You look at how Jefferies has acted, which had exposure to it. It's obviously, stressful, but they have $69 billion in assets. You look at what Western Alliance or Zion said about fraud that they were involved with, obviously stressful, but that's $180 billion in assets. But look at the banks last week. The 4 biggest banks in the U.S. reported. You also have the 2 biggest investment banks report. Between them, there's $11 trillion in assets. They all talked about the fact that, things look pretty good to them. Yes, when there's one cockroach, there might be more, as CEO of JP Morgan said, but you're always going to have some defaults. That's what happens. But the question is, are you properly diversifying your portfolio so you're not getting impacted by them? And the 4 biggest investment banks and the two largest investment banks, 4 biggest banks in the U.S., you didn't see anything really out of the ordinary that you'd expect. So that's why I think you're going to look back and say there's more coming, but there's always some bad loans made during cycles.
Dan, if we go back to AI for a moment, when do you think it'll be the time when the revenues will not be enough and you can see potentially that hit to individuals that are bullish on these stocks as potentially these companies do not have the revenue or the capex left to continue spending?
Well, it's not a question of when, it's when do investors care? Because you could argue we're there already, right? If you look at capex for the biggest hyperscalers, the 5 biggest out there, over the past 3 calendar years, including this one, they will have spent about $800 billion in capex. Just this year alone, it'll be a little bit over $400 billion, up 60% year over year. In terms of AI native revenues, so companies that don't have other businesses but just focus on AI, the cumulative revenues this year will be $20 billion. Now, if you look at OpenAI in particular, they're 13 out of that 20 billion. And they're expected to lose $8.5 billion in cash burn this year. So you're already at a point where you could consider it problematic, but much like in the late 1990s, people aren't going to care until there's an issue. And something like what we've seen with Tricolor or First Brands, you see that with some of these data centers that are highly leveraged. You haven't gotten there yet because the cash flow at these big hyperscalers is still very strong. And so they can still afford to invest, trying to get to this, artificial generalized intelligence, which is, kind of the holy grail, which everyone wants to get to. But until the stock market starts to punish you, you're not going to see it. And with the Fed doing what it's doing and us getting a hyper, dovish Fed chairman, it's probably not going to get there for a while. I think by the end of next year, that's when you're going to run into a problem because the rate cuts will all be done. You're going to then have to justify these massive cash burns. And I think that's when things are going to be interesting.
Dan, appreciate it. Dan Niles of Niles Management. At the opening bout this Monday morning, 60 minutes away. Equity futures on the S&P 500 firm up by 0.3%. On the Nasdaq up by 0.4%. Some big outperformance on the Russell. Small caps up by 0.9%. Going into the cash open. With just an hour to go until your opening bell, let's get you some morning movers with your single names. Here's Yohara with more. Hey, Yohara.
Hi, John. Cleveland-Cliffs posted a solid earnings beat this morning, but it was its comments on rare earth minerals that stole the spotlight and is sending shares up 10% in the pre-market. Cleveland-Cliffs says it's exploring mining rare earth minerals from its iron ore deposits. And with the Trump administration, of course, taking stakes in these rare earth companies and vowing to protect the sector, it is no surprise investors are pushing up the stock. this morning. Meanwhile, moving on to Sable Offshore, also jumping 12% in the pre-market after U.S. Energy Secretary Chris Wright showed support on X for the company's California oil project. The company has been stuck in waiting mode on state approval to reopen pipelines off the Santa Barbara coast. Analysts say that the federal backing provides confidence that the project could start up in late 2026. And a check on Boeing shares, they are up 1.4% on our reporting that the FAA has approved a boost in their 737 production to 42 jets a month. The increase could start as soon as November, and with plans to eventually hit 47. Of course, the production boost is key for Boeing's comeback and in its rivalry against Airbus, whose aircraft has been selling fast. John?
Yahara, thank you. Just to touch on the energy story. You know, energy and mining CEOs are the original corporate diplomats, not the tech players of the moment, which is why Rex Tillerson was such an inspired choice all those years ago to become the Secretary of State. But this has moved on to a different phase. The amount of integration we might see between the White House and that space in the years to come, wow, are we seeing results already?
Yeah, it's unbelievable. I've also spoken to sources in Washington that tell you, yes, expect more of these outright equity stakes because they feel like they are too far behind when it comes to China, and they think this is the best way to get a handle and a grip on the fact that the United States really doesn't have access to the rare earths. And as China's going to use them and control them and not allow the exports of these magnets, you have a huge problem. Forget your iPhone. You have a huge problem in the defense sector.
We've joked about this. It's like a list of names.
Yeah.
Everyone's got them, just waiting for that big move in one of them to get bought out or at least invested in by the US government.
I mean, look at William Blair today. They put one of them as a new buy rating in anticipation of this looks like a company the US president would like to take an equity stake in. It shot up to double digits pre-market.
Big moves in the pre-market on that name. Equity futures more broadly doing okay, up a third of 1% as we count you down to inflation data out later this week. Delayed CPI because of the government shutdown. Bloomberg's Ender Curran joins us now for more. And just briefly explain what's special about this. Why are we getting this and not payrolls?
It's due to the cost of living adjustment calculations that are made around this time of year, Jonathan. So the BLS staff have had to come back in and make sure the data is released. That's the practical, mechanical side of it. Of course, it's also a critical piece of the jigsaw for the Fed too.
And how difficult is it to collect this data when the government is shut down?
I think it's going to put a lot of scrutiny. It is difficult to collect it, number one, Jonathan. But number two, it kind of adds to the overall sense of scrutiny on the collection methodology behind some of the key data inputs at the moment. And not just for the period where the government is shut down, but also the catch-up period when the government comes back to work and how they meld all of this together. A lot of economists are worried that the data sets we get now, both say on the critical components of jobs and inflation, will kind of be out of whack for a little while. But nonetheless, all that said, when we get these numbers Friday, there will be a lot of focus both on services, what are the costs of shelter, how is that changing in either direction, what's going on with airline fares, and then, of course, what's happening on the good side, any hint of feed-through from tariffs. So there's going to be a lot to break down when these numbers come out on Friday.
And isn't it strange that this will be the one official data point the government does have, can provide us, and the Federal Reserve will sit around the table next Tuesday for 2 days, conclude the meeting on Wednesday, probably cut interest rates, and maybe with inflation with a 3 handle and no jobs report?
Look, it's very odd, John. There's no other way of saying it. To your point, the Fed have signalled very publicly what they're sort of on track to do, so the markets expect that rate cut next week regardless. But if these numbers on Friday come in, adding to the idea that, look, there's still persistent inflation out there, it's not all about, as we know, it's not all about the tariff story. Look what's happening in services. If core inflation still remains around with a 3 handle well above the Fed's target, then okay, the Fed cuts in October, but there are some economists asking what happens in December and then what happens in 2026. So if these numbers come in, on the high side, it will certainly complicate the Fed story going forward. If they come in on the low and the benign side, then you would have to say it probably gives a green light for the Fed to keep going the way they are.
And great work as always. We'll be following you this week. Ender Curran there of Bloomberg down in Washington, D.C. Let's stick with the data. David Seif of Nomura, looking ahead to Friday's print, he writes the following. We see an acceleration in the core goods inflation due to tariff-induced price pressures and a mild deceleration in core services. David joins us now for more. David, good morning.
Good morning.
Bit of give and take there.
Yes.
Yeah, let's start with the services prices inflation.
Yes.
Why are we going to see that roll over just a touch?
Yeah, so we should divide services into housing services and let's just say everything else. So housing services were a little bit unexpectedly hot last month. No reason to expect that to continue. So we see housing price inflation gradually getting better, and that should start this month or with this Friday's print. So no reason to think otherwise on that. Now, if you look at everything else that's in core services, that's what we would call super core. And that does seem to be ticking up a little bit. Number of things going into that, but it is really, I would say, overall, a broad-based set of services inflation there outside of housing.
When it comes to the actual data collection, these individuals weren't deemed essential at the start of the government shutdown. They were brought back because of the issues Enda was talking about when it comes to cost of living. Are you worried that the data is going to be murky?
Certainly seems as though there's a risk of what the data quality will be. I think that this coming CPI report, this one on Friday, is likely to be one of the better ones. These individuals were not actually on furlough for all that long, so they're not that far behind schedule. I think what's going to be more worrisome is next month, or whenever the shutdown ends, as people come back to the BLS and start to do work, they're going to have to go and survey people about what their job status was at some point in the past. And people are not terribly great at giving answers about what's going on right now, and they're even worse about it when asking about things that happened in the past. So we're through the survey week for what should have been the early November jobs report. And so already, even if the shutdown were to end today and people were to come back tomorrow, they're already going to have to ask about stuff that happened retroactively. And given that it seems as though the shutdown could continue for a couple more weeks, it will be that much further in the past that people will be asked about.
So it almost feels like this decision for the Fed to cut interest rates is going to be easier, say, one at the end of the year.
Yeah, so this one, it's hard to see what justification they would have for deviating from the dot plot, barring a major surprise in this Friday's CPI report. But the big thing that drove them, we think, to this more dovish shift has been the deceleration or the loss of momentum in the jobs market. And of course, they won't have any real data on that going into this meeting. So we see that as something that's likely to happen. We expect there to be another cut in December as well, but I do think it's a little bit more of a question mark. And if you look at the, I would say, enormous variation within Fed speak that has occurred since the September meeting, you definitely see a lot of sort of the more hawkish members of the Fed starting to push back, starting to say, okay, fine, we concede the October cut, but we really think we should be much more careful about future cuts.
Why do they feel more emboldened?
Well, I'm not even sure that they feel more emboldened, perhaps. I think it's just that they sort of had the what was it, the tablecloth yanked from under them, so to speak, at the September meeting. It was a pretty unexpectedly dovish shift in the Fed. Not such a surprise that they cut rates at all, and not even such a surprise that they were signaling some additional rate cuts. But the big surprise was that they did all that while upgrading all of their economic forecasts and increasing their inflation expectations. So you had a shift in their data expectations that were entirely hawkish, and yet a shift in their rate expectations, which was entirely dovish. And I think that really is something that the hawks are fighting back against.
I sat in this seat as those numbers came out and thought exactly the same thing. It was strange. I also think it's strange the way Chairman Powell communicated at the end of August to essentially tell everyone they can ignore hot inflation prints, and potentially for a long period of time. The argument coming from the chairman at the moment is transitory just without the word. When he says we could see inflation pick up, but it'll be a one-off and not all at once, that's basically telling people that anything between now and maybe through year end, if you get higher inflation prints, you can ignore it. Do you think that's a mistake?
I think we should be very careful about cutting into higher inflation. I do think, though, that this is consistent with how Powell has been in his almost 8 years as Fed chair. I don't think this has much to do with political pressure or anything like that from the Trump administration. We have seen Powell tack dovishly repeatedly throughout his time as Fed chair when there are relatively small hiccups in the data. This time it's in the inflation data. And oftentimes he's been proven right. This time we think maybe some caution is warranted, I would say.
Why is this time different?
Well, this time we don't really see inflation momentum moving back down to 2% in a clear and compelling way. And that's actually a stark contrast from a year ago, and it's a contrast to, say, pre-COVID. Both of those times inflation was either at or near target, or at least appeared to be moving back towards target. Here, inflation still seems to be coming in with prints that are well above the 2% target.
Can you see the next regime post-Powell actually looking to target just a target 2 to 3% and not actually try to get inflation back down to 2%?
Oh, absolutely. I mean, we've seen some of the more dovish people on the Fed, Myron, Bowman, Waller, all talk about the idea that an explicit 2% inflation target may not be the way to go. And that actually isn't super crazy in terms of what the Fed has historically done. That's really what the Fed did until post-GFC, when under the Bernanke Fed, it was changed to an explicit 2% target. And the reason for that was to make it clear to people that the Fed was not going to be happy with inflation well below 2%. And so it was really to try to move inflation expectations up. The question is it time to retire that mentality? We're certainly not in that world right now where we're flirting with deflation or anything like that.
Aren't they operating as if they don't have a 2% inflation target anyway?
It's certainly a thing one could say, given the September shift. Inflation is above target. It doesn't appear that it's going to get back there in 2026. Growth looks to be close to at trend and accelerating. And you put all that together, and when they come out with a dovish shift in the face of all that, it does make it seem as though they are more tolerant of above 2% inflation than before.
What is different? What's changed about this economy that makes it harder to get inflation back down to 2%? When we used to have the opposite problem?
Yeah, I don't think it's a long-term change. I think that we are still dealing with the maybe last bit of the hangover from the post-COVID period. I think we were well on track to get there in 2026. I think also that the tariffs are probably going to add a little bit to inflation, less perhaps than some of the big fears, and not in a way that would necessarily lead to anything like what we had post-COVID. But there's a difference between saying it won't be as bad as feared and saying it will be zero. We still think there's something there.
David, it's good to see you.
Always a pleasure.
Here. We'll be looking for that something when the data comes out on Friday. David Seif there of Nomura. Equity futures on the S&P positive by 0.4% with an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump has shared some of his top demands from China ahead of further trade talks. Rare earths, fentanyl, and soybeans are all listed as top issues. The U.S. and China will hold talks later this week in Malaysia with the fragile trade truce between the two countries set to expire on November 10th. Meanwhile, EU energy ministers have agreed to a joint position to ban all gas supplies from Russia by the end of 2027. Hungary and Slovakia did not support the ban despite ongoing pressure from the U.S. The bloc aims to reach a final deal before the end of the year. And another NFL Sunday is in the books. The Denver Broncos pulled off a stunning win, erasing a 19-point fourth quarter deficit to defeat the Giants 33-32. Elsewhere, the Patriots won their fourth straight game, while the Eagles got their offense rolling in a win over the Vikings. And in primetime, the San Francisco 49ers grounded out a 20-10 victory over the Falcons. That's your Bloomberg brief. John?
The Jets are so bad they don't even exist in the news wrap anymore.
I know. The producers are like, it's not even worth putting them in. I'm so sorry, Mohamed El-Arian, because he was at the game, the poor guy.
If you're watching this morning, Mohamed, I don't feel your pain because I don't support the Jets, but it's unfortunate. Let's put it that way. Up next on the programme, setting you up for the day ahead, plus George Bory of Allspring Global Investments. That conversation up next.
This is probably my unpopular opinion, but I have to say I'm not sure that Fed rate cuts really mean a huge amount for the economy. Financial conditions aren't pulling back or easing as much as many people might think just by looking at the Fed funds, whereas obviously equity stocks are having a much bigger impact on overall financial conditions in that first phase of pass-through.
The wealth effect, helping upper-income Americans keep spending. We've got this strange gap between employment, huge step down, and retail sales, which have been pretty punchy, still coming out of summer. Equity futures on the S&P going into the opening bow firmer by 0.4% on the S&P 500. On the Nasdaq, up by 0.5. On the Russell, small caps up by 1. full percentage point. That's the price action as we count you down to the opening bow. The rest of the trading week shaping up as follows. Later on today, the president meeting with the Australian Prime Minister at the White House. Look out for that. China very much in focus. On Tuesday, earnings from Netflix and GM. Wednesday, Tesla and IBM. On Thursday, more earnings from Intel and Ford. And then on Friday, the main data point of the week, CPI data just around the corner, and going into the weekend, you'll get UMich, consumer sentiment. Let's stick with the data. George Bory of Allspring Global Investments writing the following. We expect the Fed to cut rates further, but the pace may be slow and measured, reflecting ongoing inflationary pressures. George joins us now for more. George, good morning.
Good morning, John.
Building on the previous conversation, where are those ongoing inflationary pressures coming from? What's the source?
Yeah, I mean, the source, I think, is pretty clear. We're seeing sort of small movements of prices moving up kind of continuously. It's not one broad-based movement, but sort of little flares coming up. That companies are trying to push prices through where possible, where you have good demand. You mentioned, that's the K-shaped economy, if you will, allows pricing pressure in premium goods, in high demand products, in certain commodities. But at the lower end of the spectrum, you're not seeing any price pressure. And so on average, prices are moving up, but they're moving up mildly. I think that's what the bond market sees. That's what the bond market is kind of looking through. And the expectation is that pricing power is not going to persist, that you've got a couple more months for this to run. But perhaps we've already crested and you're likely to start seeing that come down once we get into the new year.
That's goods inflation. Is there a services offset playing out here?
Yeah, again, I think there's a two-tiered component on services as well. Where there's pricing power, demand at the upper end of the economy or the upper end of the income spectrum is very strong. Demand for, tech services, for AI equipment, for where follow the money. It's very simple. Like, where are people making money, and then where are people spending money? And there's good, strong pricing power there, but you move one shade away and the pricing power fades pretty quickly. So, there is this kind of upward drift on average, but we know that it's not consistent. It's not universally spread across the whole market. And you're seeing some of that bubble up. Some of the credit concerns that we're seeing in the bond market, are because certain parts, maybe you've lost some pricing power because your client base doesn't have the spending power that's necessary to keep pace with some of these broad-based inflation fears.
Will the Fed rate cuts help those individuals?
Yeah, that's a great question and a great point. Not necessarily, at least not yet. As we've seen, the long lead time, the variables are pretty long and drawn out at this point. And so on the margin, does easier monetary policy help growth over time? Yes, it does. I think that's pretty well established. However, is it going to suddenly create sort of a spark in job creation? Probably not. That will take time, much more time than perhaps, monetary policy will actually kind of drive. We know there's limitations to monetary policy, and the connect between rate cuts and job creation, that part is a little loose, to say the least.
The Fed is also somewhat flying blind. They're going to have CPI, but they're not going to have the labor data.
Right.
How has that made your job difficult?
It does make our job difficult. The Fed, we follow the same data that's released that the Fed follows, but the Fed has tremendous resources to be able to kind of try to monitor the economy in real time. We don't have that advantage, and there's sort of private sector data that we can tap into. There's survey data that we can tap into. So we can have a pretty good feel for the general level, but the granularity is harder to come by, and the longer the government shutdown lasts, the harder it gets. So then you have to pull in the reins from a risk-taking perspective, because you have to build a wider margin of error. Directionally, the economy does seem to be slowing, decelerating, but not collapsing. So we feel good about that. John's question about inflation, very, very pertinent. And it's difficult to tell with precision exactly where inflation is. We think it's mildly moving up, but we want the data. We want the granularity to be able to say with a certain degree of confidence, how much is it going up? Maybe where is the cresting point? And then importantly, how does that distribute through the economy? It's challenging to do that with a lot of precision right now.
Let's tap into this bond market. So yields have dropped, fallen across the curve. 2s are down to 350, sub 350 now. 10s around 4%, 399 so far this morning. the extra reason to buy bonds in the last week, worries about a turn in the credit cycle.
Yeah.
Do you share the concerns?
So we share some concerns. Obviously there's been a lot of talk about some very, high-level defaults. When a $20 billion company defaults, that's concerning. And that does draw a lot of attention. It's scary, and it should be scary. However, when we sort of continue to dig into as much detail and data as is available, it does sort of look to be somewhat contained in the sense that it's idiosyncratic, it's company specific. There are certain elements of over leveraging that's occurred. The credit cycle itself, it's a very straightforward kind of pattern. Kind of money rushes in, it gets lent, and then somebody along the way kind of stumbles. And then the question is it a whole group stumble, or is it just one individual? Or does one individual fall and then everyone falls over that person? Right now, it still looks like it's one person that's fallen, but we know that there's been explosive growth in private credit. There's been very robust issuance, even in the public market as well. And so borrowing, the wheels of credit are turning. They're turning pretty quickly and pretty smoothly. And that in and of itself has helped the economy. And so it doesn't look like that's slowing down. Maybe it's slowing down a bit, but it doesn't seem to be stopping at all.
Can I just ask you a question, how you draw a distinction between one or the other? Something that's idiosyncratic and something that's broadly more problematic?
Yeah, no, that's a very good question. And when you have a series of uncorrelated events happening at the same time, they in and of themselves can cause, sort of concern, because the collective view is that we need to then pull back kind of risk-taking, and then that starts a bit of a domino effect. There's maybe a mini element of that happening right now, but it does seem to be on the margin. And I think you have two very strong things going for you. They're macro. One is the Fed. We just talked about it. The Fed's cutting rates. That tends to help financial markets more broadly. And then really importantly is that profitability is still strong, up and down the corporate sector. And that in and of itself is a major driver for what kind of keeps cycles rolling. So you can absorb a fair number of stumbles along the way, even if they happen in close sequence. But when you have sort of this this tailwind behind you, it is a little bit more difficult to sort of broadly kind of spread and go from what's idiosyncratic to systemic. What I think's between those two is a correction. And I think that's where we are. It's like a credit cycle correction. These are big defaults. They're in very notable names that are like right at the precision middle of the credit cycle.
Yep.
But it's also, there's like a cascading effect where lenders are now scouring their portfolios. Like, how much factoring do we have in the portfolio? Who are we lending to?
Journalists trying to work out the same thing.
Yes, exactly. And so,
scary headlines from Jamie Dimon. George, I'm up against the clock, but this was fantastic. A clinic.
Thank you for having me on.
Thank you, sir. Appreciate it. George Bory of Allspring Global Investments from New York City this morning. Good morning. We'll see you tomorrow morning.
metal is having a moment. Not this kind, though, sadly.
Gold hits another record.
Spot gold prices have climbed above $4,000 an ounce for the first time.
The key word is scared.
During times of economic and political and financial turbulence, you buy the dollar, you buy US Treasuries, you seek safety.
Not so much now. Now you buy gold.
What we're seeing at the moment is not like anything really that we've seen over the last couple of decades.
In October, gold extended its already furious run from last year and showed few signs of abating.
This gold rally really looks unstoppable at this time.
Excitement is evident online, on shopping streets and in capital markets.
Just gold, gold, gold the whole time.
Chinese mining company Zijin Gold recently raised $3.2 billion in one of the year's biggest IPOs. But it's not just a gold rally. Look at silver. In October, it reached its highest price per ounce in more than 4 decades.
I think it is a warning sign that people are very anxious.
Gold is the ultimate safe haven asset, a heart rate monitor, if you will, the health of the global financial system.
And because of that, when you see a spike in the gold price, your first question should really be what's gone wrong.
Gold is the ultimate precious metal. It's been around since the beginning of time. Gold has seen it all and has survived through it all, and it probably will continue to do so.
Because it's reliable, easy to trade, and high value, despite lacking the intrinsic utility of a semiconductor or shipping container full of these things.
Gold has outperformed equities, it's outperformed almost every other asset class if you take your starting point at 2000.
It is the one asset that does very well when the typical parts of your portfolio go down.
It breached $1,000 during the global financial crisis, $2,000 during COVID, and $3,000 after the Trump administration's tariff announcements, which perhaps was a wake-up call.
The dollar for many, many years has been seen as the haven of the market because people trust the U.S. government and they trust dollar assets.
Welcome to 2025.
The dollar is the single biggest decline in 6 months in 50 years. Gold is at record highs.
And here's what that looks like. This gold line, because why would it be any other color, shows how much the metal has increased in value since January. The green line shows the dollar's depreciation over the same period. That discrepancy reflects what's called the debasement trade.
It is the idea that faith and trust in the dollar is no longer what it once was, so you have investors looking at other assets.
People do that trade when they are losing their confidence in traditional government bonds and fiat currencies.
And in that situation, gold becomes quite appealing because there is no counterparty. It's just you and your gold.
It's independent from the government's influence as well.
Which is no longer something investors automatically say about the dollar or the US central bank.
So the Federal Reserve has long been seen as kind of a bulwark of global financial stability. It has cherished independence from the political system in the US. Now the pressure on the Fed from the White House and President Trump has thrown that whole dynamic into question.
Am I allowed to appoint myself at the Fed? I do a much better job than these people.
How sustainable is the Fed's position, given the position that President Trump is taking and given the pressure he's putting on the Fed to lower interest rates?
If the Fed is slashing interest rates all the time,
that makes gold more appealing because unlike cash, it doesn't actually obviously yield interest. And so when interest rates are lower, gold becomes relatively more appealing. But on the other hand, you have inflation that makes gold appealing as a hedge.
And inflation's back on investors' minds as Trump's tariffs risk driving prices higher around the world.
So that's kind of a heads I win, tails you lose scenario for gold.
Over the summer, the dollar fell to its weakest level in more than 3 years.
While there are different views on what's behind that weakness, the takeaway is that the US isn't seen as the trusted ally it once was.
But to find the source of gold's rally, we need to look back further than Trump's second term. A pivotal moment for the metal was in 2022, after Russia's full-scale invasion of Ukraine.
G7 countries froze the assets of the Russian central bank that were held in Europe.
That caused many countries around the world to think we need to diversify away from the dollar in order to shield ourselves against potential or future US sanctions, or at least getting caught up in the dragnet of those.
And by countries, we're talking central banks, which have been steadily adding to their gold reserves. In the early 2000s, they were selling a few hundred tons into the market every year.
They've flipped that now. They're buying about 1,000 tons a year.
And for the third year in a row in 2024, according to the World Gold Council. China, India, Poland and the Czech Republic have been among the biggest buyers.
China in particular has been probably the most important central bank buying gold over the last couple of years. It's the biggest consumer of gold in the world, it's the biggest producer of gold in the world. Really, gold is a China story.
People's Bank of China is trying to create, or at least help to facilitate, a world that's less dependent on the dollar. And one way of doing that for the PBOC is to reduce holdings of the dollar, such as the US Treasuries, and buy gold instead.
But halfway through the 20th century, the dollar became the world's reserve currency. If you want oil, you use dollars. If you want gold, you use dollars. If you want to exchange currencies, often the dollar sits in the middle of that transaction.
Even most of China's exports are settled in the dollar rather than the yuan.
The dollar made up nearly 3/4 of the world's foreign exchange reserves in 2000, but its share has been slipping since then. Pressure on the Fed, with tariffs, inflation and sanctions in mind, it's prompted trading partners to look at the US and its currency in a different light.
People are concerned with geopolitical tensions, with trade conflicts, and Trump's chaotic tariff policies.
And again feeds the idea that why is the world settling trade in dollars? What alternatives do we have?
Demand for gold's also been boosted by gold-backed exchange-traded funds, or ETFs, which let investors bet on the metal's price without ever holding any.
Maybe they don't have access to buy gold bars or to buy physical gold, but they have this access to ETFs.
September was the biggest month of inflows that we've seen in more than 3 years.
We saw that ETF inflows were 6 times larger than what a rates-based model predicts.
And remember, this trend doesn't just concern the precious metal King Midas once mistakenly transformed a daughter into. Although he shouldn't be that upset, she'd be worth a fortune right now.
Platinum and silver this year have rallied a lot more than gold.
Now there's a nuance that can get lost in the discussion about precious metals other than gold.
They're also useful. They're used in industry, they have real sources of demand. So those markets function a little bit differently than gold, but they tend to do really well when gold does well. It's partly about this debasement theme where people are worried about the ability of many developed economies to pay back their sovereign debts. And because of that, they're looking to other precious metals like platinum, like silver, and they're looking to cryptocurrencies.
Gold and to some degree Bitcoin, they are ways to express an opinion that the system itself is going to have some problems.
When it comes to haven assets, the gold standard remains, well, you know.
This gold rally speaks to the times we are living in.
Not everyone's convinced currencies and bonds are so easily replaceable. A major de-escalation of Trump's tariffs or a peace deal between Russia and Ukraine could also spur a price decline. Volatility is very much still in gold's fine print. Still, Goldman Sachs and Deutsche Bank both say they expect gains to continue for now.
With any rally, it naturally makes people worried. Is this a bubble? Is this going to pop soon? One thing it does have going for it is that the secular trends that have been supporting it over the last few years are still very much there.
It's clearly a very fragile geopolitical moment. Old alliances are being tested, new alliances are being formed, and I think as long as these really steep tensions do persist, then that clamour for safe haven assets such as gold is going to continue.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. The gold rout easing after suffering its biggest intraday drop in more than 12 years, while Asian stocks fall as the equity rally on Wall Street shows signs of fatigue. Donald Trump says his meeting with Chinese President Xi Jinping may not happen as the trade deal deadline approaches. The US president also casting doubt on a second meeting with Vladimir Putin. Plus, L'Oreal reports disappointing sales growth, citing weakness in the US. We'll bring you UniCredit and Heineken earnings next. A very good morning. We kick off the programme with earnings out of Amsterdam from the Dutch brewer Heineken, of course. They say that their third quarter adjusted net revenue comes in at 7.3 billion euros. The expectation was for 7.36 billion euros. So an ever so slight miss there. They see full year adjusted operating profit at the low end of 4 to 8% growth. They expect volume to decline modestly for the current year of 2025. And they see organic operating profit growth at the lower end of 4%. So those results just coming in from Heineken. We had a Morgan Stanley analyst saying that pretty much everything that can go wrong for Heineken has gone wrong in the third quarter. But these numbers not looking too bad. We've had a redhead just now in terms of organic beer volumes falling 4.3%. The estimate was for a fall of 4.52%. So not quite as bad as had been expected. We also have breaking earnings out of Milan from UniCredit, kicking off European bank earnings season. Revenue for the third quarter coming in at 6.17 billion euros. The estimate was for 6 billion euros, so a beat there. Net income of 2.66 billion euros. The estimate was for 2.39 billion euros. Again, a beat there. And net interest income, of course, all important, coming in at 3.37 billion euros. The estimate was for 3.39 billion euros. So an ever so slight miss when it comes to net interest income. But of course, the Italian government's been mulling windfall taxes on banks in recent months. M&A remains an important theme for European banks, even if UniCredit has abandoned its M&A ambitions on Banco BPM. So we keep an eye on European bank earnings. We've just had the first one, though, that coming from UniCredit. Let's check in on these broader markets. We come into Wednesday with stocks near all-time highs, but futures pointing lower here in Europe. Higher, though, stateside. We've already seen some sign of the fatigue in the Asia session. The MSCI Asia Pacific Index down 0.1%. And if we flip the board over to the cross-asset picture, the top story today has to be in the commodities space. We've seen steep losses for gold and silver yesterday, the biggest intraday decline in more than a dozen years. And it has been this ferocious weeks-long rally. So traders taking a bit of profit. Gold steady now. It's up a touch at $4,129 a troy ounce. But the question remains, is this bull trend done? Now, partly the sell-off had come as the dollar rose on positivity around the US-China trade talks. We have euro dollar up today at a 116 handle, and we have oil up for a second day as President Trump has stressed that India would wind down its oil purchases from Russia. So Brent trading there at $62 a barrel, and the US 10-year yield at 3.95% as this US government shutdown continues. But let's get a look at how Asian markets are faring this morning. We can go to Winnie Xu in Hong Kong. But just a moment, we are going to come next to the oil inventories, and we can go next to Winnie Xu. So let's get to Winnie Xu now in Hong Kong. And now we're going to go, we are going to go back to the trade story and dive into that. The US President Donald Trump saying that a 155% tariff on Chinese goods will begin on November 1st. It comes as he says that a meeting with China's Xi Jinping would yield a good deal while tempering expectations.
I think we're going to have a very successful meeting. Certainly there are a lot of people that are waiting for it. Maybe it won't happen. Maybe it won't happen. Things can happen where, for instance, maybe somebody will say, I don't want to meet, it's too nasty. But it's really not nasty, it's just business, and we're going to do a good job representing you people and representing the people of our country.
Let's get to our China correspondent, Min Min Lo now. Min Min, we keep debating who's got the upper hand in the US-China trade war. Should we take from the latest China trade data that the US just can't seem to live without Chinese exports? What does that mean for leverage?
Well, if you look at China's trade data, yes, it does seem like Chinese exporters are extremely nimble in shifting their trade flows and looking for alternative markets to reduce their reliance on the U.S. And when you think about what is on China's and U.S.'s wish list, it's semiconductors versus rare earths. And some analysts are saying that the U.S. needs rare earths from China more than China needs semiconductors from the U.S. And some are saying because of the resilient trade, maybe President Xi might be more willing to walk away from a deal if his conditions are not met. Because you think about what China wants, it's not just the high bandwidth memory chips, but the highest end semiconductors for that would be useful for its AI sector. And some are saying there are reasonable signs that maybe President Trump would be more amenable to loosening those trade restrictions than his predecessor Biden, right? Because Trump has so far been willing to cut deals with the likes of Nvidia, offering, allowing them to sell to China in exchange for a portion of their revenue. Of course, China also wants lowering of tariffs to be on par with other countries, and that means the removal of the fentanyl-related tariffs. That would require China to show more signs, even if symbolic ones, that they are doing more to remove or to curb the flow of these ingredients of fentanyl into the U.S. and perhaps maybe committing to buying some soybeans from the U.S. in exchange for lower tariffs. But there are really infinite ways that this talk could, turn out in the end. But President Trump certainly setting the tone for a very successful trade talk with President Xi, he says.
OK, and meanwhile, we've got China trying to calm foreign businesses that its rare earth export controls aren't going to be disruptive. Tell us more, Min Min.
Yes, clearly China is sort of trying to balance between threatening the U.S. with its rare earth leverage while also calming markets, and especially not to spook investors in China, because yesterday the Vice Minister of Commerce had met with an unusually large numbers of foreign businesses here in China, about 170 foreign businesses and foreign chambers in Beijing. And the message from the Vice Commerce Minister was that these rare earth controls are not meant to disrupt normal trade flows. And China will continue to work with countries as long as these are legitimate transactions in line with Chinese law. China will make sure the flow of rare earths will be smooth. So just within that message, there's also, what is unsaid is that sort of a veiled threat as well to these companies and these other countries, right? That China doesn't want to see the spillover effect to other countries. The message is targeted at the U.S., but at the same time, if other countries start to join the U.S. in this bandwagon to sanction Chinese companies, maybe they could face some delay in rare earths. And case in point is this Dutch chip company in the Netherlands that is owned by a Chinese owner, with the Dutch government seizing control of the company because of the expansion of this U.S. entity rules. China has been retaliating by placing export controls on that particular chip company in the Netherlands.
OK, Min Min Lo out of Shanghai, we thank you so much as we head towards that potential meeting between Trump and Xi Jinping. Now, I just want to return to those UniCredit earnings that we had out of Milan a few moments ago in the programme and just correct one of the numbers, a key number, in fact, and that is the net income. So it came in for the third quarter at 2.63 billion euros. The estimate was for 2.39 billion euros. But unfortunately, we had shown on the screen the incorrect number. And so just to remind you of the correct number there before we get trade on that later in the day. But let's also get to how Asia markets are faring with Winnie Xu in Hong Kong. Winnie, how's everything playing out where you are?
Morning. It seems like we're seeing a bit of a weakness in Asian stocks today, mainly dragged by some of the declines in the technology shares. But here you can also see that leading the region lower are the Hong Kong shares, and actually with the major index down over 1%. So there is still a lot of volatility when it comes to trading Chinese equities. We were just talking about how Trump on one hand say that he is expecting a good deal with China, and on the other hand saying that this meeting with Xi might not even happen. And strategists are also quite divided in terms of how to trade this market, with Morgan Stanley and Nomura saying that not to buy the dip yet, while we just had this note from Goldman Sachs saying that the default mindset for Chinese stocks should be to buy the dip. Now take a look at what's going on in the Japanese markets, because we are seeing that stocks fluctuating a little bit when it comes to kind of trading after Takaichi got elected as the prime minister. We are seeing a bit of kind of profit taking here, and SoftBank here is that big drag when it comes to the dragging the index lower after Texas Instruments actually had a quite disappointing outlook. And also when it comes to cross asset, we are also seeing the yen strengthening just a little bit after weakening for the past 3 days. And it's also coming after how the new prime minister says that tackling inflation is one of the key priorities. Now, we are focusing a lot on what's going on when it comes to gold and silver globally, and we see a bit of that spillover effect into the Asian session as well. You see here Australia's West Gold Resources and also Japan's Sumitomo Metal Mining both down over 5%. So it is that sell-off going on across the globe. But for now, we are hearing from investors that they don't really see a contagious effect to go further, because it's mostly a profit take after a big rally. But we'll see how things go in the European session.
Rennie Shu, we thank you so much out of Hong Kong with that update. Now, in the European session, we are going to be looking ahead to lots of the luxury names reporting, but we have seen L'Oreal shares dropping in New York after sales disappointed. US weakness outweighing signs of improvement in China. And we can get more now with Bloomberg's Angelina Rascouet out of Paris, who's watching all of these numbers for us. So, Angelina, disappointing growth overall last quarter for L'Oreal, it looks like.
Yes, indeed, that was the case. I mean, as you mentioned, the U.S. was pretty underwhelming. The CFO explained that in the U.S., L'Oreal tends to be exposed to makeup, which is a category that hasn't been super dynamic lately. And even though China recovered, they grew, it wasn't, I guess, enough to offset the weak U.S. performance. The CEO of L'Oreal, Nicolas Hieronymus, said he remains cautious on China. He didn't want to draw big conclusions from the third quarter numbers alone. He also said the beauty market overall in 2026 is expected to rise slightly more than in 2025, but again, remaining cautious. He was asked about Armani. Remember, L'Oreal has the beauty license for Armani, and it's a very lucrative license. And L'Oreal was named among the preferred bidders for an initial stake sale of 15%. And he said that even though they did a massive deal with Kering this week worth €4 billion, that will not prevent them from assessing and exploring their options when it comes to that Armani initial stake sale.
OK, I want to come back to Kering in just a moment. But first, we're going to get a 7 a.m. London time sales data from Hermès, Angelina. So is that likely to follow LVMH's strong lead? And what do you make of the choice of Wales Bonner to lead the menswear line, the latest in this wave of new creative directors?
Absolutely. I mean, Hermès tends to be amongst the most resilient luxury brands out there. I guess its customer base is wealthier. They buy, the exclusive bags that Hermès offers. And so we're expecting growth. However, in the past, we've been used to double-digit growth rates. This time around, we're expecting single-digit growth rate. Still expecting double digits at the crucial unit, which is leather goods and saddlery. We'll see what happens. Basically, analysts said they want to see what the quality of the growth looks like. And so far this year, Hermès shares are actually down, not because it hasn't performed well, but because, the market sort of assesses that it's sort of really highly valued. It's quite expensive. And when it comes to the nomination, absolutely. Hermès last week announced that their menswear designer who'd held that role for 37 years, Véronique Nichanian, who's 71, will present her last show this January. And yesterday they announced her replacement. She's 35. She's British Jamaican. Her name is Grace Wales Bonner. She graduated from Central St. Martin's about 10 years ago. She has her own line. She also did collaborations with Adidas. So, sportswear affinity, I would say. So it'll be interesting, and it's part of the changing of the guard that we saw in the past year with many new designers at Celine, Dior, Chanel being appointed. During this downturn, we need new creativity. We need to generate desire again, and that's what you're doing. However, for Hermès, the new menswear designer, we will have to wait until January 2027 to see her new creations.
All right, Bloomberg's Angelina Rascouet in Paris, we thank you so much. As you mentioned, we are going to get the Kering sales numbers as well. That's at 4:45 p.m. London time. Of course, we've got a new CEO there as well, Luca Di Maio. But let's get back to the top story in markets, and that is what's been happening in commodities. Gold and silver have plunged from their record highs, with the yellow metal suffering its biggest intraday fall since 2020. Bloomberg's Valerie Teitel has been tracking all of this for us. Val, what's going on with gold? Is it just a bit of profit taking, or is this the end of the rally?
Look, most people would say that we were due for a pullback. Gold has essentially risen 30% since the end of August, essentially in a straight line. So the first pullback to this rally happened yesterday. Gold at one point in the session was down over 6%. We closed 5% lower and are just scraping back just tiny those losses overnight and this morning. Now, it's interesting, Lizzie, it's not just gold that was impacted. Silver also saw a retracement. There was also a steep retracement in gold miners. A hotly tracked gold miner ETF, GDX, had its worst fall since March 2020, was down around 10%. So it does feel like some of these momentum trades are being at least cooled down for now. Let's see if that extends in trade today. But it was interesting that this pullback in this commodity trade didn't necessarily have any effect on risk appetite. The broader S&P 500 index essentially closed the session flat yesterday. The attention was more on the earnings that we got after the bell. A lot of disappointment out here, Lizzie. Let's start with Netflix coming out talking about a $600 million hit to operating profit to settle a lawsuit with the Brazilian regulator. So those shares fell off of that disappointment. So we missed on the top line because of that payment to Brazil. Shares were down 6.5% after hours. Now, what executives were trying to claim is that aside from this one-off payment, the results were actually very solid, mostly due to their most popular streamed series now of all time, K-pop Demon Hunters, which I am told by my producer is a must-watch. But executives also wanted to address shareholder concerns that AI-generated video is having an impact on their business. They said, if anything, it's seen the opposite in the last quarter, and that their subscriber engagement was at a record. We also had disappointment from a chip name from Texas Instruments. This one showing that their turnaround in analog chips is not necessarily going as planned. These shares plummeted in after-hours trade, down 8.6%. This is now the second quarter in a row of a disappointing forecast from Texas Instruments. And Liz, you'll be watching the analog chip makers here in Europe at the Open, Infineon being the big one.
All right, Valerie Teitel, we thank you so much. Binge watching the K-pop as always, and Val will be back with us later in the programme. But coming up next, UniCredit's third quarter net income beating, and we're going to dig into those earnings. Coming up, this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's dive into those UniCredit numbers, shall we? Reporting third quarter profit and revenue that beat analyst estimates, giving a boost to the CEO Andrea Orcel after his unsuccessful bid for Banco BPM. We can get more with Lento Tang, who's been looking under the hood here, our senior bank analyst at Bloomberg Intelligence. If you're looking at these, I think they look pretty good, right?
Yeah.
Why haven't they upgraded their guidance?
The result was good, but that's more on the bottom line control rather than the top line.
Okay.
So revenue, as you said, 2% beat, but that is mainly driven by the trading revenue, which we kind of expected it because of good results from the US banks. So we expected trading to be good. If you look at the breakdown of revenues, NII is actually 1% miss. So I think that's kind of what the key line there. So currently consensus is saying the NII is going to bottom in the first half of 2026. So it's very important to see from the management comments on when the bottom will be. I think that will be the key driver. Now, speaking to the bottom line control, so cost and loan loss provisions are really good this quarter. So again, you will see whether that performance is going to continue or not.
OK, really helpful. Lento Tang, Senior Banks Analyst at Bloomberg Intelligence on those UniCredit earnings. But coming up on the programme, the CFO of ARM comments on the idea of an AI bubble and who might be the winners and losers. We'll get the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe and to tech now. ARM CFO says that the company is the CPU of choice in major artificial intelligence projects from NVIDIA to Oracle. Jason Child also told us that today's AI challenge is supply, not demand, and expects both failures and winners to emerge in the sector.
If you back up Stargate, I think they said it was going to be something like $500 billion of total spend over 4 years. As of today, we are the CPU of choice. So if you think of, say, Grace Blackwell, or even in the future, Vera Rubin, Grace and Vera, those are both built on ARM from NVIDIA. And then, of course, to the extent that Oracle's also going to be contributing, that's certainly another partner that we could be helping. And then there's OpenAI, and certainly there's, I guess, rumors of custom efforts by them. And for the most part, most of the custom efforts, there's been a lot of discussion about using ARM-based CPUs to pair with those custom GPUs. So a lot of opportunity, and it could be significant.
The numbers, I mean, you mentioned 500 billion.
Yep.
The numbers are kind of range from 100 billion to 500 billion.
Yep.
Is there a risk that the revenues realised won't match some of those larger aims and larger aspirations?
Possibly. We're not super close to the total spend in Stargate, but if you look at what the needs and uses are right now of AI, compute in particular, supply is far behind demand. And so at this point, I think the challenge is really just about, can you get the power, can you get the chips, and can you get the systems deployed? And so, with that kind of a demand cycle, I expect there's a decent chance that you'll see us at the high end of that.
So on that point about supply not meeting demand right now, we've seen these incredible numbers, incredible deals across the infrastructure space from the hyperscalers and OpenAI and many others. On a future, a promised future, but not fully realised yet, does it concern you? I mean, are we seeing an AI bubble?
Okay, so when I think about bubbles, I think about, I was actually at Amazon back in 99, 2000 when things were getting frothy, I think they said. What was interesting there is there was a bunch of build-out, but a lot of that build-out wasn't really being deployed or it wasn't being fully utilized. If you think about all the servers, all the websites, the shipping capacity, et cetera. What's different in this cycle is the problem we have right now is supply, not demand. That was really more of a demand issue. This is really, right now, our challenge is supply. So I think the question is going to be, is there going to be a situation where you have a bunch of companies that probably have raised capital and maybe are pre-revenue? Is there a bunch of those companies that maybe won't make it out? So are they going to be the Pets.com or Home Grocer or Webvan or whatever? Sure, that certainly could happen. But are there also going to be the equivalents of Amazon, Google, eBay, Yahoo, these other companies that actually were, quite large and became, pretty huge companies? I expect that to happen as well. So how we define bubble and who's the winners and losers, I think that's all to be seen.
So that was the ARM CFO, Jason Child, speaking to our very own Tom McKenzie on the sidelines of Bloomberg Tech London. And we've got some significant tech earnings coming up today, not least SAP and Tesla, as we look at futures pointing higher stateside, but a touch lower here in Europe. Euro Stoxx 50 futures down 0.4%. But coming up next here on Bloomberg Daybreak Europe, the much talked about summit between Presidents Trump and Vladimir Putin may not happen. We'll get you all the details on the geopolitics next. So stay with us. This is Bloomberg. morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. The gold rout easing after suffering its biggest intraday drop in more than 12 years, while Asian stocks fall as the equity rally on Wall Street shows signs of fatigue. Elsewhere, Donald Trump says that his meeting with Chinese President Xi Jinping may not happen as the trade deal deadline approaches. The US president also casting doubt on a second meeting with Vladimir Putin. And UniCredit's profit beat. Italy's second biggest bank sees net income rising almost 5% on higher dividends, giving a boost to the CEO, Andrea Orcel, after his unsuccessful bid for Banco BPM. Well, a very good morning. If you are just joining us, it's just 6:30 a.m. here in London, and we're looking at futures pointing higher stateside but lower here in Europe. We've already seen a bit of fatigue in the Asian session. The MSCI Asia Pacific Index, paring some of its earlier losses, now down just 0.1%. But if we flip the board over to the cross-asset picture, we saw these steep losses when it comes to silver and gold yesterday, the biggest intraday decline for gold in more than a dozen years, and this after what really has been a ferocious weeks-long rally. So traders seemingly taking a bit of profit. The rout showing signs of easing now, but the question remains, is this bull trend done? Now, partly the sell-off had come as the dollar rose on the positivity around the US-China trade talks. You can see euro-dollar on the up today at 1.16 and the 10-year yield at 3.9665 at the moment. The US government shutdown, of course, continuing. It's on the verge of becoming the second longest on record, and we have oil up for a second day as the president stresses that India is going to wind down its oil purchases from Russia. So Brent there at $62 a barrel. But let's get to the UK now, because the Bank of England governor is warning of parallels between the private credit boom now and the subprime debt crisis during the financial crisis. Andrew Bailey said that the alarm bells are ringing, and he was giving evidence to a UK parliamentary committee. This is after officials confirmed plans to stress test the private credit market.
We certainly are beginning to see, for instance, what used to be called sort of slicing and dicing and tranching of loan structures, for instance, going on. And if you're involved before the financial crisis or during it, the alarm bells start going off at that point. I sat in a session with people from the private equity and private credit world some months ago, who of course told me that everything was fine in their world apart from the role of the rating agencies. And I said, well, we're not playing that movie again, are we?
Let's get more now with Bloomberg's Valerie Teitel. Val, we heard cockroaches from Jamie Dimon, a canary in the coal mine from Andrew Bailey. Just the fact that everyone's talking about private credit, even if they choose different animals, show that these concerns are really building.
Oh, yes. Well, Bailey's comments yesterday, I think, adds fuel to those worries. He especially was concerned after the collapses of Tricolor and First Brands of the U.S., what that can tell us about the very opaque private credit market. And I think the thing that's concerning, at least for Bailey and the regulators here, is we still don't even really know the size of the private credit market. The latest estimates put the size of the U.S. private credit market over $1 trillion, but it's really an opaque sector. And I think the worry for the Bank of England and for Bailey specifically is that they really want to answer the question, if we get a shock to private credit, if we see substantial write-downs in these loans, is that a shock that is contained, or is it amplified like what we saw in the subprime crisis during the financial crisis? Now, Bailey is essentially saying that, look, we got it very wrong back in 2008. Everyone told us subprime would be contained. It ended up not being. It ended up being very amplified throughout the financial system. Essentially, they don't want a repeat of that. So that is why they're looking at these stress tests. We haven't gotten very many details on how they expect to perform them, but the details is that these are something they likely will be launching in the next 9 to 12 months, with details coming shortly. But essentially, this is really the Bank of England being on the forefront of these warnings. It was only a few weeks ago the Bank of England warned that there could be a sharp correction in the equity market due to stretched AI valuation. So they seem to really be on the forefront, at least, of worrying about drawdowns in the industry.
Well, we're going to pick up on that worry about about the stretch valuations later in the programme with our tech guest, but Bloomberg's Valerie Teitel, thank you so much for breaking it all down as always. Now, President Trump says that he does not want to have a wasted meeting with Vladimir Putin in a sign that the summit between the two leaders may not happen. The US leader has, however, reiterated his desire to see the current battlefield lines in Ukraine frozen as part of any ceasefire agreement that is reached. But that has been rejected by the Kremlin. So let's bring it all together. We can bring in Bloomberg's Russia economy and government editor Greg Sullivan. He's with us now for more. Greg, you've got the Financial Times reporting that this Trump-Putin summit is cancelled. Is it just in jeopardy? What's the latest?
Well, before this even, we had Russia really tamping down expectations for this summit. We heard that they would take challenging and work and a lot of preparation leading up to it. And now we have Donald Trump casting doubt on it himself. What seems to have happened is that Russia's Foreign Minister Sergei Lavrov held a call with U.S. Secretary of State Marco Rubio that was intended to plan on preparations for this intended summit. Obviously, the call did not yield much. There's no plans for the two to meet. But really what we have is Russia not really moving away from their maximalist demands. They've tamped down expectations for a ceasefire. They've thrown cold water on that demand from President Trump. They don't want a ceasefire right now. So it's unclear what, if the summit was held, President Trump would actually walk away with. So now President Trump is potentially reassessing the situation, realizing he might walk away empty-handed from yet a second summit with President Putin, and reassessing whether this can happen. Of course, things can change. We saw that President Putin was able to get Trump on the phone ahead of his Zelensky meeting. So again, things could change quickly. But as for now, there does seem to be a lot of doubt over what Russia is actually willing to offer, and if they're even ready for a ceasefire, barring further pressure.
Well, the Europeans, Greg, are preparing for a ceasefire. We have these latest ceasefire proposals from the European leaders to try to end the war. Just talk us through what's actually in this 12-point plan for peace.
Well, a few things. One, the plan does call for the conflict to be halted along the current lines of contact. Now, of course, that's something that Russia has dismissed. It's something that President Trump and the EU leaders are calling for. But again, that's one of the points of contention in leading up to a ceasefire. Now, should Russia agree to a ceasefire, the plan also calls for the return of Ukrainian children that have been deported from the country, as well as funds to rebuild Ukraine in the post-war reconstruction phase. Furthermore, it does address security guarantees for Ukraine. That will be crucial in any resolution to the conflict going forward, and something that Zelensky wants to keep on the agenda in front of Trump and on the minds of his allies. Again, one thing I would caution is that this envisions all of this after Russia agrees to a ceasefire. And as we know, with the summit now in doubt, it doesn't look like Russia is moving any closer to agreeing to a ceasefire, so it's unclear when all this will actually come to fruition.
OK, Bloomberg's Greg Sullivan, we thank you so much for the latest on that. And we can get to some other top geopolitical stories as well. Of course, Trump wanting the ceasefire between Russia and Ukraine because we have the ceasefire between Israel and Hamas. And the US Vice President says that he's still optimistic about the future of that ceasefire between Israel and Hamas, despite the flare-up in violence over the weekend. J.D. Vance says that the Gaza deal will require constant monitoring and supervision, but he will not set a deadline for Hamas to disarm.
I'm not going to do what the President of the United States has thus far refused to do, which is put an explicit deadline on it, because a lot of this stuff is difficult. A lot of this stuff is unpredictable. I feel very optimistic about where we are. Knock on wood, you never know how this stuff is going to go. But given what I've seen, given the incredible talent and effort that's going in to the reconstruction of Gaza, to the long-term security of the Gazans in that territory, I feel very good about where we are.
We also have the news that the US is planning to buy 1 million barrels for its strategic petroleum reserve, taking advantage of low oil prices. The Energy Department plans to buy crude for delivery in December and January, using a portion of the $171 million from President Donald Trump's signature tax and spending law. So those are some of our top stories worldwide. But coming back to the UK and its ambition to become a global leader in life sciences. It's being put to the test in Cambridge, where rapid development at its biomedical campus is really being hit by struggling local.
Hello everyone. Good evening to all of you. MCX market is open. ये 1 hour टाइम फ्रेम का चार्ट लगाया था, लेवल देख लेना. मॉर्निंग पे थोड़ा बहुत सपोर्ट लिया इसने गोल्ड ने, वापस ऊपर रेजिस्टेंस एरिया से के आसपास ही सेलिंग आ रही है. होल्ड नहीं करता है तो थोड़ा और गिर सकता है. 300 922 के आसपास थोड़ा बेरिश ही लग रहा है. ऊपर एक रेजिस्टेंस सब मेजर है. बाकी बिटकॉइन को देखोगे सपोर्ट पर ही साइडवेज हो गया, मल्टीपल टाइम सपोर्ट ले लिया, अगर होल्ड नहीं करता है तो फिर नीचे 99,300 तक भी जा सकता है 1 आवर टाइम फ्रेम पे। लेट्स मूव ऑन टू द नेचुरल गैस एंड क्रूड ऑयल। ठीक है, 5:30 न्यूयॉर्क सेशन की ओपनिंग रहेगी। क्रूड ऑयल का चार्ट अभी भी नहीं चल रहा है, आई थिंक ये कॉन्ट्रैक्ट चेंज करना पड़ेगा। लाइक भी करते रहो गाइस, जिन लोगों ने लाइक नहीं किया डोंट फॉरगेट टू लाइक द स्ट्रीम। नेचुरल गैस में तो करंट फ्यूचर ही है 304 305 के आसपास चल रहा है, हल्का सा गैप अप हुआ है, थोड़ा बहुत रिजेक्शन मिल रहा है। क्रूड ऑयल में देखोगे तो नवंबर मंथ का ही फ्यूचर लगाना। 1050 चल रहा है प्राइस, मुझे लग रहा है शायद अभी भी रिफ्रेश नहीं हुआ है, नहीं तो ये अभी तक ऑन हो जाना चाहिए था, यही दिखेगा आपको। ठीक है, करंट मंथ का जो फ्यूचर है वो शायद शो नहीं कर रहा होगा, ये कल का ही लेवल है। कल याद होगा आपको मूरत ट्रेडिंग के वक्त प्राइस इस लेवल तक चला गया था, फॉरेक्स में और ऊपर गया तो वो एमसीएक्स में ऑलमोस्ट टारगेट पे चला गया। लेट्स सी यहाँ पर क्या ट्रेड बना सकते हैं आज इंट्राडे में। ठीक है, ये करंट मंथ का फ्यूचर वहाँ पर अपडेट नहीं हुआ है इसलिए शो नहीं हो रहा है, ये दिसंबर मंथ का मैंने फ्यूचर लगाया हुआ है, दिसंबर मंथ का चार्ट है। 5146 47 5050 के आसपास चल रहा है। ये तो कंफ्यूज मत होना, क्रूड ऑयल में नेक्स्ट मंथ का ही चार्ट है, करंट मंथ का चल ही नहीं रहा है अभी। Vladimir Putin oversees readiness test of Russia's nuclear force. ये क्रूड ऑयल भी देखो रेजिस्टेंस पर ही है, हो गई कैंडल क्लोज। दो बार यहाँ से रेजिस्टेंस ले चुका है प्राइस, ये तीसरी बार है इस एरिया पे, तो इट इज ऑल्सो ऑन रेजिस्टेंस। आगे नीचे आता है क्रूड, तो सपोर्ट परसों का जो लास्ट स्विंग बना था 4990, उसको कंसिडर करेंगे। तो नीचे सपोर्ट ये है हमारे पास, ये अभी भी इंटैक्ट ही है। बार यहाँ से सपोर्ट ऑलरेडी ले चुका है प्राइस। यहाँ पर भी एक रेजिस्टेंस है, दो रेजिस्टेंस साथ साथ ही बने हुए हैं, तो दोनों को एक साथ लगा दे रहा हूँ। पूरा एक बड़ा रेजिस्टेंस बनाऊंगा तो वो थोड़ा सा ज़्यादा ही बड़ा शो होगा, तो अलग अलग लगा दे रहा हूँ क्योंकि वो एरिया काफ़ी बड़ा है। यहाँ से यहाँ तक पूरा मार्क करके देखोगे तो 112 पॉइंट का रेंज है, तो अलग अलग उसको कंसिडर कर सकते हैं। ऊपर वाला लेवल अभी तक टेस्ट नहीं हुआ है, ध्यान रखना। ये जिस लेवल से भी सेलिंग आ रही है दैट इज ऑलरेडी टेस्टेड 2 times, दिस इज द थर्ड टाइम। ऊपर वाला और स्ट्रॉन्ग है एज कम्पेयर टू दिस वन। 5:30 होने वाला है, न्यूयॉर्क सेशन इज गोइंग टू ओपन एट 5:30। नीचे सपोर्ट वही है क्रूड में जो लगाया हुआ है, उसके अलावा बीच में कोई नया सपोर्ट है नहीं। नेचुरल गैस में भी नीचे सपोर्ट 280 285 के अराउंड 15 मिनट टाइम फ्रेम पर। यहाँ पर देखोगे ना, नेचुरल गैस में परसों याद होगा यहाँ पर एक रेजिस्टेंस भी बनाया था। परसों याद होगा यहाँ पर एक ये रेजिस्टेंस क्रिएट किया था, मार्केट आया था, थोड़ी बहुत सेलिंग आई। अभी प्राइस देखोगे ना, उस रेजिस्टेंस एरिया के थोड़ा सा अपर साइड पे निकल रहा है। नहीं तो यहाँ से भी एक सेलिंग का प्लान कर लेते, थोड़ा सा अपर लेवल पे निकलने की कोशिश कर रहा है। 5:30 हो चुका है, लंदन सेशन ऑलमोस्ट गोइंग टू ओपन इन 30 सेकेंड्स। बस इसका नेक्स्ट रेजिस्टेंस भी देख लेते हैं, बिकॉज अगर यहाँ से नहीं आई थी सेलिंग तो फिर इसके ऊपर भी एक रेजिस्टेंस है, वहां पर भी मैं देख पा रहा हूँ। एक बार सेलिंग तो आई थी, दूसरी बार आई है, फिर 3 4 5 छठी बार हिट कर रहा है क्या इसको? 6 टाइम हिट कर दिया इसने तो। ठीक है, 6 टाइम ये हिट किया ऊपर वाले। इसके ऊपर भी एक रेजिस्टेंस है, दैट इज अ 6 टाइम हिटिंग दिस लेवल। ओवरऑल तो सुपर बुलिश ही लग रहा है। नेचुरल गैस परसों से थोड़ा सा अभी पुल बैक नहीं आ रहा है। परसों गैप अप हुआ था, उसके बाद कंटिन्यूसली ऊपर ही जा रहा है। अभी भी देखोगे ये भी एक रेजिस्टेंस है। परसों थोड़ी बहुत सेलिंग आने की कोशिश करी थी, अभी उसके ऊपर ही निकल गया। क्लोजिंग बेसिस पे देखोगे इसके ऊपर एक रेजिस्टेंस यहाँ पर है, ये भी आपका जैसा मैंने बताया। पर टाइम टेस्ट हो गया मल्टीपल, मतलब एक बार तो पहली बार में ही सेलिंग आ गई थी। तो एक बार यहाँ पर सेलिंग आई है, दूसरी बार, 3 बार, 4 बार, ये 5वीं बार है, 5th टाइम नेचुरल गैस का लेवल ऊपर वाला। यहाँ से तो हिट कर दिया, तो इस लेवल को लगा के फायदा नहीं है कुछ, इसको रहने ही रहता है। ठीक है, जहाँ पर ये है वो भी रेजिस्टेंस है, बट वो रेजिस्टेंस के ऊपर निकल गया, देख पा रहे होगे वहाँ पर लेवल को, दैट इज गॉन अबव द रेजिस्टेंस एरिया। तो इस पूरे जोन को रेजिस्टेंस मान सकते हो कम्प्लीटली। नीचे नेचुरल गैस का सपोर्ट है, वो भी स्ट्रॉन्ग ही है, अब 280 84। ठीक है, क्रूड ऑयल में भी लेवल है एक ट्रेड का, थोड़ा सा इसमें क्वांटिटी का ध्यान रखना, बिकॉज पहली बार नहीं आ रहा है इस लेवल पे। क्रूड ऑयल में मल्टीपल टाइम टेस्ट कर चुका है इस लेवल को, तो थोड़ा वीक तो हो ही गया होगा अब, इवन दो अभी भी सेलर है प्रेजेंट, लग तो रहा है, बट ऑलरेडी जब इतने बार टेस्ट हो गया तो पॉसिबिलिटी है कि ऊपर भी जा सकता है, तो थोड़ा सा क्वांटिटी कम रखना है यहाँ पर क्रूड ऑयल के सेलिंग वाले ट्रेड में। इसके ऊपर भी एक रेजिस्टेंस है, यहाँ देख पा रहे होगे, देयर इज आल्सो वन रेजिस्टेंस ओवर हियर। ये फिर भी ठीक है एज कम्पेयर टू दिस वन, बिकॉज वो अभी तक टेस्ट नहीं हुआ है, ये टेस्ट हो गया मल्टीपल टाइम। ठीक है, तो थोड़ा सा नेचुरल गैस के स्ट्रेट क्रूड ऑयल के स्ट्रेट का ध्यान रखना, क्वांटिटी थोड़ी सी कम ही रखना। 25 पॉइंट का ऐसा रखा है फ्यूचर में, थोड़ा सा मल्टीपल टाइम टेस्ट हो गया तो इसलिए काइंड ऑफ अ रिस्की आप मान सकते हो ट्रेड को। अब ऊपर वाले को टेस्ट तो नहीं किया है जितना मुझे दिख रहा है अभी तक, वो फिर भी स्ट्रॉन्ग ही है इसके कंपैरिजन में। बाकी नीचे आता है तो सपोर्ट है, वो एक ही बार टेस्ट हुआ है, दूसरी बार आएगा वहाँ पे। ये लेवल 3 बार टेस्ट हो गया, चौथी बार फोर्थ टाइम इस प्राइस को हिट कर रहा है क्रूड ऑयल 15 मिनट टाइम फ्रेम पे MCX। बाकी अगर क्लोजिंग आती है क्रूड ऑयल में 5120 के नीचे तो फिर अच्छा खासा फॉल आ जाएगा, बट उसके लिए 5120 के नीचे क्लोजिंग भी चाहिए, पर वहाँ नहीं ले सकते बिकॉज सेल फिर बहुत बड़ा हो जाएगा। तो ध्यान रखना जो लोग सेल किए हैं, थोड़ा सा रिस्की साइड पर है ट्रेड क्रूड ऑयल का ये वाले लेवल पे। मल्टीपल टाइम टेस्ट हो गया बिकॉज
News when you want it with Bloomberg News Now. I'm Karen Moscow, and gold is extending losses in a choppy session after suffering the worst rout in over 12 years yesterday on concerns its rally had run too far too fast. Silver is also falling. Garfield Reynolds covers the markets for Bloomberg.
You're looking at the biggest drop in gold, at least intraday, for something like a dozen years, and the move in silver was also similarly extreme. People were talking about, sort of close to being a 5 standard deviation move, which is the sort of thing that should happen, basically about once a century. So huge moves, and part of the significance, I suppose, really is that these were moves that didn't come on any news.
And that's Bloomberg Markets Live reporter Garfield Reynolds, who says despite yesterday's sell-off, gold is still up almost 60% this year. Checking COMEX gold, it's down 1.7% at $4,043 an ounce. Silver has also resumed its declines this morning. Spot silver is down 1.9% at $47.78 an ounce. AT&T shares are higher. It added more mobile phone and home internet subscribers this summer than analysts expected. This amid a heavy promotional push to keep competitive pressure on its two main rivals. Shares of Netflix, meanwhile, are lower, down 7%. The streaming giant says a tax dispute with Brazil cut into third quarter earnings, marring results that otherwise fell in line with Wall Street estimates. And another earnings disappointment as shares of Texas Instruments down about 8%. The biggest maker of analog chips gave a lackluster forecast for the current period, and that added to concern that a chip industry recovery is sputtering. Another stock we are following this morning, Beyond Meat. It appears this is the latest stock to hit meme mania. It is soaring 85% in early trading. The stock has rallied nearly 600% over the past 3 sessions. On Monday, Business Insider pointed to the influence of a trader who posted a YouTube video touting his bullish thesis for the maker of plant-based sausages and burgers. Now to the U.S. government shutdown. It's in its 22nd day and has become the second longest in history as a stalemate between the two parties over expiring health care subsidies persists. President Trump is expected to leave later this week for a trip to Asia. Lawmakers and congressional aides say they see a real possibility the closure could extend into November and surpass the 35-day shutdown of Trump's first term. President Trump says he does hope to make a good deal on trade with Chinese President Xi Jinping. He discussed his upcoming meeting with the Chinese leader at a White House lunch with Senate Republicans.
I have a great relationship with President Xi. I expect to be able to make a good deal with him, and I want him to make a good deal for China, but it's got to be fair.
At the same time, President Trump says his meeting with Xi might not happen if the negotiations get too nasty. And again, the two leaders are expected to meet at the APEC summit in South Korea later this month. President Trump appears to be acknowledging a New York Times report that he's seeking $230 million from the Justice Department for past investigations against him. That includes the probes into alleged Russian collusion with his 2016 campaign and the FBI search for classified documents at his Mar-a-Lago home. The president says he's not looking to profit off his claims.
They probably owe me a lot of money, but if I get money from our country, I'll do something nice with it, like give it to charity or give it to the White House while we restore the White House.
President Trump's demand for compensation would be reviewed by senior Justice Department officials, some of whom could be his former personal lawyers. DOJ says its officials follow the guidance of career ethics officials. Officials say a large-scale Russian drone and missile attack across Ukraine has killed at least 6 people. The attack, which began at night and extended into this morning, targeted at least 8 Ukrainian cities. Israel has identified the bodies of 2 more hostages killed in the October 7, 2023 Hamas attack. Their remains were returned to Israel, where a military ceremony was planned. Since the ceasefire began on October 10th, the remains of 15 hostages have been returned, with 13 still to be recovered. The Louvre has been reopened to the public 3 days after thieves forced open a window and stole French crown jewels in a daring daylight raid on the museum. The Apollo room, where the theft occurred, remains closed to visitors. And the race for AI dominance getting more intense. Sources say Google and Anthropic are in talks for a cloud deal worth tens of billions of dollars. And Bloomberg's John Tucker is here to tell us what we know so far. John.
This deal, if it goes through, would have Google provide AI startup Anthropic with vast additional cloud computing power. Anthropic uses Google's tensor processing units. These are known as TPUs, the company's chips that are custom designed to accelerate machine learning. Anthropic is best known for the Claude family of large language models, which competes with OpenAI's GPT models. Like its peers, Anthropic has been raising significant sums to keep pace in a race to advance AI that's going to require more and more resources and money. This is not their first deal. Google previously invested about $3 billion in Anthropic. Shares of Google parent Alphabet, they're up pre-market about 1.4%. In New York, I'm John Tucker, Bloomberg Radio.
All right, John, thank you. And futures this morning are a little changed, at least S&P and Dow futures. NASDAQ futures down about 0.2% this morning. 10-year Treasury yield at 3.94%. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
Said he reached out to you about meeting on the government shutdown. Will you meet with him before you leave for Asia on Friday?
Well, I will actually. I'd love to meet with them. I just want them to open up the country first. You know, the country is so hot right now, and they've never voted against, continuation. They've never voted against. They've never done that. They're doing this because they have Trump derangement syndrome. But I would love to meet. I would like to meet with both of them. But I set one little caveat. I will only meet if they let the country open. They have to let the country open. The people want to go back to work. They want to be served. They need the services of some people. And a lot of people need the money, the payroll. So I'll do it as soon as they open up the country. I'd like to meet.
So you won't meet with them until the government. Mr. President, just to be clear, you won't meet with them until the government's open.
The government has to be open, yeah. Mr. President. You know how long it would take for them to do that? Just say, okay, government's open, that's it. There is nothing.
How long
They're not negotiating. What they're doing is saying they lost the negotiation when we got the great big beautiful deal done. They lost that negotiation. Now they're saying, well, we want to get some of the things we lost. But the problem is the things they lost are very bad for our country. We don't want to have people come over from all over the world, from prisons and all, and have them have their health care paid for. We want to take care of people that are American citizens and all. So they want $1.5 trillion of money to be wasted and jeopardize the health care of other people. We're not going to do that. So I would love to meet with them. We want the country open for us.
Metal is having a moment. Not this kind though, sadly.
Gold hits another record.
Spot gold prices have climbed above $4,000 an ounce for the first time.
The key word is scared.
During times of economic and political and financial turbulence, you buy the dollar, you buy US Treasuries, you seek safety.
Not so much now. Now you buy gold.
What we're seeing at the moment is not like anything really that we've seen over the last couple of decades.
In October, gold extended its already furious run from last year and showed few signs of abating.
This gold rally really looks unstoppable at this time.
Excitement is evident online, on shopping streets and in capital markets.
Just gold, gold, gold the whole time.
Chinese mining company Zijin Gold recently raised $3.2 billion in one of the year's biggest IPOs. But it's not just a gold rally. Look at silver. In October, it reached its highest price per ounce in more than 4 decades.
I think it is a warning sign that people are very anxious.
Gold is the ultimate safe haven asset, a heart rate monitor, if you will, the health of the global financial system.
And because of that, when you see a spike in the gold price, your first question should really be what's gone wrong.
Gold is the ultimate precious metal. It's been around since the beginning of time. Gold has seen it all and has survived through it all, and it probably will continue to do so.
Because it's reliable, easy to trade, and high value, despite lacking the intrinsic utility of a semiconductor or shipping container full of these things.
Gold has outperformed equities, it's outperformed almost every other asset class if you take your starting point at 2000.
It is the one asset that does very well when the typical parts of your portfolio go down.
It breached $1,000 during the global financial crisis, $2,000 during COVID, and $3,000 after the Trump administration's tariff announcements, which perhaps was a wake-up call.
The dollar for many, many years has been seen as the haven of the market because people trust the U.S. government and they trust dollar assets.
Welcome to 2025.
The dollar is the single biggest decline in 6 months in 50 years. Gold is at record highs.
And here's what that looks like. This gold line, because why would it be any other colour, shows how much the metal has increased in value since January. The green line shows the dollar's depreciation over the same period. That discrepancy reflects what's called the debasement trade.
It is the idea that faith and trust in the dollar is no longer what it once was, so you have investors looking at other assets.
People do that trade when they are losing their confidence in traditional government bonds and fiat currencies.
And in that situation, gold becomes quite appealing because there is no counterparty. It's just you and your gold.
It's independent from the government's influence as well.
Which is no longer something investors automatically say about the dollar or the US central bank.
So the Federal Reserve has long been seen as kind of a bulwark of global financial stability. It has cherished independence from the political system in the US. Now the pressure on the Fed from the White House and President Trump has thrown that whole dynamic into question.
Am I allowed to appoint myself at the Fed? I do a much better job than these people.
How sustainable is the Fed's position, given the position that President Trump is taking and given the pressure he's putting on the Fed to lower interest rates?
If the Fed is slashing interest rates all the time,
that makes gold more appealing because unlike cash, it doesn't actually obviously yield interest. And so when interest rates are lower, gold becomes relatively more appealing. But on the other hand, you have inflation that makes gold appealing as a hedge.
And inflation's back on investors' minds as Trump's tariffs risk driving prices higher around the world.
So that's kind of a heads I win, tails you lose scenario for gold.
Over the summer, the dollar fell to its weakest level in more than 3 years.
While there are different views on what's behind that weakness, the takeaway is that the US isn't seen as the trusted ally it once was.
But to find the source of gold's rally, we need to look back further than Trump's second term. A pivotal moment for the metal was in 2022, after Russia's full-scale invasion of Ukraine.
G7 countries froze the assets of the Russian central bank that were held in Europe.
That caused many countries around the world to think we need to diversify away from the dollar in order to shield ourselves against potential or future US sanctions, or at least getting caught up in the dragnet of those.
And by countries, we're talking central banks, which have been steadily adding to their gold reserves. In the early 2000s, they were selling a few hundred tons into the market every year.
They've flipped that now, they're buying about 1,000 tons a year.
And for the third year in a row in 2024, according to the World Gold Council. China, India, Poland and the Czech Republic have been among the biggest buyers.
China in particular has been probably the most important central bank buying gold over the last couple of years. It's the biggest consumer of gold in the world, it's the biggest producer of gold in the world. Really, gold is a China story.
People's Bank of China is trying to create, or at least help to facilitate, a world that's less dependent on the dollar. And one way of doing that for the PBOC is to reduce its holdings of the dollar, such as the US Treasuries, and buy gold instead.
About halfway through the 20th century, the dollar became the world's reserve currency. If you want oil, you use dollars. If you want gold, you use dollars. If you want to exchange currencies, often the dollar sits in the middle of that transaction.
Even most of China's exports are settled in the dollar rather than the yuan.
The dollar made up nearly 3/4 of the world's foreign exchange reserves in 2000, but its share has been slipping since then. Pressure on the Fed, with tariffs, inflation and sanctions in mind, it's prompted trading partners to look at the US and its currency in a different light.
People are concerned with geopolitical tensions, with trade conflicts, and Trump's chaotic tariff policies.
And again feeds the idea that why is the world settling trade in dollars? What alternatives do we have?
Demand for gold's also been boosted by gold-backed exchange-traded funds, or ETFs, which let investors bet on the metal's price without ever holding any.
Maybe they don't have access to buy gold bars or to buy physical gold, but they have this access to ETFs.
September was the biggest month of inflows that we've seen in more than 3 years.
We saw that ETF inflows were 6 times larger than what a rates-based model predicts.
And remember, this trend doesn't just concern the precious metal King Midas once mistakenly transformed a daughter into. Although he shouldn't be that upset, she'd be worth a fortune right now.
Platinum and silver this year have rallied a lot more than gold.
Now there's a nuance that can get lost in the discussion about precious metals other than gold.
They're also useful. They're used in industry, they have real sources of demand. So those markets function a little bit differently than gold, but they tend to do really well when gold does well. It's partly about this debasement theme where people are worried about the ability of many developed economies to pay back their sovereign debts. And because of that, they're looking to other precious metals like platinum, like silver, and they're looking to cryptocurrencies.
Gold and to some degree Bitcoin, they are ways to express an opinion that the system itself is going to have some problems.
When it comes to haven assets, the gold standard remains, well, you know.
This gold rally speaks to the times we are living in.
Not everyone's convinced currencies and bonds are so easily replaceable. A major de-escalation of Trump's tariffs or a peace deal between Russia and Ukraine could also spur a price decline. Volatility is very much still in gold's fine print. Still, Goldman Sachs and Deutsche Bank both say they expect gains to continue for now.
With any rally, it naturally makes people worried. Is this a bubble? Is this going to pop soon? One thing it does have going for it is that the secular trends that have been supporting it over the last few years are still very much there.
It's clearly a very fragile geopolitical moment. Old alliances are being tested, new alliances are being formed, and I think as long as these really steep tensions do persist, then that clamour for safe haven assets such as gold is going to continue.
What about gold? Alexander Altman from Barclays last week telling surveillance that it was actually, if anything was in a bubble, it was gold that was in a bubble. Can you comment on gold at almost records?
Yeah, I mean, I would say the last, Vonnie, I go around and speak at these conferences, and the questions I've been getting for the last decade was, well, when is the dollar going to lose its reserve status? And I used to say to people, what, are people going to sell dollars to buy the euro, or they're going to sell dollars to buy the Chinese yuan? I just don't see that happening. And the mistake I made was I think other central banks are selling dollars and buying gold. I never thought gold would, take the mantle. So is it a bubble? Yeah, but if foreign central banks are reducing their treasury holdings and buying gold, then I think it can continue.
India-based Mint newspaper reporting that New Delhi and Washington may be nearing a trade deal that could cut tariffs on Indian exports from around 50% to as low as 15%. Let's bring in Bloomberg's Brendan Murray for more. The teams were obviously busy, Brendan. What kind of an agreement may they have come to, given this report?
Yeah, exactly. I mean, this deal has been months in the making, and it would be a significant step. The U.S. and India have tried to make a deal in various phases, 3 and 4 phases over the next 6 months or so. But it looks like that first phase might be coming together, if we can believe this report. Now, there is a lot yet to confirm with the White House and with the official Indian government. But this would come at an interesting time, because the president of the U.S. is trying to meet with China's president and do a deal of their own. So you've got a bit of gamesmanship going on, playing off India and China, obviously two competing manufacturing, exporting powerhouses. So it'll be interesting to see what they say at the White House this morning. We've seen some of these reports before, though, so we have to sort of take it when we hear confirmation or not.
The analyst at William Blair out saying that the U.S. government could take a notable stake in the company as the only U.S. antimony producer. Gary, do you see the U.S. government taking a stake in the company?
Well, it's something we don't, stay up at night worried about. We've been very fortunate in that the U.S. government has given us an incredible contract. This is the DLA, which is the Defense Logistics Division of the Department of Defense. We won a $245 million sole source contract about a month ago, and so we're working hard to fulfill that contract. And what that is antimony ingots that's used for our defense to hold in stockpile for future wars.
So can you fulfill that with the capital structure that you have right now? Do you need more money in order to fulfill this?
No, fortunately, we've raised over the last month and a half about $100 million of capital. So we're sitting on a lot of cash. We have no debt. And we actually have revenues, cash flow, EBITDA, and net income, which is unusual for a small mining company. We did announce, though, on yesterday, of our attempted takeover of a company in Australia, which is a large antimony as well as gold producer.
Larvado Resources.
Some new mine starting. Exactly. So what that does for us is it adds additional value. In fact, with our reserves and Larvado reserves, we'd be in the top 5 of the world, which is something I think both the Australian government and the U.S. government really would like to see.
Yeah, and I just want to dig a little bit deeper. What kind of tonnage of antimony would this be in terms of this deal that you're making with Larvado?
Well, you got to understand, Larvado is just a miner. They do not do the refining end, which is what we do. So we have a smelter in Thompson Falls, Montana, and we have one in Madero, Mexico. So the one in Montana is being expanded significantly, 5 times greater than what we currently produce. That expansion will be done in our first week of January. The smelter in Mexico, we could expand that probably 5 to 6 times as well. So what this resource that Larvado has we can bring to our smelters and make a finished product, not only for the government, but we make products for 7 other customers. People don't realize that antimony is used in many, many different things, and especially with the new AI technology going on. We make fire retardants for roofing materials, which all these data centers require, and then we make typically in most electrical cords to keep them from catching fire.
Wait, so it sounds like important. And I'm just curious how much you guys are paying. Can you share anything in terms of this company that you're buying? How much?
Well, yeah. So we did make an offer. We already own 10% of the company. So over the last 30 days, we've been quietly acquiring shares. It's a company we've been looking at for 9-10 months, and we wanted to wait till the appropriate time. So we bought stock. We own 10%. We announced that we're required by the Australian government to do so, and then we made an offer to the management of the company. And the offer is basically, we will give them 6 shares for every 100 shares of their stock. So if you looked at the valuation, it's a $400+ million transaction.
Okay, good to know. I want to go back, though, to what Tim asked you, Gary, initially about William Blair's call. I mean, are you guys talking with the U.S. government about them taking a notable stake in your company? Are you working on a deal? Is there anything going on right now?
Well, obviously, those type of discussions I can't really talk about. I will tell you, we've been working with the DOD on a grant. We've talked about that publicly. We're hopefully at the final stages of that. And I mentioned already the contract. So the timing of the transaction with Larvata couldn't be better. Obviously, the Prime Minister of Australia was meeting with President Trump today in the White House, and I'm pretty certain this deal was discussed. So anyway, I think that what we've got to do as Americans is realize that China has a 100-year plan, and we're not part of that plan. And we, as the largest antimony producer in the United States, want to build those reserves and resources and not be dependent upon a country that is not doing things in our best interest. So it's not only antimony, we're involved in tungsten, we're involved in cobalt, as other rare earth companies are also moving into the space. So we're trying to step it up, and we think a collaboration between the United States and Australia is a great way to do it.
You just said that you're pretty sure this was discussed between the two leaders today. How are you so sure that was discussed?
General Jack Keane is on our board, so does that help answer your question?
It does. Thank you.
Okay.
I know Carol had another.
Wait, did they call you? Did they call you to talk even a little bit further about the possibility of this?
No. But
do you want them
if you look at what the discussions were about, it was about critical minerals, it was about rare earths and a collaboration, and this is obviously what we're doing.
Do you want the United States to take a position in your company?
Not necessarily. We've access to capital is not an issue for United States Antimony. We want to do what's best for our shareholders and what's best for the country. Right now, we think that we can accomplish those goals as an independent company without shareholder ownership. If the government comes to me and says, hey, we definitely want an ownership position, then that's a different story. I'm not really in a position to talk about that at this point, but you can see the close alignment between the United States Antimony and the U.S. federal government, and it continues to strengthen. We talk to them almost every day about different things.
But do you feel like you need a U.S. investment to maybe, I just feel like, do the companies that get U.S. investments in the mineral space, if you will, have an advantage over those that don't?
I'm not sure what the investment does as an advantage. If you need capital, that's one thing. We don't need capital. We have plenty of access to capital. As you noted when we first came on the air, we've had a tremendous run in our stock, and it's because we have access to antimony. We started mining our first antimony mine in Montana last week, brought 7 loads of trucks down the mountain. So we are actively mining. We're the first fully integrated antimony company in the world outside of China, and we're happy about that. We think Larvata will definitely add to that equation.
It's a big deal because this is minerals cooperation that's going not just from conversation, and we've been doing years of talking about minerals, to actually putting the resources in to develop really strategic projects. I mean, we've agreed to commit $1 billion each to be deployed within 6 months on strategic projects. And this could be Alcoa's landmark gallium refinery. Keep in mind, China has cut us off of gallium, a really crucial material for semiconductors. And this gallium refinery is going to produce 100 tons a year in Western Australia. That may not sound like a lot, but remember the U.S. only uses about 20 tons of gallium a year. So it's actually really significant to Australia announcing equity in a rare earth project there. But what we've also seen is the first time that these countries are making a concerted effort to counter China. So you may have seen that both countries have committed to preventing Chinese acquisitions of new projects, both within their own countries, but also using diplomatic instruments in other countries. We've seen a commitment to using price support. So really, when you take the summation of all of these different efforts, we're really seeing rubber hit the road with a country that has enormous geological potential. We're talking about 40 minerals that the U.S. identified as critical, incredible financial markets, and deep technical expertise.
Is this all bottom line about putting kind of a hold on China?
This is about countering China from a supply and a demand perspective. You know, let's be totally honest. This year was a wake-up call for the whole world. Until now, a lot of the export restrictions on critical minerals were really targeted at us here in the United States. But the multiple rounds of restrictions this year actually hit companies around the world, like these recent rare earth export restrictions. Australia is still on the other end of them. So what we're really doing is we're uniting with our allies. And again, Australia being the one country that has fought beside us in every war since 1918, right, to say, okay, if we work together, we can actually start to counter China in a meaningful way.
Very then significant, again, because it feels like we have gone through a bunch of months where the U.S. is like, we don't need you, we're going to do it alone. We're going to build up stuff, supply chain, so on and so forth. At least this is coming from the administration to do stuff here in the United States. This feels like it's very significant, the U.S. saying, wait, we actually need to have global partners on this. And this is kind of a big message, again, I'm going to point out, to China and really the world at large.
And this is a really important message because I want you to understand the historical relationship of Australian mining. Historically, Australian minerals have gone to China for processing. So it's a highly vertically integrated industry between these two countries. So this was a pretty big disruption. You know, if we roll out restrictions on China, no one really bats an eye. But for Australia, where those minerals go to China, this is a really important realignment with us and breaking from what has been their historical trade relationship as it relates to the mining industry.
So I guess the question that we have is about the U.S. companies that are a part of this. And we've spoken to quite a few of these. We spoke to U.S. Antimony yesterday. Gary Evans over there, a critical mineral, not a rare earth per se, but in the same space, and with the idea that, you know, they're getting a government contract, not investment from the government, but a government contract to actually buy antimony for Defense Department purposes. But I'm curious about U.S. companies' role, and if there is such an opportunity for many different U.S. companies right now to take advantage of this. And look, we have an investing audience. They want to know which are the companies that are best positioned right now to be in a place where they can be the ones that benefit from this increased need for critical minerals.
So one of the big parts of this a new framework agreement is that we will strategically together identify priority projects and companies. One of the early leaders here is Alcoa. Again, Alcoa is a Philadelphia-based company who is now building this gallium refinery through support from the Department of War, and it was announced by the U.S. and Australian governments yesterday. Again, I want to take you back to the fact that gallium is a no-brainer of a priority for both sides because it was a commodity that China cut us off from earlier this year. So really, when we start to look at what are the winners going to be, I mean, rare earths, obviously, we're going to see Linus being really important. But broadly speaking, for some of these minor metals, which antimony is one of them, we've seen tungsten emerge in the news quite recently. These minor metals are going to be the ones where we're highly vulnerable and where we do not always have the geology to make it work, and where Australia often does.
We both have questions, but Carol, you go first.
Well, I want to go back. Forgive me if we're bouncing around, because it's just sometimes, you know, the brain is a little slow and things settle in. But Graceland, what I want to ask you is going back to as you said, a big deal for Australia to do this because they have been so intertwined with China when it comes to Australia exporting large quantities of raw minerals and then China processing. I mean, this has been a very important trading relationship. And so we know U.S. and China has been antagonistic for a while, but to have them do that, that's really significant.
It's extremely significant, but you've been seeing that growing tension for probably the last 7 years. Remember that Australia was the first country to ban Huawei back in about 2018. They also passed legislation to prevent foreign interference in their higher education sector. More recently, there was a $1.25 billion Australian loan that was given to build the Iluka refinery for rare earths. One of the T's and C's of that was that offtake had to go to allied countries. But now what this really does now, I mean, is it starts to potentially re-architecture supply chains in a meaningful way.
Yeah.
Australia, for example, is the biggest lithium producer in the world. They produce about close to 60% of the world's lithium. Over 90% of that actually goes to China for refining. If that didn't happen, China would lose its grip on lithium-ion batteries. So what this deal really stands to do is re-architecture supply chains, not just from mines, but down to the manufactured good.
So if we think about this in the context of the leverage that China could still have, even after the U.S. makes deals such as this and deals with allies, where's that leverage?
The leverage is still there in the short term with rare earths, for sure, no doubt, right? Although Australia's Lynas was the first company to separate heavy rare earths earlier this year outside of China. But it's going to go beyond that. There was a line in this framework agreement that actually said that the U.S. and Australia will work with other international partners on price support mechanisms. So this conversation is likely to extend beyond these two countries to the G7 later this year to think about how do we scale these partnerships up even more. So really what we're starting to see is an economy of scale that we're creating for the minerals and the processing capabilities. I mentioned that Alcoa deal earlier. That Alcoa deal is also getting Japanese financing. It's actually a tripartite effort. So an example of how this bilateral is going to set the stage for what's probably going to be a much bigger play of countries to counter China.
How do we figure out, especially as we see investors pushing up shares on all of these stories about the relationships, the investments by the U.S. government in various critical mineral companies. How do we figure out which is investor speculation, kind of chasing a trade? Do you think it's misplaced, or is it a bit irrationally exuberant, or you think these investments, these relationships, this is the build out, it's happening, and with good reason because the demand's going to be there?
The broader build out of the sector when it comes to mining being much more strategic is absolutely here to stay. And it's here to stay for a couple of reasons. One of them is we are diversifying away from China, right? But the second thing we have to remember is that certain of these commodities, I need a lot more in objective terms. I need a lot more copper to electrify, to build data centers, to build defense technologies. So it's also the growing demand. So I'd say the larger macro trend in prioritization is here to stay. And again, remember that the U.S.-Australia relationship, it's a continuation. It was being built under the Biden administration as well. But the other thing, though, is, there are going to be fads that come and go when it comes to specific minerals. There's no doubt, right? Some things are going to, hit media attention. Certain deals are going to hit media attention, and they're going to fall away. Not everything that this government is looking at is going to succeed. But what we are hoping is that the right number of them succeed to create a more resilient supply chain. But there are a lot of coming and going.
Yeah.
Certainly the relationship with Australia is on our radar right now, given the visit of the Prime Minister. But I'm wondering what other countries the U.S. could ally with that would be able to offer some sort of countermeasure to China and its capabilities.
So countries that I'm looking at with interest, Japan and South Korea, particularly because of their midstream and downstream capabilities. I'm looking at the UK. There's been some interesting acquisitions there, least common metals by USA Rare Earths. That's an interesting one. The EU, again, it's an interesting jurisdiction. There's some minerals, things like Solvay for their permanent magnets in France, an interesting one, again, with some conversations happening with the US as well. So there's certain pockets of interesting transactions happening from a global north. Obviously, from the global south, Brazil is still a very interesting jurisdiction to us because they have the heavy rare earths that can come back and be separated here in the United States.
Is here with Andrea Felstead, Bloomberg opinion columnist for consumer goods and retail, to look at luxury earnings. So we have luxury and banks. What more do you want for this Wednesday morning? Tom, let's start with, the banks. And actually, Barclays, it's interesting because there's been a lot of credit anxiousness out there, and Barclays was the first one in really coming out and saying their exposure to it.
Yeah, exactly. So it was known they're going to take a hit from Tricolor, and it looks like from the earnings, they don't actually name the entity, but it's 110 million impairment they're taking against a single name client. So that's clearly why we've got Venkat coming on TV going, I'm not happy with what happened there, and they've obviously taken a look, and I think the sort of learnings from that is they're just going to sort of amp up their due diligence, take extra care. He was pointing out this was a fraud situation, and so that's always a bit more tricky to kind of take too many learnings across the spectrum. But yeah, Barclays, fascinating earnings. Broadly speaking, on the group level, pretty good. Shares are up. And obviously they're bringing forward a share buyback. But then when you drill down, there's sort of these various individual incidents that do give a little bit of a pause. So you've got Tricolor, you've also got this motor finance provision, and then also just generally the investment bank not really, blowing the market away, I would say, like kind of coming in under estimates, or in particular on equities, just not delivering.
Tom, it was a good interview with Venkat, so here he is.
We had an exposure to Tricolor. I'm obviously not happy about it. Barclays had no exposure to First Brands, although we were approached multiple times by them. The thing about fraud is you wonder whether it is one bad actor or it is some effect of circumstances that are stretching the company's finances and making them take risks that they otherwise should or would not do. That's the kind of thing we look for, and that's what I think investors should be looking for over the next, months and quarters.
Tom, how is the investment bank at Barclays doing compared to the US, but also other European banks?
Yeah, I think the comparison to Wall Street is where it gets painful. So you look at equities, something like 22% increase over in the US. At Barclays, it was basically flat. And so, Venkat in that interview was also talking about, again, they're looking at how they can boost that performance. There's no suggestion they're not looking to exit that business or anything, but instead they're going to be sort of investing, looking in the long term. And one thing he said is, I think they need deeper kind of client franchise, client relationships. So I think there's a sense that, quarter to quarter, it's always a very volatile space. But, they're there for the long term, and I think you'll probably see Barclays continue to look to find an edge in that space. But, yeah, right now it's tough competition, and it looks like they're losing out a bit to the US firms.
Okay, talk about losing out. You see what I did there, from banks to luxury. Hermes is actually falling as growth disappoints. Hermes was meant to be the luxury company that could do no wrong.
Exactly. And it's the crucial leather goods division that has disappointed. It's slightly missed earnings. The interesting thing is, Hermes has been very resilient. When times are tough, Hermes is very resilient because it has more demand for its iconic bags that it can actually meet. But the flip side of that is when things get a lot better, it can't produce as much as perhaps the demand is there for. And investors are looking to luxury to rebound. So they've been looking at the names that have been hit more and are perhaps more likely to outperform when times are good.
How are you looking at, so there's Kering tonight. LVMH was actually a little bit better than expected.
Yes, it was.
Is it amongst those three names that will fight it out?
Yes, with Kering, it's been an underperformer. We will be looking for whether there's been any signs of improvement at Gucci, and also the new CEO, Luca De Meo. He's really hit the ground running, but investors will be looking for what he's got to say about things going forward.
Tom, UniCredit, it's pretty good, actually.
That's exactly what I thought, and then of course the shares drop a little bit. So, but yeah, no, I think there's a big expectations around that bank. They've been delivering quarter after quarter, so the shares are up something like 60% this year, so naturally they maybe slide a little bit. But yeah, broadly speaking, looks like they're hitting most of their expectations. I think some analysts were saying, look, when you go under the hood a little bit, there's a little bit less quality in some of that earnings because I think the NII, the net interest income, was somewhat disappointing. But I think, again, this is very sort of rarefied expectations, so perhaps no surprise the stock's slipping a little bit today.
Derek, we'll get to, of course, your wheelhouse of currencies and yen and sterling in a second. But it does seem the earnings picture is not that easy actually to read out because it's really company, focused.
Yeah, very much. And obviously AI is a huge theme in terms of what's driving overall sentiment. And when you look at the consensus for earnings growth over the next 4 quarters, we're still talking 15 to 20% growth for the MAG 7. Much more subdued for the other 493. But, within those expectations, there's certainly nothing priced in terms of a downturn for the economy, a risk-off event or something that kind of results in a reversal in sentiment. So, we're still priced for
perfection.
Perfect.
So you're worried about a possible correction?
Well, 10-year yields are down 50 basis points at the middle of July, and the equity market, the S&P, is up 7.5%. So we see this big divergence. And as we all know, that's very unlikely to last indefinitely. Yeah. One of those will break. And my feeling is that based on pricing, the risks, if the labour market, when we start to get the data, if that shows risks of recession, I think that could be a trigger for a reassessment in terms of growth in the US that results in a correction.
Yeah, and we'll talk a little bit more. It's interesting, Adidas is actually down because of the currency swings, and also L'Oreal was a little bit disappointing because of the U.S. Thank you both, Tom and Andrea. Tom Metcalf, who leads our EMEA finance coverage, Andrea Felsted, Bloomberg columnist for consumer goods and retail. Derek, when you look at, in general, currencies, and it was interesting to have that, actually L'Oreal saying that they are seeing weaker sales in the U.S., Adidas saying, look, the comparison is not that easy. Are you expecting a lot more volatility in currencies, full stop?
Yeah, incredibly, when you look at FX, we had the really big move through until around May, June. And we had, of course, the biggest drop in the dollar in the first half of the year since 1973. And basically since then, DXY has been in a plus minus 2% trading range around 98. So it's pretty subdued. But, I think given what's happening in the equity markets, I think that has been a really important catalyst for bringing down volatility more generally. And, of course, inflation overall is moving in the right direction, a bit stickier in different places, but that kind of movement back towards target in terms of inflation is also helping to reduce overall volatility.
We had steady UK inflation actually here in the UK, and that's kind of cemented what the market thinks of a December rate cut. What are you doing with sterling?
Yes, we have a view at the moment, higher euro sterling, and it's based primarily on our view that they will cut rates in December. So I think today's data obviously reinforces our view. Downside hits on all the key components within CPI. I think it's going to be very difficult in those circumstances for the Bank of England to continue to argue that they can, refrain from easing. So November's too soon, but I think December definitely.
And this is despite the labour market possibly getting worse. I mean, it's always this trade-off, right, that we're seeing with the Fed, which is why the governor was so tentative.
Yeah, obviously from a domestically generated inflation perspective in the UK, it's still sticky wages. Yeah. I think the reason why they pulled away from the quarterly pace in terms of the signal they gave is essentially the labour market. The data that we had more recently was suggesting it wasn't as bad as they had originally thought, and therefore they were a bit concerned about domestically generated inflation being stickier. But I think, the miss that we've got now, plus I think, while the labour market might not be weakening as much as they had expected, the direction of travel is still very clear. And by December, when, between November and December meetings, we'll have 2 CPI reports, we'll have 2 labour market reports, and I think that will be enough to justify a cut in December.
Derek, what happens to gold? We're always on gold watch. I don't know what actually, if even cools off the rally a little bit at this point.
I know, it's incredible. One sign of maybe a bubble in an asset is when the narrative about the fundamentals driving the move change. It's geopolitics, it's the debasement trade, it's sovereign risk, and I think it's become a hugely crowded trade. Obviously, we've had a correction. Asia, we've rebounded from the lows in Asia. I would still say, given what's happened in the credit space and the uncertainties that could linger there for a period, the risks are we could see a bigger correction. But, you know, there is a fundamental story that probably has been consistent all the way through, and that is central bank buying. And China has increased its volume of gold by 20% since the beginning of 2024. But if that stops, then that fundamental story loses a key component.
But Derek, I mean, is that just because they want to sell U.S. assets? And again, it's unclear to me in the data right now how much it has to do with de-dollarization or actually getting away from U.S. assets in general.
I think it is. I think it's obviously fear of the Trump administration using the financial markets as a weapon for getting what it wants. Now, Russia, that's not the example for Russia, but obviously what's happened with Russia at the beginning of the Ukraine war has kind of perked up central banks around the world in terms of the need for diversification. And I think certainly since the Russia-Ukraine war, there's been a clear trend in terms of an increase in demand from central banks.
Derek, yeah, I mean, it's exciting. There's a new prime minister, and she's female for the first time.
Yes.
But what does it mean for assets?
And a first female finance minister, Katayama, who's just spoken this morning. I would agree with Finance Minister Katayama, who this morning said the Takaichi trade is probably done. She didn't use those words, but she implied that. And I would agree. Look, there's a degree of policy continuity that I think will be important for the new administration. And while I think fiscal spending will certainly be increased, the details that we have so far, the initial steps are going to be very much focused on getting the cost of living burden on households down. So that's good for bringing inflation lower. And then strategic investments in areas like defense and AI and tech, which, of course, from a Trump-US-Japan relationship is very important. And the last thing the new administration wants when Trump is visiting next week is for dollar yen to be going through the roof. So I think we're certainly done for now. And my feeling is the BOJ is going to be allowed to conduct its policy. It's already been uber cautious in raising rates.
I mean, you think it's behind the curve?
Yes, yeah. Like if you look at the curves, certainly 230s in JGBs, it's the steepest across G4. And an element of that is certainly investors fearing that they're behind the curve. And we still have inflation. We have inflation data at the end of the week.
So do you think they'll act?
I do, yeah. Obviously, October now is out, but I certainly think December, latest January when we have the updated forecasts. I think by then we have better political stability, and I think we need a rate hike. And it's in the interest of the new administration not to have the yen weakening further. And Katayama implied that today in terms of the damage the yen is doing to household budgets.
Derek, overall, I mean, how do you look at the credit concerns that we're talking about with Tom? Do you worry about financial stability, or do we need to start at least thinking about it?
Oh, yeah, absolutely. Private non-bank lending, getting a handle on that, of course, is very difficult. But what we can say is that even with central bank balance sheets shrinking gradually, liquidity is still hugely abundant. And in that context, it's fueling this very strong risk appetite in a backdrop of such high levels of uncertainty.
But do you worry that the Fed is cutting into this cycle?
There is that risk. There is that risk, definitely. But I think the reason why the Fed have started again to cut is definitely, of course, more the labour market than inflation. And if we're going to start getting negative NFP prints, and if you consider the scale of deceleration in jobs growth over the last 3 months of data that we have, it's very unlikely that the labour market is going to recover on its own. Yeah. It either needs fiscal or monetary stimulus for that to happen. And I think in that context, the Fed continue to cut because of the labour market primarily.
Derek, thank you so much. Derek Halpenny, their global markets head of research at MUFG. Now, coming up, AI company Anthropic is said to be in talks with Google over a deal for cloud computer power worth tens of billions of dollars. We'll discuss that next. This is Bloomberg.
it's important to understand that you are building companies that will define technology for the next 30, 50 years. And it is reasonable to approach that from the perspective of you're going to invest money right now to build intellectual property, to build products, to build mind share, to do all those things. And it will take more than 5, 7, 10, or maybe even 20 years to pay that back. It doesn't matter. And that's a completely reasonable approach to investing.
Well, that was Michael Intraday, the CoreWeave chief executive, speaking about investing in AI infrastructure at the Bloomberg Tech London Summit. Now, Bloomberg understands that Anthropic and Alphabet's Google are in early stage talks about a deal for cloud computing services valued in the high tens of billions of dollars. The agreement would mark the latest in a wave of investment deals and partnerships involving AI firms and cloud providers, which, all told, are set to run into the hundreds of billions of dollars. Well, we're now joined by Adrian Cox, a thematic strategist at Deutsche Bank Research, and Matt Bloxham, our senior tech analyst from Bloomberg Intelligence. So thank you both for joining us. Matt, I mean, this feels like a huge deal, right? I mean, could it actually be a game changer for their competitors?
Not so, I don't think so much a game changer for the competitors, but it keeps Anthropic in the game. Exactly, yeah. It's a bit like a game of poker, and you kind of, someone raises the stakes and you have to decide whether you're going to match it or fold. And clearly it's way too early in the game for anybody to fold, and there's enough money out there to keep them funding people. But, I think you have to question at some point how many different AI platforms is the world going to need, and, is this going to be enough to actually kind of close the gap on the two big leaders, obviously OpenAI and Google with Gemini. They're by far and away the kind of most popular AI platforms, both with consumers and businesses.
I mean, I love this. It's really like, they're almost warring, right? So you have Anthropic teaming up with Google, and then you have OpenAI with a new web browser. Is it too soon to say who's going to win this? Is there only one winner?
I don't think there's one winner, but there's probably a small handful. If you look at history, you do clearly get a dominant player in most industries, and certainly tech industry. Amazon dominates kind of online retail. Google dominates search. It's been a bit more spread on social media platforms, but you still got a heavy dominance towards TikTok and Instagram. So I think it is going to consolidate eventually down to a much smaller number of players than we've got today, and the ones that have already kind of lost a bit of pace on the kind of the big leaders are going to maybe struggle, either have to kind of pivot into a niche, or maybe they'll get kind of rolled up into kind of like an aggregate that is big enough and has enough scale to compete with OpenAI and Google.
Matt, what's your take on Netflix? It's getting slammed today, pre-market.
Yeah, I think that was really kind of a sense of market expectations were pretty full. They had a big slate of content. They had the big boxing match, which drew lots of viewers. So I think, although they grew at 17.5%, which is a great number, people were expecting a bit of a surprise on the upside. We didn't get that, so I think just a bit of profit taking.
Yeah. Adrian, when you look at actually ChatGPT, when you look at OpenAI, all of these agreements, it does feel like Europe is being left out.
Yes, to some extent. I think that that is the big challenge, and why you're seeing a lot of interest in sovereign AI, and the fact that all of the concern a couple of years ago was about AI safety, and now really it's about national security. And so there is this trope that the US innovates and Europe regulates, and I think that we're kind of seeing that. It was interesting, the comment that you made about companies being sucked up or pivoting on their business models, because that's what you saw with Aleph Alpha, which was a German maker of LLMs, which decided they're going to pack it up and really leaving only Mistral in Europe to be able to compete. But there's more to it than that. Obviously, there's not just the models. There's the data centers, there's the capacity to power them, and so on.
I mean, is that where do you find value? If you look at thematic investment, I mean, there's so much talk. Matt writes about this every day, and it's about the big players because that's the sexy stuff. But if you're going in as an investor, are they too expensive? Do you want to get into maybe some of the smaller ones that will be a winner 4, 5, 6 years from now?
Yes, well, knowing where the winners are 4, 5, 6 years from now is
we'll make you quite rich.
somewhat challenging, one would say. But if you have a look at the structure of the market, it's really like almost like a sort of a tree where you have in the roots there are the infrastructure providers, and then going up into the trunk there are the cloud providers, and then in the branches the model makers, and then up at the top in the leaves that's the applications. And in each level of those, you're seeing various pockets of strength, probably firmest at the moment in the infrastructure. In the end, the value, though, will be in those applications, and probably with just 1 or 2 LLMs left really holding the branches up. But most of the applications will fall away along the way.
Adrian, if you look at data centers, is there a worry that there's just going to be overcapacity? I mean, we're talking about like billions and billions of dollars being poured into this. If there's too much money, too many data centers, then it's not a good bet.
Yeah. Well, in a way, what you're asking is the trillion-dollar question. And in a way, there is an interesting bifurcation between people on the AI side, the sort of technology people who are worrying about whether AGI is going to come along, and artificial general intelligence, and then the rest of the world, which is wondering whether there's going to be sufficient demand to justify all of this build-out in data centers. And on the one hand, those data centers, as we saw there from the CEO of CoreWeave, are potentially 20-year investments because they include cooling and buildings and so on, which has a long shelf life. But on the other hand, they're being stuffed with chips which potentially have, maybe a 4-year life until they become obsolete. So it's a tricky balance between those two competing timeframes.
Yeah, how do you view this, Matt? Because again, in our stories, I mean, this is extreme. This is the question, really.
Yeah, it is. I think you do have to break it down because at the kind of infrastructure layer, these things are quite modular. So although you may be building a 1 gigawatt facility, that comes on in phases. So there are various kind of staging points where you know whether the demand is coming, where you can decide whether you're going to fit out the infrastructure. That's maybe a little bit more problematic for the power. If you're talking about small nuclear reactors, you can't just turn these things on. They are multi-year investments. So that's probably kind of where some of the risk is in terms of being confident about the future demand, because once you've got that, I think probably inevitably power is going to kind of find a home somewhere. But if you're putting a nuclear facility, next to a data center and the data doesn't need it, you've got problems about how you distribute that back into the kind of main grid. So there is a bit of a risk of stranded assets there. And as we were saying, that the applications is probably where, as a venture capitalist or a kind of early stage investor, it's probably a more interesting space to be involved in right now, because applications are becoming agents essentially, and it's that agent space where there's probably going to be a lot of really interesting stuff over the next 2 or 3 years.
So Adrian's timing, basically.
Yes, exactly. It's funny. I did a report recently where I looked back at an old Bloomberg story from 1998 with someone saying in November that year that he said, this is an enormous bubble. This is going to make the bio whatever it was, bubble of early 1990s look like a picnic. But of course, at the time, the NASDAQ was at 2,000 and eventually reached 5,000.
You always go back in history, and it shows you a lot of things that maybe we're missing right now. Adrian, thank you so much. Adrian Cox, thematic strategist at Deutsche Bank Research, and Bloomberg's intelligence analyst, Matt Bloxham. Coming up, we'll be joined by Anna Rosenberg from the Amundi Investment Institute. We'll talk geopolitics and trade. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Barclays lifts its guidance and launches a £500 million share buyback, but the chief executive tells Bloomberg he's not happy about its exposure to the collapse of subprime auto lender Tricolor Holdings. Bloomberg understands the AI firm Anthropic and Google are in advanced talks over a cloud computing partnership, potentially worth tens of billions of dollars. Plus, Donald Trump signals uncertainty over a second meeting with Vladimir Putin, saying he does not want a wasted summit. We discuss how Europe is ramping up pressure on Moscow with Ireland's Minister for Defence and EU Affairs. Now, meanwhile, President Trump says a 155% tariff on Chinese goods will begin on November 1st unless the two nations broker a trade deal. Now, it does come, as he says, a meeting with President Xi Jinping would yield a good deal while tempering expectations. We're now joined by Anna Rosenberg, head of Geopolitics at Amundi Investment Institute, and Brendan Murray, who coordinates our global trade, supply chain, and geoeconomic statecraft coverage from Bloomberg. So I have to say these are like the two busiest people in London trying to figure out our world. Brendan, what we're trying to understand is actually where the U.S. wants to focus next on trade. So there's been quite a lot of turmoil. What do we know that the Treasury Secretary and the President himself want to focus on?
Yeah, exactly. I think these next 2 weeks are probably the most consequential that we're going to see on trade policy in the second Trump term. We've got the Besant meeting in Malaysia with his Chinese counterpart. They need to de-escalate before they can put some things on the table toward a trade deal. We have the sort of on-again, off-again summit between Trump and Xi. Is it going to happen? We don't know. It sounds like it is, but then Trump says recently it may not as well. So what can a trade deal in the short term look like is a huge question. And then a week after that, we have the Supreme Court hearing on the legality of Trump's reciprocal tariffs, which could throw the whole thing, all the negotiations, the bilateral ones, the deals that are in the works with all sorts of countries. So a lot of the turbulence is behind us, but there's plenty ahead of us as well.
So, and I mean, the million-dollar question that we've been asking since Liberation Day is trade is trade actually changing diplomacy, or is diplomacy changing trade? Like, what do we know the U.S. administration wants?
Well, I think we are in a different geopolitical order, right? And it's not anymore about efficiency, it's about security. And we have seen, as a result, a lot of economic friction. And this is not new. This didn't start with the Trump administration. We've seen more protectionism, more sanctions and export controls. And that already shaped and changed global trade over the last few years, right? And so now we have a lot more economic friction, and more is likely to come. So what we're seeing now is actually an attempt by diplomacy to make up for the disruption of the old world order, if you will. And we're seeing a lot new trade negotiations happening between partners that have strategic interests in common, right? For example, the EU is talking with many different countries and regions on trade, with Mercosur, India, Indonesia. The Indians as well are having a lot of new trade discussions, right? They signed the deal with the UK, and we're having negotiations with the EU, negotiations with Brazil and Mercosur too. Everyone is trying to sign new side deals, if you will, to compensate for the global disruption. And as a result, I think trade is going to continue to flow. We're not deglobalizing, but it's changing how it is flowing.
But to you both, is this going Trump's way? Because the disruption is self-inflicted, but are they happy about it?
Well, I mean, I think Trump's way is to get reciprocity, right? He wants to reduce the trade deficit. That's what he cares about. It's not necessarily going his way. He's getting some better deals overall. But all in all, comes at a cost, comes at a price to U.S. consumers. And I think we'll see by next year at the ballot box if this is in his interest or not.
How do you see it, Brendan? I mean, I was struck, I know you were at the IMF, I was struck by the IMF Director General saying that trade is like water, that actually even if there's a blockage, it still finds its way to where it needs to be.
Yeah, exactly. But if you look at the amount of trade that the U.S. does with the rest of the world, the three big countries are China, Canada, and Mexico. We don't have a deal with China. We're going to renegotiate USMCA over the next 6 months. And so without any clarity on those three major U.S. trading partners, then the whole trading relationship that the U.S. has really won't change fundamentally. Yes, you can sign some deals with the UK and the EU, and you can kind of change things on the margins, but those are the three that count the most. President Trump would say, look at the stock market. I'm winning. I must be winning. But there are a lot of small businesses that are getting crushed by these tariffs. The number that I saw yesterday from a center-right think tank was $85 billion a year. That's $233 million a day just in the direct tariff costs, not the extra manpower it takes, the extra hours to comply and all that. So it's helping big companies. At least that's the way the market sees it. But it's really crushing the little guy.
Anna, how's Europe doing? Again, Europe has a difficult choice because they suddenly almost realize that they're very reliant on the U.S., maybe not the most reliable ally or partner right now, but they're also very reliant on China. So can they actually be more standalone?
Well, it's tough, isn't it? They are very dependent on the U.S. also for security and for AI, and they're very reliant on China for rare earths and for exports. So they are in the middle. But ultimately, it's a classic middle power, and it can benefit from trying to navigate both relationships and playing each other off. But it's not an easy time, absolutely not. I think what Europe has done more successfully than what we give it credit for is they've become quite successful at managing Trump and at getting him to align with European interests again, right? And we've seen this very clearly around Ukraine, for example. So I think it's a tough situation to be in. As a result, they are diversifying as much as possible with all these trade deals that I mentioned earlier. But ultimately, they're trying to muddle through.
Yeah, and when you look at Europe, again, is there anything that they can sign on rare earths? Rare earths is coming back. Do we know if the U.S., I mean, it's unclear whether the two presidents meet.
Yeah, exactly. So the rare earths news that China announced just a couple weeks ago, the sort of expansion of their rare earths export controls, really was not just targeted at the U.S., but it sent a message to capitals all over the place, and the Europeans included, who said, okay, well, maybe they do have a bit more leverage than we thought they had, or at least they're willing to use it. And so that has sort of coalesced some of the trade policy thinkers in Brussels to say, you know, we may need to take this a little bit more seriously. Maybe not to the extreme that Donald Trump does, but maybe we need to. We have something in common here that we could work with the Americans on.
I think that the issue around rare earths is that everyone is highly dependent on it, and there have not been enough efforts to try and diversify away from them. This has been well known for a while, but neither the US nor Europe have done a lot, and it will take time. This is not a quick fix. You need new alliances in different types of rare earths, light and heavy, and things like that. So it will be quite a big undertaking to diversify away from that. Right.
And I also want to talk about foreign policy, because actually it's incredible. I mean, we're like 10 days away from that peace deal in Gaza that is now faltering. Yeah. Would the Trump administration see this as a success nonetheless?
I think it's still being seen as a success in the sense that the first part, getting those hostages out, is a big deal, and stopping the big fighting in the first place is something that we have to recognize. But it was always difficult from here, because ultimately the aim to disarm a militant organization, Hamas, is going to be very difficult, because the whole raison d'etre of a militant organization is to be armed, right? And then we have elections in Israel coming up, so there's a lot of risk still there. But ultimately, we have to also keep in mind that the Israeli army is exhausted at this point. Hamas is exhausted. So it remains volatile in a tinderbox, but for now, the first phase, I think, is something that he deserves credit for.
I mean, does it embolden him in trying to find a solution for Ukraine? Again, I mean, this was like a week where there was a lot of diplomacy, shuttle backwards and forwards. He spoke to Vladimir Putin. It's unclear where the president stands on this.
He really wants to find a solution for Ukraine, but he cannot, because it's simply that all the goals do not overlap. Neither the US goals, nor Ukraine's goals, nor Europe's goals, nor Russia's goals, they don't overlap. And ultimately, I think Trump is torn between his personal relationship to Putin, he believes in him, and then American interests, the fact that Russia is an enemy. And he constantly flip-flops as a result of that. But ultimately, it means he will not walk away from Ukraine. He will also not put undue pressure, or let's say very heavy pressure on Russia, economic pressure on Russia. So ultimately, the continuation of the status quo is the most likely, until there's so much economic pressure on Russia that they think now it's time to sit down and find a solution to this, and we're not there yet.
And Europe is not faltering?
Europe is not faltering, because ultimately for Europe, the biggest security and defense for Europe is that Ukraine remains heavily militarized. That's it. They don't really have a choice. So they have to continue supporting Ukraine.
We're just getting some breaking news, actually. A China chip maker, YMTC, said to be mulling an IPO as soon as next year. Now, this is according to people familiar with the matter and what could be one of the biggest listings there in years. But it's also, I believe, a company that was put on a blacklist from the U.S. Is this just going to be a tit for tat in terms of blacklists and for chip makers?
Yeah, exactly. In the same way that the U.S. needs Chinese rare earths, China needs American high technology, and so we're going to see this tug of war continue unless the leaders can get together in a week or so and try to ratchet things down, or at least call a ceasefire, but this is going to go on, indefinitely.
Brenda, do we know what China wants in these negotiations?
China wants, they probably want a lot of things. They want the fentanyl tariffs to go away. It's going to take, some sort of show of force on the enforcement side for China to show President Trump that they're doing something about the illegal flow of fentanyl and its raw materials. China wants a relaxation of those September 29th expanded export controls from the Commerce Department. That really angered them. They don't like the fees on Chinese-made ships. That's going to disrupt the flow of their state-run carriers. So China has some things that's the real question. We know what Trump wants, but China has what many people would say has the stronger hand at the moment, and we'll see. The subject of Taiwan has come up as on the table in these talks. So who knows how the discussion could go there? But China's got a lot of leverage right now, and they could be ready to use it as well.
What a great conversation. Thank you both for joining us. Anna Rosenberg, head of Geopolitics at Amundi Investment Institute, and our very own Brendan Murray. Now, the UK's ambition to become a global leader in life sciences is putting to the test in Cambridge, where rapid development at its biomedical campus is being hit by struggling local infrastructure. Despite major investments from companies like Prologis and the presence of pharma giant AstraZeneca, basic utilities like wastewater treatment are having problems keeping pace. Well, we're joined by Ashley Furlong, who covers health and pharmaceuticals for us. Ashley, can you walk us through exactly what's happening, for example, with the sewage system in Cambridge?
So what we're seeing in Cambridge is that Anglian Water, the company responsible for wastewater in Cambridge, says they just don't have extra capacity. And that's a problem mainly for companies, because homes, for example, Anglian Water has to take that waste, but they don't have to take waste called trade effluent, which is what a pharmaceutical company, for example, or biotech with a laboratory in Cambridge might be producing. So what developers are telling us is that this is a blockage for them. So they're having to find alternative solutions. For example, Prologis has said that they have built massive tanks beneath a new facility. Other developers say that that's not going to be a possibility for them, but it's sort of hindering investment and making it harder to attract tenants in what's already a very difficult environment for life sciences in the UK.
Actually, is this part of a wider problem in the UK?
Yes, very much so. So it's a problem both for life sciences and for the infrastructure question. So maybe just on the infrastructure question, firstly, we're seeing in the UK massive problems with the ability to process wastewater. So you'll know when there's heavy rains, there might be flooding into rivers, which you might see sewage in rivers. In the summer, you might not be able to swim in the sea. There might be sewage in the sea. So that's sort of one issue. But more broadly, what we're seeing is difficulties with UK life sciences and the ability to attract investment. So we're seeing the UK pharma company AstraZeneca say that they are halting a planned expansion of their facility in Cambridge. We're seeing Merck, the US pharma company, pulling out of plans for facility in London. So we're sort of seeing a very much a concern that the UK is just not attractive enough as a place for life sciences companies to invest. And obviously the sewage problem is just making it even more difficult.
Ashley, thanks so much. Ashley Furlong there with a great story that I know will be of much interest to many of our viewers and listeners. Coming up, with Donald Trump saying he does not want a wasted meeting with Putin, we discuss how the EU is looking to ramp up pressure on Moscow. The Irish Minister for Defence and EU Affairs joins us next, live from Brussels, and this is Bloomberg.
A powerful pitch can unlock transformative growth. Having at least 1 million pre-launch equips companies with a 25% higher likelihood of success.
You're coming from a world that is quite far separated from venture capital. Building up the skills was an important part of that journey. Not just my own area of physics, but things on the business side.
The right expertise can move your business forward. Search Turning Point, brought to you by HSBC and Bloomberg Media Studios to find out more.
Around the late 70s, Vietnam was actually the poorest country in the world by GDP per capita. See where it is right now.
New Vietnam is all about youthful energy, it's about reinvention, and it's about determination.
The private sector is going to be the key driver. There will be a lot of startups come into the market to seek for new funding.
The best thing is to feel it and see it.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, European nations are working with Ukraine on a 12-point proposal to end Russia's war along current battle lines. Moscow has so far rejected the idea, despite incurring massive casualties in the war that's now in its fourth year. It comes as President Trump says he does not want to have a wasted meeting with Vladimir Putin, in a sign that a summit between the two leaders may not happen. Let's discuss the European position with Thomas Byrne, the Irish Minister for State for Defence and European Affairs. Minister Byrne, thank you for joining us. Should we actually expect, Minister, EU leaders to agree on the next sanctions package on Russia?
Well, I hope so, because I think it's really, really important that the European Union continues to use its leverage against Russia and the power and the strength that we have in order to help Ukraine and protect the people of Ukraine who are basically fighting and defending their European democracy. So we've agreed on numerous sanctions packages. They all require unanimity. Every member state has its own specificities. And I think we will get there, and we've got there so often before.
Will the package include accessing frozen Russian assets?
Look, I think that's very, very important. Clearly, it has specific implications for Belgium, and that's very understandable. So I think what will happen at the leaders' meeting is the leaders will have a good discussion. And from that, then, I would hope to see the Commission coming forward with proposals on this, that we can actually use that leverage that we have in the interests of Ukraine, in the interest of protecting their right as an independent country to survive and exist and prosper.
But, Minister, is there an issue for Ireland as a neutral country, for example, if that money is used to buy weapons for Ukraine?
Look, Ireland's a neutral country in the sense that we're not part of any military alliance, and we have given significant support to Ukraine, whether that's the fact that 2% of our own population is a Ukrainian refugee, but also we've given a huge amount of support in terms of defensive weapons. And we're able to work out a system with the Ukrainian government, with the European Union and with European Union partners to make sure that our specificities, and every country has them, are not affected. And I'm sure that we can work this one through as well. I've no doubt about that, because we've given significant support to Ukraine. They are entitled under international law to defend themselves, and I don't think anybody could object to that.
Minister, where do you think President Trump is on his, relationship or friendship with Vladimir Putin? How problematic would it be for you and European colleagues if a face-to-face meeting were to happen between the two leaders?
I don't think anybody from the European Union has suggested that we would have a problem if President Trump meets President Putin, particularly in the interest of peace. What I think is very, very important is that the European Union continues our strong relationship with the United States. That's at the level of the leadership of the European Union, but also the member states as well. Our own Taoiseach Micheál Martin was one of the first visitors to the White House. We've seen Finnish President Stubb engaging significantly with President Trump and other leaders, including, of course, President Zelensky. So we need to keep up close contact, close relations with the United States. We're, like-minded democracies, we're like-minded peoples, and at the end of the day, I think we achieve much more together. And I think President Trump sees that as well, because we've seen his engagements with the European Union in recent times have been quite positive, quite proactive. Yes, we had the issue with trade, but again, we've sorted that so far. So I think continuing to work closely with the United States is in everybody's interests. And again, I really believe that Ukraine sees that as well, because they have obviously stuck very close to the US despite difficulties in the relationship.
But what do you think would emerge from a one-to-one Trump-Putin meeting?
I don't know, but what I would be suggesting is that, President Putin would be reminded that he's conducting an illegal war of aggression against Ukraine. I think that's the first principle, and that no country has the right to do what he's doing, and that he should stop, and that there should be peace, and that he and Russia should be held accountable for what he's doing. And I think until that happens, we as a European Union must continue to use our strong leverage. I think it's really, really important that Ukraine is allowed to survive as a nation, is allowed ultimately to join the European Union, to make its own choices about defence, and to make sure that its peace and security are protected and guaranteed. I think that ultimately Ukraine has to join the European Union. That's important for them. But I think it's also important for all the rest of us as well. And as European Affairs Minister of Ireland, that's something that I'm particularly close to. and I think that we should keep it as a priority, and certainly for our presidency of the Council of the European Union next year, that will be a significant priority.
Minister, the EU has been affected by China ramping up some of the export curbs on rare earth materials. Would you support retaliatory measures against China?
Look, I think what China has to do is stop this, and China has to comply with the WTO rules. I was at a meeting of the G20 trade ministers only 2 weeks ago in South Africa, and everybody around that table, Ireland is a guest country, but everybody around that table was supporting the WTO in principle. So China should stick to the rules there. I think what Ireland would say is that we have full confidence in Commissioner Maroš Šefčovič. He is one of the busiest commissioners at the moment. There seems to be a trade issue all over the world at the moment, and Commissioner Šefčovič is not only dealing with problems that arise in the case of the US, for example, and China, but also looking for opportunities for the European Union as well in trade. And I think that's really, really important. So the Commission have competence on trade. They will consult with Member States. We will support what the Commission does. At the end of the day, China itself depends on a global market for its goods, and I think that they will have to bear that in mind as well in all of this. Trade is always a two-way street, and I don't think that any country benefits from bringing in unilateral measures on trade, especially if there are countries like China that depend on the rest of the world to buy their products.
What do you think Europe needs to now do to be more competitive?
We've a lot to do. I would like to see the simplification agenda move forward. I mean, it has the support of the Commission and the Member States. I think the European Parliament, needs to come to the table. It is working on these issues, but we need to work more closely with the Parliament to get some of these administrative burdens reduced that we've committed to doing. I think we have to get that capital markets union, as we call it, the savings and investment union, up and running around the European Union as well, and get some of that investment into the EU, which is at the moment going outside the European Union. I think there's a huge agenda as well on housing. Housing has shot up really, I think, to the leaders' agenda very, very quickly. I know the Cypriot presidency have told me that they will have it as a priority. Ireland will certainly have housing up there next year. And many people around the council table yesterday in Luxembourg at the General Affairs Council, preparing for the leaders' meeting, were talking about the importance of housing. And what we're looking for is a simplification of some of the rules that are there. What we're also looking for as well is a simplification of the state aid rules. We've seen in Ireland a lot of judicial reviews on planning permission, arguing legal points, ultimately coming mostly from European law to prevent developments going ahead. So we've got to make sure the rules are fair and that we work towards the common good. And in my view, housing is very much part of the common good. And we certainly want the European Union to follow on from what, of course, President von der Leyen committed to in her State of the Union. I think the discussion at the leaders' meeting will be very important because housing is a key part of our competitiveness. Our employees, our workers, everybody needs to find a home. Investors, investing in the European Union need to make sure that their employees can find a home as well. So I think it should be a key focus for the time ahead.
Minister, I know Germany floated this idea of a pan-European stock exchange. Is it something that Ireland would support?
Well, we're certainly interested in looking to any proposals that will enhance our competitiveness, enhance our offering as a European Union. We don't jump in on every single proposal straight away. We consider them carefully. But I think we certainly do need more investment within the European Union. There's a huge amount of savings out there, a lot of which goes to America. Some of our greatest entrepreneurs see it as the ultimate sign of success to have success in the United States. We need them to think as well about having huge success within the European Union. We are the biggest single market in the world. We are the most prosperous economy, but we can do a huge amount more. And if we bring some of that investment together within the European Union, I think we can achieve a lot. So, look, there's a lot of proposals on the table, and we'll certainly consider all of them that come forward that can meet those goals.
Minister, we're almost running out of time, but actually there's a series of things to do with climate issues in the last couple of weeks that have been pushed back, be it the new carbon market or actually, the proposal to give companies another 6 months to comply with curb deforestation laws. Are you worried that the EU is giving up on its climate ambitions?
No, I'm not worried about that because I think the EU is more committed than anybody to achieving our climate ambitions. Why? Because it's absolutely necessary for the survival of the planet. So, we have to take that as the starting premise. We also have to make sure, though, that companies and citizens can work through this, because it is a big transition, it is a big change. We've seen in Ireland, and this has been acknowledged by the Commission now, significant energy costs to our consumers and to our businesses as we deal with that transition. So we look forward to proposals coming from the Commission to deal with that, but no, our climate ambition must be top for agenda.
Minister, thank you so much for your time today. Thomas Byrne there, the Irish Minister for Defence and EU Affairs. Up next, Bloomberg Brief. It's a big stock market day. Look, stocks really struggling for direction because we've had quite a lot of mixed earnings. This is Bloomberg.
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
News when you want it with Bloomberg News Now. I'm Nathan Hager. Trading day is underway on this Wednesday morning. That is the sound of the opening bell from the floor of the New York Stock Exchange. And at the open, stocks are kind of looking for direction. The S&P 500 is up nearly 0.1%, a gain of about 5 points at the open. The Dow Jones Industrial Average is little change to the downside, a drop of almost 20 points. The NASDAQ Composite opens little change to lower as well, down about 14 points. The 10-year Treasury is little changed at 3.96%, but gold is sinking once again, adding to its declines following the worst rout in more than a dozen years. Mike McGlone covers commodities for Bloomberg Intelligence.
Bull markets get stretched, and there's an old saying in markets, you're supposed to be selling when you're yelling, and there's the essence of the business is taking profits, and we're seeing some of this. So particularly those of us who've been too bullish gold for too long, what you see happening this year is one of the most extreme stretches above any major moving average, it's say 60 months in 45 years.
Mike McGlone with Bloomberg Intelligence. And at the open of cash trading, COMEX gold is down nearly 1%, trading below $4,100 an ounce. Oil is jumping on a report that India is close to a deal with the U.S. that would see it gradually reduce its imports of Russian crude. The Mint newspaper is reporting the deal could cut India's tariff rate from 50 to around 15 to 16%. Brendan Murray is Bloomberg's global trade czar.
And this deal has been months in the making, and it would be a significant step. The U.S. and India have tried to make a deal in various phases, 3 and 4 phases over the next 6 months or so. But it looks like that first phase might be coming together if we can believe this report.
That's Bloomberg's Brendan Murray. And right now, West Texas Intermediate crude is higher by 2.3%. Brent is up 2.1%. It's day 22 of the government shutdown in Washington, and Republicans and Democrats don't appear any closer to resolving the standoff. Bloomberg Government's Jack Fitzpatrick has the update.
You heard the president's comments yesterday saying Republicans will not be extorted. They are determined not to negotiate during a shutdown on the health subsidies that Democrats have brought up and warned are going to expire at the end of the year.
Bloomberg Government's Jack Fitzpatrick reports it is now the second longest government shutdown in U.S. history. President Trump's about to leave the fight behind. He's headed to the APEC summit at the end of this week. U.S. Trade Representative Jamieson Greer says he and Treasury Secretary Scott Bessent are on their way to Malaysia today for talks with Chinese officials ahead of a possible meeting between Presidents Trump and Xi Jinping.
There's a spot for it on the schedule if it happens. Obviously, it's a mutual decision as to whether President Xi and President Trump meet together.
USTR Jamieson Greer spoke on CNBC. President Trump has said China's tariff rate could jump to 155% if he doesn't reach a deal. Vice President J.D. Vance is meeting today with Israeli Prime Minister Benjamin Netanyahu, looking to keep the Hamas ceasefire intact.
We have a very, very tough task ahead of us, which is to disarm Hamas but rebuild Gaza, to make life better for the people in Gaza, but also to ensure that Hamas is no longer a threat to our friends in Israel.
Vice President J.D. Vance speaking in Tel Aviv. Bloomberg's Ethan Bronner is there and says Secretary of State Marco Rubio will be in the region tomorrow.
This is a surprising parade of very senior U.S. officials who are basically babysitting this thing, trying to make sure that the Israelis don't overstep in retaliating against Hamas, and also sending a message to Hamas and the region that this is not a one-off, that they're very serious about it. Will that be enough? We don't know.
Bloomberg's Ethan Bronner in Tel Aviv. Later today, President Trump meets with NATO Secretary General Mark Rutte at the White House as the war in Ukraine rages on. Russia unleashed a wave of missile and drone attacks overnight after the president cast doubt on a summit with Vladimir Putin, saying he wouldn't want to waste time meeting with the Russian leader in Budapest if he won't agree to a ceasefire in Ukraine. Turning back to markets, AT&T shares are lower at the open, down more than 5%, even though the company added more mobile and home internet internet subscribers in the latest quarter. AT&T did run a lot of promotions during that period. Netflix is down more than 8% following its earnings. Matthew Bloxham covers media for Bloomberg Intelligence.
People were expecting something a bit better than what they delivered on the back of that slate of popular and well-received content, which also included a widely viewed live boxing event. So I think people just thought they'd done enough to boost the momentum just a bit more than they'd guided to, and we just saw it in line.
Matt Bloxham of Bloomberg Intelligence also says the streamer reported a $600 million tax hit in Brazil. After the close of trading today, we'll get earnings from Tesla. That stock has more than doubled in the last 12 months. Elon Musk has focused investor attention on the autonomous future over falling present profits. And at the open, Tesla shares are little changed. Beyond Meat is up nearly 50% at the open. The plant-based meat maker may be the latest meme stock. It's up nearly 1,300% in the last 4 days. And that's news when you want it with Bloomberg News Now. I'm Nathan Hager. This is Bloomberg.
When the rest of the markets slow down, the futures market keeps moving. Did you know that CME Group S&P 500 and NASDAQ 100 futures trade nearly 24 hours with great liquidity? In the ETF markets, volume and liquidity lessens after 4 p.m. until the next morning. But with futures, you get trading opportunities both day and night. Learn more at cmegroup.com/equity-futures.
Hello, I'm Caroline Hepker, introducing you to the new Stock Movers report from Bloomberg. There are so many big names in equities to keep track of, and our Stock Movers report is the best way to find out which individual names are making the biggest moves every day. Stock Movers consists of short audio reports, they're 5 minutes or less, delivered right to your podcast feed throughout the day. We'll bring you conversations on the day's biggest winners and losers in equity markets and explain the news and the data that's driving those gains and losses. Listen a couple of times throughout the day to find out what's moving equities and why. Just search for Stock Movers on Spotify, Apple Podcasts, or anywhere you listen. Get the latest stock news and data backed by reporting from Bloomberg's 3,000 journalists and analysts across the globe. Subscribe to Stock Movers wherever you get your podcasts.
biggest banks were looking at a 19% jump in their capital requirements, which they were quite livid about, pushed back forcefully on. This revised proposal, the early calculations are looking at a 3 to 7% increase in the capital that they'd have to hold. So much reduced. And, there was a compromise version that was floated last year with a 9% increase, so even below that. So the devil's always in the details. These proposals can run thousands of pages, and this is just a broad outline of what they want to do, but certainly it's in the directions that banks want.
How big of a gulf is that between 3 and 7%? Mm-hmm. What would those numbers mean, and how would their fortunes change on either end for the big banks?
Yeah, and that's an aggregate number. Individual banks could be looking based on their business mix and looking at different figures. We said some of the ones with larger trading portfolios, it could be even lower than that 3% figure. So I think it'll depend on which bank and a lot of the details that will come through. The proposal is not expected until the first half of next year. So I think you are going to see a lot of questions, but certainly banks will be encouraged by this direction.
Good morning. A very good morning. We kick off the programme with earnings out of Amsterdam from the Dutch brewer Heineken, of course. They say that their third quarter adjusted net revenue comes in at 7.3 billion euros. The expectation was for 7.36 billion euros. So an ever so slight miss there. They see full year adjusted operating profit at the low end of 4 to 8% growth. They expect volume to decline modestly for the current year of 2025. And they see organic operating profit growth at the lower end of 4%. So those results just coming in from Heineken. We had a Morgan Stanley analyst saying that pretty much everything that can go wrong for Heineken has gone wrong in the third quarter. But these numbers not looking too bad. We've had a redhead just now in terms of organic beer volumes falling 4.3%. The estimate was for a fall of 4.52%. So not quite as bad as had been expected. We also have breaking earnings out of Milan from UniCredit, kicking off European bank earnings season. Revenue for the third quarter coming in at 6.17 billion euros. The estimate was for 6 billion euros, so a beat there. Net income of 2.66 billion euros. The estimate was for 2.39 billion euros. Again, a beat there. And net interest income, of course, all important, coming in at 3.37 billion euros. The estimate was for 3.39 billion euros. So an ever so slight miss when it comes to net interest income. But of course, the Italian government's been mulling windfall taxes on banks in recent months. M&A remains an important theme for European banks, even if UniCredit has abandoned its M&A ambitions on Banco BPM. So we keep an eye on European bank earnings. We've just had the first one, though, that coming from UniCredit. Let's check in on these broader markets. We come into Wednesday with stocks near all-time highs, but futures pointing lower here in Europe. Higher, though, stateside. We've already seen some sign of the fatigue in the Asia session. The MSCI Asia Pacific Index down 0.1%. And if we flip the board over to the cross-asset picture, the top story today has to be in the commodities space. We've seen steep losses for gold and silver yesterday, the biggest intraday decline in more than a dozen years. And it has been this ferocious weeks-long rally. So traders taking a bit of profit. Gold steady now. It's up a touch at $4,129 a troy ounce. But the question remains, is this bull trend done? Now, partly the sell-off had come as the dollar rose on positivity around the US-China trade talks. We have euro-dollar up today at a 116 handle, and we have oil up for a second day as President Trump has stressed that India would wind down its oil purchases from Russia. So Brent trading there at $62 a barrel, and the US 10-year yield at 3.95% as this US government shutdown continues. But let's get a look at how Asian markets are faring this morning. We can go to Winnie Xu in Hong Kong. But just a moment, we are going to come next to the oil inventories, and we can go next to Winnie Xu. So let's get to Winnie Xu now in Hong Kong. And now we're going to go, we are going to go back to the trade story and dive into that. The US President Donald Trump saying that a 155% tariff on Chinese goods will begin on November 1st. It comes as he says that a meeting with China's Xi Jinping would yield a good deal while tempering expectations.
I think we're going to have a very successful meeting. Certainly, there are a lot of people that are waiting for it. Maybe it won't happen. Maybe it won't happen. Things can happen where, for instance, maybe somebody will say, I don't want to meet. It's too nasty. But it's really not nasty. It's just business. And we're going to do a good job representing you people and representing the people of our country.
Let's get to our China correspondent, Min Lo now. Min, we keep debating who's got the upper hand in the US-China trade war. Should we take from the latest China trade data that the US just can't seem to live without Chinese exports? What does that mean for leverage?
Well, if you look at China's trade data, yes, it does seem like Chinese exporters are extremely nimble in shifting their trade flows and looking for alternative markets to reduce their reliance on the U.S. And when you think about what is on China's and U.S.'s wish list, it's semiconductors versus rare earths. And some analysts are saying that the U.S. needs rare earths from China more than China needs semiconductors from the U.S. And some are saying because of the resilient trade, maybe President Xi might be more willing to walk away from a deal if his conditions are not met. Because you think about what China wants, it's not just the high bandwidth memory chips, but the highest end semiconductors for that would be useful for its AI sector. And some are saying there are reasonable signs that maybe President Trump would be more amenable to loosening those trade restrictions than his predecessor Biden, right? Because Trump has so far been willing to cut deals with the likes of Nvidia, offering, allowing them to sell to China in exchange for a portion of their revenue. Of course, China also wants lowering of tariffs to be on par with other countries, and that means the removal of the fentanyl-related tariffs. That would require China to show more signs, even if symbolic ones, that they are doing more to remove or to curb the flow of these ingredients of fentanyl into the U.S. and perhaps maybe committing to buying some soybeans from the U.S. in exchange for lower tariffs. But there are really infinite ways that this talk could, turn out in the end. But President Trump certainly setting the tone for a very successful trade talk with President Xi, he says.
OK, and meanwhile, we've got China trying to calm foreign businesses that its rare earth export controls aren't going to be disruptive. Tell us more, Min.
Yes, clearly China is sort of trying to balance between threatening the U.S. with its rare earth leverage while also calming markets, and especially not to spook investors in China, because yesterday the Vice Minister of Commerce had met with an unusually large numbers of foreign businesses here in China, about 170 foreign businesses and foreign chambers in Beijing. And the message from the Vice Commerce Minister was that these rare earth controls are not meant to disrupt normal trade flows. And China will continue to work with countries as long as these are legitimate transactions in line with Chinese law. China will make sure the flow of rare earths will be smooth. So just within that message, there's also, what is unsaid is that sort of a veiled threat as well to these companies and these other countries, right? That China doesn't want to see the spillover effect to other countries. The message is targeted at the U.S., but at the same time, if other countries start to join the U.S. in this bandwagon to sanction Chinese companies, maybe they could face some delay in rare earths. And case in point is this Dutch chip company in the Netherlands that is owned by a Chinese owner, with the Dutch government seizing control of the company because of the expansion of this U.S. entity rules. China has been retaliating by placing export controls on that particular chip company in the Netherlands.
OK, Min Lo out of Shanghai, we thank you so much as we head towards that potential meeting between Trump and Xi Jinping. Now, I just want to return to those UniCredit earnings that we had out of Milan a few moments ago in the programme and just correct one of the numbers, a key number, in fact, and that is the net income. So it came in for the third quarter at €2.63 billion. The estimate was for €2.39 billion. But unfortunately, we had shown on the screen the incorrect number. And so just to remind you of the correct number there before we get trade on that later in the day. But let's also get to how Asia markets are faring with Winnie Xu in Hong Kong. Winnie, how's everything playing out where you are?
Morning. It seems like we're seeing a bit of a weakness in Asian stocks today, mainly dragged by some of the declines in the technology shares. But here you can also see that leading the region lower are the Hong Kong shares, and actually with the major index down over 1%. So there is still a lot of volatility when it comes to trading Chinese equities. We were just talking about how Trump on one hand say that he is expecting a good deal with China, and on the other hand saying that this meeting with Xi might not even happen. And strategists are also quite divided in terms of how to trade this market, with Morgan Stanley and Nomura saying that not to buy the dip yet, while we just had this note from Goldman Sachs saying that the default mindset for Chinese stocks should be to buy the dip. Now take a look at what's going on in the Japanese markets, because we are seeing that stocks fluctuating a little bit when it comes to kind of trading after Takaichi got elected as the prime minister. We are seeing a bit of kind of profit taking here, and SoftBank here is that big drag when it comes to the dragging the index lower after Texas Instruments actually had a quite disappointing outlook. And also when it comes to cross asset, we are also seeing the yen strengthening just a little bit after weakening for the past 3 days. And it's also coming after how the new prime minister says that tackling inflation is one of the key priorities. Now, we are focusing a lot on what's going on when it comes to gold and silver globally, and we see a bit of that spillover effect into the Asian session as well. You see here Australia's West Gold Resources and also Japan's Sumitomo Metal Mining both down over 5%. So it is that sell-off going on across the globe. But for now, we are hearing from investors that they don't really see a contagious effect to go further, because it's mostly a profit take after a big rally. But we'll see how things go in the European session.
Rennie Shui, thank you so much out of Hong Kong with that update. Now, in the European session, we are going to be looking ahead to lots of the luxury names reporting, but we have seen L'Oreal shares dropping in New York after sales disappointed. US weakness outweighing signs of improvement in China. And we can get more now with Bloomberg's Angelina Rascouet out of Paris, who's watching all of these numbers for us. So, Angelina, disappointing growth overall last quarter for L'Oreal, it looks like.
Yes, indeed, that was the case. I mean, as you mentioned, the U.S. was pretty underwhelming. The CFO explained that in the U.S., L'Oreal tends to be exposed to makeup, which is a category that hasn't been super dynamic lately. And even though China recovered, they grew, it wasn't, I guess, enough to offset the weak U.S. performance. The CEO of L'Oreal, Nicolas Hieronymus, said he remains cautious on China. He didn't want to draw big conclusions from the third quarter numbers alone. He also said the beauty market overall in 2026 is expected to rise slightly more than in 2025, but again, remaining cautious. He was asked about Armani. Remember, L'Oreal has the beauty license for Armani, and it's a very lucrative license. And L'Oreal was named among the preferred bidders for an initial stake sale of 15%. And he said that even though they did a massive deal with Kering this week worth 4 billion euros, that will not prevent them from assessing and exploring their options when it comes to that Armani initial stake sale.
OK, I want to come back to Kering in just a moment. But first, we're going to get a 7 a.m. London time sales data from Hermès, Angelina. So is that likely to follow LVMH's strong lead? And what do you make of the choice of Wales Bonner to lead the menswear line, the latest in this wave of new creative directors?
Absolutely. I mean, Hermès tends to be amongst the most resilient luxury brands out there. I guess its customer base is wealthier. They buy, the exclusive bags that Hermès offers. And so we're expecting growth. However, in the past, we've been used to double-digit growth rates. This time around, we're expecting single-digit growth rate. Still expecting double digits at the crucial unit, which is leather goods and saddlery. We'll see what happens. Basically, analysts said they want to see what the quality of the growth looks like. And so far this year, Hermès shares are actually down, not because it hasn't performed well, but because, the market sort of assesses that it's sort of really highly valued. It's quite expensive. And when it comes to the nomination, absolutely. Hermes last week announced that their menswear designer who held that role for 37 years, Véronique Nichanian, who's 71, will present her last show this January. And yesterday they announced her replacement. She's 35. She's British Jamaican. Her name is Grace Wales Boner. She graduated from Central St. Martin's about 10 years ago. She has her own line. She also did collaborations with Adidas. So, there's that sportswear affinity, I would say. So, it'll be interesting. And it's part of the changing of the guard that we saw in the past year with many, many new designers at Celine, Dior, Chanel being appointed. During this downturn, we need new creativity. We need to generate desire again, and that's what you're doing. However, for Hermes, the new menswear designer, we will have to wait until January 2027 to see her new creations.
All right, Bloomberg's Angelina Rascouet in Paris, we thank you so much. As you mentioned, we are going to get the Kering sales numbers as well. That's at 4:45 p.m. London time. Of course, we've got a new CEO there as well, Luca De Meo. But let's get back to the top story in markets, and that is what's been happening in commodities. Gold and silver have plunged from their record highs, with the yellow metal suffering its biggest intraday fall since 2020. Bloomberg's Valerie Teitel has been tracking all of this for us. Val, what's going on with gold? Is it just a bit of profit-taking, or is this the end of the rally?
Look, most people would say that we were due for a pullback. Gold has essentially risen 30% since the end of August, essentially in a straight line. So the first pullback to this rally happened yesterday. Gold at one point in the session was down over 6%. We closed 5% lower and are just scraping back just tiny those losses overnight and this morning. Now, it's interesting, Lizzie, it's not just gold that was impacted. Silver also saw a retracement. There was also a steep retracement in gold miners. A hotly tracked gold miner ETF, GDX, had its worst fall since March 2020, was down around 10%. So it does feel like some of these momentum trades are being at least cooled down for now. Let's see if that extends in trade today. But it was interesting that this pullback in this commodity trade didn't necessarily have any effect on risk appetite. The broader S&P 500 index essentially closed the session flat yesterday. The attention was more on the earnings that we got after the bell. A lot of disappointment out here, Lizzie. Let's start with Netflix coming out talking about a $600 million hit to operating profit to settle a lawsuit with the Brazilian regulator. So those shares fell off of that disappointment. So we missed on the top line because of that payment to Brazil. Shares were down 6.5% after hours. Now, what executives were trying to claim is that aside from this one-off payment, the results were actually very solid, mostly due to their most popular streamed series now of all time, K-pop Demon Hunters, which I am told by my producer is a must-watch. But executives also wanted to address shareholder concerns that AI-generated video is having an impact on their business. They said, if anything, it's seen the opposite in the last quarter, and that their subscriber engagement was at a record. We also had disappointment from a chip name from Texas Instruments. This one showing that their turnaround in analog chips is not necessarily going as planned. These shares plummeted in after-hours trade, down 8.6%. This is now the second quarter in a row of a disappointing forecast from Texas Instruments. And Liz, you'll be watching the analog chip makers here in Europe at the Open, Infineon being the big one.
All right, Valerie Teitel, we thank you so much. Binge watching the K-pop as always, and Val will be back with us later in the program. But coming up next, UniCredit's third quarter net income beating, and we're going to dig into those earnings. Coming up, this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Let's dive into those UniCredit numbers, shall we? Reporting third quarter profit and revenue that beat analyst estimates, giving a boost to the CEO, Andrea Orcel, after his unsuccessful bid for Banco BPM. We can get more with Lento Tang, who's been looking under the hood here, our senior bank analyst at Bloomberg Intelligence. If you're looking at these, I think they look pretty good, right?
Yeah.
Why haven't they upgraded their guidance?
The result was good, but that's more on the bottom line control rather than the top line.
Okay.
So revenue, as you said, 2% beat, but that is mainly driven by the trading revenue, which we kind of expected it because of good results from the US banks. So we expected trading to be good. If you look at the breakdown of revenues, NII is actually 1% miss. So I think that's kind of what the key line there. So currently consensus is saying the NII is going to bottom in the first half of 2026. So it's very important to see from the management comments on when the bottom will be. I think that will be the key driver. Now, speaking to the bottom line control, so cost and loan loss provisions are really good this quarter. So again, you will see whether that performance is going to continue or not.
Okay, really helpful. Lento Tang, Senior Banks Analyst at Bloomberg Intelligence on those UniCredit earnings. But coming up on the programme, the CFO of Arm comments on the idea of an AI bubble and who might be the winners and losers. We'll get the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe and to tech now. Arm CFO says that the company is the CPU of choice in major artificial intelligence projects from Nvidia to Oracle. Jason Child also told us that today's AI challenge is supply, not demand, and expects both failures and winners to emerge in the sector.
If you back up Stargate, I think they said it was going to be something like $500 billion of total spend over 4 years. As of today, we are the CPU of choice. So if you think of, say, Grace Blackwell, or even in the future, Vera Rubin, Grace and Vera, those are both built on ARM from NVIDIA. And then, of course, to the extent that Oracle's also going to be contributing, that's certainly another partner that we could be helping. And then there's OpenAI, and certainly there's, I guess, rumors of custom efforts by them. And for the most part, most of the custom efforts, there's been a lot of discussion about using ARM-based CPUs to pair with those custom GPUs. So a lot of opportunity, and it could be significant.
The numbers, I mean, you mentioned 500 billion.
Yeah.
The numbers are kind of range from 100 billion to 500 billion.
Yeah.
Is there a risk that the revenues realised won't match some of those larger aims and larger aspirations?
Possibly. We're not super close to the total spend in Stargate, but if you look at what the needs and uses are right now of AI, compute in particular, supply is far behind demand. And so at this point, I think the challenge is really just about, can you get the power, can you get the chips, and can you get the systems deployed? And so, with that kind of a demand cycle, I expect there's a decent chance that you'll see us at the high end of that.
So on that point about supply not meeting demand right now, we've seen these incredible numbers, incredible deals across the infrastructure space from the hyperscalers and OpenAI and many others. On a promised future, but not fully realised yet, does it concern you? I mean, are we seeing an AI bubble?
Okay, so when I think about bubbles, I think about, I was actually at Amazon back in 99, 2000 when things were getting frothy, I think they said. What was interesting there is there was a bunch of build-out, but a lot of that build-out wasn't really being deployed or wasn't being fully utilized. If you think about all the servers, all the websites, the shipping capacity, et cetera. What's different in this cycle is the problem we have right now is supply, not demand. That was really more of a demand issue. This is really, right now, our challenge is supply. So I think the question is going to be, is there going to be a situation where you have a bunch of companies that probably have raised capital and maybe are pre-revenue? Is there a bunch of those companies that maybe won't make it out? So are they going to be the Pets.com or Home Grocer or Webvan or whatever? Sure, that certainly could happen. But are there also going to be the equivalents of Amazon, Google, eBay, Yahoo, these other companies that actually were, quite large and became, pretty huge companies? I expect that to happen as well. So how we define bubble and who's the winners and losers, I think that's all to be seen.
So that was the ARM CFO Jason Childs speaking to our very own Tom McKenzie on the sidelines of Bloomberg Tech London. And we've got some significant tech earnings coming up today, not least SAP and Tesla, as we look at futures pointing higher stateside, but a touch lower here in Europe. Eurostoxx 50 futures down 0.4%. But coming up next here on Bloomberg Daybreak Europe, the much talked about summit between Presidents Trump and Vladimir Putin may not happen. We'll get you all the details on the geopolitics next. So stay with us. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. The gold rout easing after suffering its biggest intraday drop in more than 12 years, while Asian stocks fall as the equity rally on Wall Street shows signs of fatigue. Elsewhere, Donald Trump says that his meeting with Chinese President Xi Jinping may not happen as the trade deal deadline approaches. The US president also casting doubt on a second meeting with Vladimir Putin. And UniCredit's profit beat. Italy's second biggest bank sees net income rising almost 5% on higher dividends, giving a boost to the CEO Andrea Orcel after his unsuccessful bid for Banco BPM. Well, a very good morning. If you are just joining us, it's just 6:30 a.m. here in London, and we're looking at futures pointing higher stateside but lower here in Europe. We've already seen a bit of fatigue in the Asian session. The MSCI Asia Pacific Index paring some of its earlier losses, now down just 0.1%. But if we flip the board over to the cross-asset picture, we saw these steep losses when it comes to silver and gold yesterday, the biggest intraday decline for gold in more than a dozen years, and this after what really has been a ferocious weeks-long rally. So traders seemingly taking a bit of profit, the rout showing signs of easing now, but the question remains, is this bull trend done? Now, partly the sell-off had come as the dollar rose on the positivity around the US-China trade talks. You can see euro-dollar on the up today at 116 and the 10-year yield at 396.65 at the moment. The US government shutdown, of course, continuing. It's on the verge of becoming the second longest on record, and we have oil up for a second day as the president stresses that India is going to wind down its oil purchases from Russia. So Brent there at $62 a barrel. But let's get to the UK now, because the Bank of England governor is warning of parallels between the private credit boom now and the subprime debt crisis during the financial crisis. Andrew Bailey said that the alarm bells are ringing, and he was giving evidence to a UK parliamentary committee. This is after officials confirmed plans to stress test the private credit market.
We certainly are beginning to see, for instance, what used to be called sort of slicing and dicing and tranching of loan structures, for instance, going on. And if you're involved before the financial crisis or during it, alarm bells start going off at that point. I sat in a session with people from the private equity and private credit world some months ago, who of course told me that everything was fine in their world apart from the role of the rating agencies. And I said, well, we're not playing that movie again, are we?
Let's get more now with Bloomberg's Valerie Teitel. Val, we heard cockroaches from Jamie Dimon, a canary in the coal mine from Andrew Bailey. Just the fact that everyone's talking about private credit, even if they choose different animals, show that these concerns are really building.
Oh, yes. Well, Bailey's comments yesterday, I think, adds fuel to those worries. He especially was concerned after the collapses of Tricolor and First Brands of the U.S., what that could tell us about the very opaque private credit market. And I think the thing that's concerning, at least for Bailey and the regulators here, is we still don't even really know the size of the private credit market. The latest estimates put the size of the U.S. private credit market over $1 trillion, but it's really an opaque sector. And I think the worry for the Bank of England and for Bailey specifically is that they really want to answer the question, if we get a shock, shock to private credit, if we see substantial write-downs in these loans, is that a shock that is contained, or is it amplified like what we saw in the subprime crisis during the financial crisis? Now, Bailey is essentially saying that, look, we got it very wrong back in 2008. Everyone told us subprime would be contained. It ended up not being. It ended up being very amplified throughout the financial system. Essentially, they don't want a repeat of that. So that is why they're looking at these stress tests. We haven't gotten very many details on how they expect to perform them, but the details is that these are something they likely will be launching in the next 9 to 12 months, with details coming shortly. But essentially, this is really the Bank of England being on the forefront of these warnings. It was only a few weeks ago the Bank of England warned that there could be a sharp correction in the equity market due to stretched AI valuations. So they seem to really be on the forefront, at least, of worrying about drawdowns in the industry.
Well, we're going to pick up on that worry about the stretched valuations later in the programme with our tech guest. But Bloomberg's Valerie Teitel, thank you so much for breaking it all down, as always. Now, President Trump says that he does not want to have a wasted meeting with Vladimir Putin, in a sign that the summit between the two leaders may not happen. The US leader has, however, reiterated his desire to see the current battlefield lines in Ukraine frozen as part of any ceasefire agreement that is reached. But that has been rejected by the Kremlin. So let's bring it all together. We can bring in Bloomberg's Russia economy and government editor Greg Sullivan. He's with us now for more. Greg, you've got the Financial Times reporting that this Trump-Putin summit is cancelled. Is it just in jeopardy? What's the latest?
Well, before this even, we had Russia really tamping down expectations for this summit. We heard that they would take challenging and work and a lot of preparation leading up to it. And now we have Donald Trump casting doubt on it himself. What seems to have happened is that Russia's Foreign Minister Sergei Lavrov held a call with U.S. Secretary of State Marco Rubio that was intended to plan on preparations for this intended summit. Obviously, the call did not yield much. There's no plans for the two to meet. But really what we have is Russia not really moving away from their maximalist demands. They've tamped down expectations for a ceasefire. They've thrown cold water on that demand from President Trump. They don't want a ceasefire right now. So it's unclear what, if the summit was held, President Trump would actually walk away with. So now President Trump is potentially reassessing the situation, realizing he might walk away empty-handed from yet a second summit with President Putin, and reassessing whether this can happen. Of course, things can change. We saw that President Putin was able to get Trump on the phone ahead of his Zelensky meeting. So again, things could change quickly. But as for now, there does seem to be a lot of doubt over what Russia is actually willing to offer, and if they're even ready for a ceasefire, barring further pressure.
Well, the Europeans, Greg, are preparing for a ceasefire. We have these latest ceasefire proposals from the European leaders to try to end the war. Just talk us through what's actually in this 12-point plan for peace.
Well, a few things. One, the plan does call for the conflict to be halted along the current lines of contact. Now, of course, that's something that Russia has dismissed. It's something that President Trump and the EU leaders are calling for. But again, that's one of the points of contention in leading up to a ceasefire. Now, should Russia agree to a ceasefire, the plan also calls for the return of Ukrainian children that have been deported from the country, as well as funds to rebuild Ukraine in the post-war reconstruction phase. Furthermore, it does address security guarantees for Ukraine. That will be crucial in any resolution to the conflict going forward, and something that Zelensky wants to keep on the agenda in front of Trump and on the minds of his allies. Again, one thing I would caution is that this envisions all of this after Russia agrees to a ceasefire. And as we know, with the summit now in doubt, it doesn't look like Russia is moving any closer to agreeing to a ceasefire, so it's unclear when all this will actually come to fruition.
OK, Bloomberg's Greg Sullivan, we thank you so much for the latest on that. And we can get to some other top geopolitical stories as well. Of course, Trump wanting the ceasefire between Russia and Ukraine because we have the ceasefire between Israel and Hamas. And the US Vice President says that he's still optimistic about the future of that ceasefire between Israel and Hamas, despite the flare-up in violence over the weekend. J.D. Vance says that the Gaza deal will require constant monitoring and supervision, but he will not set a deadline for Hamas to disarm.
I'm not going to do what the President of the United States has thus far refused to do, which is put an explicit deadline on it, because a lot of this stuff is difficult. a lot of this stuff is unpredictable. I feel very optimistic about where we are. Knock on wood, you never know how this stuff is going to go. But given what I've seen, given the incredible talent and effort that's going in to the reconstruction of Gaza, to the long-term security of the Gazans in that territory, I feel very good about where we are.
We also have the news that the US is planning to buy 1 million barrels for its strategic petroleum reserve, taking advantage of low oil prices. The Energy Department plans to buy crude for delivery in December and January, using a portion of the $171 million from President Donald Trump's signature tax and spending law. So those are some of our top stories worldwide. But coming back to the UK and its ambition to become a global leader in life sciences. It's being put to the test in Cambridge, where rapid development at its biomedical campus is really being hit by struggling local infrastructure. Despite major investments from companies like Prologis and the presence of pharma giant AstraZeneca, basic utilities like wastewater treatment are having problems keeping pace. And Bloomberg's Ashley Furlong has that story for us. So, Ashley, I haven't mentioned what we're really talking about here because it's a little unsavoury at this hour of the morning. It's sewers. Just talk us through what's actually happening here in Cambridge.
So the issue in Cambridge is that Anglian Water, the body responsible, or the private company responsible for managing wastewater in Cambridge, says they don't have extra capacity. But they're obliged to take things like from your household tap, from your household toilet. They can't say no to that. What they can say no to is trade effluent. Now, that's if you're a biotech company, a large pharma company, and you have a laboratory and you have chemicals that are going down the pipes, they can say they're not going to take that. And at the moment, developers are telling us that they can't get guarantees from Anglian Water that they'll take the trade effluent from the biotech companies that are hoping to move to Cambridge or hoping to open new laboratories there. So it's really a blocker, and what we've seen is a blocker in the pipes. And what we've seen is Prologis, for example, in Cambridge have put massive tanks beneath their new building that they're developing there because they're just saying we need an alternative solution. We can't really rely on the wastewater company.
And it seems pretty symbolic of some of the other bigger infrastructure problems that this government is having, whether that's planning or finances. Is that a good characterisation?
I think very much so. It's also, sort of the wastewater problem is a problem across the UK. You'll know when there's heavy rains, the rivers might be flooded. In summer you might be worried about going to swim in the sea and worried that there's sewage in the ocean. So this is a problem across the UK. These private companies are responsible for maintenance of the facilities, for increasing capacity in the facilities, and we'll know the UK government has these massive plans for house building, and that's going to be putting extra pressure on these private companies who are saying, they just, they don't want to upgrade their facilities anymore.
So it's symbolic of a broader political story, but also we know that the Chancellor is really pushing for economic growth. To what extent are these sewer issues actually holding back investment in life sciences?
Well, there's concerns that what might happen is that companies might say, well, if we can't get these licenses in Cambridge, well, we might just go elsewhere. And we're already seeing, not necessarily, companies citing sewage problems, but we're seeing AstraZeneca saying that they're not going to expand their facility in Cambridge. We're seeing US company Merck saying that they're not going to continue with plans for a new research hub in London. So we're already seeing companies already saying, we're going to go to the US instead. And so the UK really needs to be providing an attractive alternative, which they're not at the moment.
OK, really helpful. Ashley, thank you so much for bringing us that story. And, of course, you can read it on the terminal today. Fantastic feature, even if it is a little unsavoury, Ashley Furlong, with our feature this morning. I just want to mark, as we inch towards the open here in Europe, it looks like L'Oreal is going to have a significant drop this morning. It's about 6% down on Tradegate at the moment. And this, of course, is after its disappointing sales numbers that we were discussing with Angelina Raskoway earlier in the programme. You've seen US weakness, even if there was a bit of strength in China, and so overall disappointment across the sales picture. So do keep an eye on L'Oreal shares at the open. We've already seen the weakness in New York in the numbers overnight. But coming up on the programme, is it the coming of age for European tech? We'll get to discussing that next with Tommy Stadlin, co-founder and general partner at global venture capital firm Giant Ventures. That conversation next. This is Bloomberg.
think there's an opportunity that the UK becomes sort of and this might not be a very good metaphor here, but sort of the Delaware of content, where in the United States, Delaware created the laws that where everyone registered their company because the laws were so clear. If the UK stands up and says, we want the fairest marketplace for content providers and for new startup AI companies, I think that's the best way to encourage. Don't give the game to the people who won yesterday. Let people compete on the merits. And the best way to do that is to say you can't leverage the technical advantages that you had yesterday in order to bootstrap a monopoly in the future.
So that was the Cloudflare CEO Matthew Prince at yesterday's Bloomberg Tech Summit here in London. And there are some investors who believe that now is the coming of age for European tech, among them Tommy Stadlen, co-founder and general partner at Giant Ventures. I'm pleased to welcome you, Tommy, to the programme. I wonder just broadly why you're so bullish on European tech.
Well, thanks for having me. I've always argued that we have all the intrinsic ingredients to be a technology superpower. Here in the UK and in Europe broadly, we have, within about an hour of our headquarters at Giant in London, 3 of the world's top 10 universities, Oxford, Cambridge and Imperial, and they are churning out incredible AI talent that is every bit as good as their US counterparts. And what we're consistently seeing now is those talented engineers, those founders are going on to start companies that are finally having their moment in the sun.
Yeah, but when it comes to turning that talent into real money, if you look at the amount that's being invested, if I look at the numbers from ASML and SAP recently, billions of euros, right, to grow homegrown AI startups, it's chump change, isn't it, compared to the amount being invested in the US?
It is a tiny fraction of what's being invested in the US. So I think it's really important we understand where we can win and where we can't in Europe. So you just had the Cloudflare CEO on there. We're not going to win in AI infrastructure. We're not going to win in the data center race. There are hundreds of billions of dollars, trillions of dollars being invested into those infrastructure companies. We can't match that whatsoever in the UK. But what's fascinating now is we are in an era where a 2 or 10 person startup can create a business within a few years with hundreds of millions of revenue. We're seeing that consistently with companies like Lovable and others. So you don't need armies of people and you don't need armies of capital. And in fact, now one of the things we look at Giant when we're assessing startups is how lean can this team build? Do they need to build a team of 20, 30 people to really generate a great product and great revenue? Or can they use AI to scale much faster? You don't need huge amounts of capital for that.
OK, so we don't need to try and cover the entire supply chain. Which parts of it do you want to invest in then? Where is success going to come from in Europe?
Well, we're really excited about the intersection of AI and the physical world. So we backed, for example, a company called Cusp AI. Jeffrey Hinton, the godfather of AI at Google, his new company that he's very involved with. And they're using AI to create a search engine for novel materials that can help real-world problems. So smarter batteries, making carbon capture finally economically viable, working on chips and making them more energy efficient. So that's one example of using AI to try to make the physical world smarter and better. And what's nice about that is it plays to Europe's strength. We have these industrial powerhouses who are sleeping, who are struggling, but they can partner with startups to try and drive a wave of economic growth that we so badly need in Europe.
True. And when you've got everyone pouring money into this, whether it's Canada or South Korea or in the Middle East, is it that specialisation that's really going to make Europe and the UK in particular stand out here?
I think we do need to focus on our strengths, right? And so if you look at the UK in particular, you were talking about life sciences earlier. Despite Cambridge's issue with sewers, that's a world-class institution with world-class incumbent pharma companies. So we've got the pharma companies, we've got the finance companies here in the UK, so fintech's been a massive strength. If you look at Revolut, one of the generational companies coming out of the UK at over $70 billion now.
Yeah, but so still a question of whether it'll list in London.
Big question, and to be honest, that is the one missing piece of the jigsaw. We've got all the talent, we've got all the venture capital in the world. We're the third biggest centre now, London is, for venture capital globally. But the big problem in Europe is exits. And we never advise our companies to go public in the UK. It's just not a good idea.
Wow, OK. Well, I did want to ask you what you want to see from the Chancellor at the budget to try and turn that around.
Well, I think the UK, like other European economies as a whole, if you step back, we do seem to be stuck in a kind of high-tax, low-growth doom loop. And we're hearing rumours coming out this week of yet more taxes aimed at the income generators, if you will. And we've got to be really careful with that. We're consistently hearing in my small world of venture capital and technology of both founders. We hear about the Revolut CEO moving to the UAE, potentially to not have a huge tax bill here in the UK. Venture capitalists as well. We don't want to chase away those folks who are generating this innovation economy. So we've got to be really careful on tax, which is a basic thing. But I would like to see us be much more ambitious than that. How do we go and make the UK the most AI-friendly regulatory place in the world? Things like driverless cars. In San Francisco, 25% of ride shares now are on Waymo, driverless cars. Almost none in the UK.
But from the investor perspective, but what about all the fears about AI being a bubble? We had the Bank of England Governor Andrew Bailey warning that stretched valuations are going to lead to a sharp correction. Where is the froth, if we're being honest, in your view?
I'll say two things about AI fears. On the bubble, there is no doubt that it is a bubble. We are in a complete excess world of valuations, hype, all of those things. And the same thing that happened with the internet. There will be a lot of capital blown up making bad investments, but there will be generational companies that come out of this and completely change the world. So I think the same thing will happen here. And in a way, bubbles can be good things because it can attract huge amounts of capital and get the infrastructure built. So we've got to be careful. You don't want to be left holding the baby with the bad ones, but there'll be generational companies built. The other thing I would say about AI fears, it was really interesting listening to the Cloudflare CEO on your package earlier, talking about the incumbent media industry and their fears of AI disrupting their business model. I spoke to someone right at the top of the UK government, and they said, we'd love to be the most friendly place for AI, but the newspapers won't let us do it because they are so anti-AI because they're afraid of what it will do to their business models.
The newspapers, not Bloomberg, Tommy.
Not Bloomberg, absolutely. But we can't allow incumbent media organisations to fearmonger on AI too much. We have to grasp it. It is our silver bullet in the UK to escape this kind of low-growth, high-tax doom loop.
Of course, balancing the risk and the opportunity, all important for the regulators and for governments around the world. Tommy, great to see you. Tommy Stadlin, Giant Ventures co-founder and general partner. Really good to have you on the programme. We've got plenty more coming up. Stay with us. This is Bloomberg.
Equity financing currently rank lowest among the funding sources that firms expect to use for green investment. Deepening and integrating EU capital markets is critical to support the large-scale investments that we need.
So that was the ECB President Christine Lagarde, and we'll be hearing from her again later in the day. But just time to bring you a few term charts to set you up for your trading day. And we've got to talk about gold because we've seen this ferocious rally over the past few weeks. You can see it here in the yellow line. It, of course, went past this $4,000 an ounce level. But if you look at this lower line, where this is the RSI, the Relative Strength Index, and you can see that since September here, we've been past the 70 level, which signifies overbought territory. So just dropping below that here, we saw the drop yesterday, phenomenal drop actually for gold and silver. Is this the end of the rally or is it just a bit of profit taking? We'll see in today's session. Pretty steady actually at the moment when it comes to gold. But flip the board over again because at 7 a.m. London time we're expecting the latest UK inflation numbers. 3.8% was the last figure. It's expected to tick up to 4%, so twice the Bank of England's target. You can see here what we're expecting for September, and yet still more cuts priced for the Bank of England next year. Can this number at 7 a.m. change those bets? Flip the board one more time, and when it comes to equities, we've talked about momentum, gold losing a bit of momentum, momentum down yesterday when it comes to equities. Momentum, in fact, the worst factor in yesterday's session, despite a pretty flat day. Why is this important? Because momentum has been the factor behind the S&P rally so far, and if investors are getting burnt when it comes to their niche bets, what is it going to come to when they look at their core momentum bets as well? Again, another story, another question for today's session, but we've got some key interviews for you as well today. The Barclays CEO, CS Venkatakrishnan, will be on the opening trade at 7:15 a.m. This is Bloomberg.
Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. UniCredit third quarter profit beats as investments pay dividends, but acquisitions remain elusive. We bring you details as European bank earnings season kicks off. As Chancellor Rachel Reeves watches Britain's cost of living closely ahead of her upcoming budget, we'll break the latest UK inflation print shortly. Plus, gold and silver stabilise after suffering their steepest sell-offs in years during Tuesday's session.
Certainly all something we're going to digest. But let's talk about how it shows up in the cross-asset picture. I'll start with the bottom up because you're starting to see after that hit, Anna was just talking about a little bit of a rebound in the metals sector. Does it erase the losses from yesterday? Not quite. To me, I think what's more interesting is the risk-off sentiment you're seeing in the futures picture. Your Stocks 50 futures down 0.5%. You're seeing a little bit of a bid into the bond market as well. U.S. 10-year, 396. The countdown to the opening trade starts right now.
Wednesday morning, good morning. Gold's taking a breather. That means we can probably talk about inflation. Inflation's going to be a big theme over the next couple of days. Obviously, the big print coming out of the States Friday is going to be a big focus of attention. Today, though, we get UK data. And I think at the margin, slightly better news?
Yes, absolutely. Yes, if you are, like most people, wanting to bring inflation down, then yes, 3.8% is the number we have for the headline inflation print against an estimate of 4%. So that's lower than expected. It doesn't start with a 4, which psychologically perhaps makes a difference. The core number also 0.2 of a percentage point lower than anticipated. The services number, crucial for the UK economy, also moving, at least not in the wrong direction, staying at 4.7%, so not on the rise. And we see a drop in the pound as a result of this. Not a huge one, but it's been quite stable. It's now down by around 0.1%. And, maybe this makes it, there's fewer barriers to cutting interest rates, perhaps, for the Bank of England. Might be one conclusion from slightly weaker data coming through on the inflation front.
There's an expected pickup maybe still coming through, though, maybe over the next couple of months. It's interesting. Anna Andrade over at Bloomberg Economics has got April as the first cut. She expects that probably to come at the beginning of next year at some point. April feels like the most logical point in time for that to happen. Does this bring that forward? I don't know. This is basically fairly static. I need to go into the details and see exactly what's been happening on the services side. We think that probably airfares was a contributing factor there. So we'll just look into that and see what's going on.
And this is, of course, ahead of the key fiscal data that we're going to get next month. We're about a month away, I think, from the UK budget as well. Does the dial shift materially ahead of that commentary? And that's just the economic front. We got plenty of earnings to work through as well when it comes to that story.
Shall we go to that? Because we've still got a month to talk about the UK budget.
We do.
So let's not do it all, have all that fun in one day, Chrissy. And of course, the budget will be relevant perhaps to Barclays. So let's go to that story.
Let's go to Barclays. I mean, two massive redheads crossing the Bloomberg terminal here. They're launching a $500 million share buyback. This is crucial as well. They're talking about third quarter investment bank revenue that's coming in slightly higher than expected, a £3.08 billion number there. The estimate was about 3.05. So not a massive gain, but certainly one that is showing up pretty well. Some good numbers across the board here. I'm just looking at ROTE for 2026 here that is looking at about 12%. Across the board, there's some pretty strong numbers from Barclays. It looks like they are starting to see perhaps a little bit of provisions that they have an increase of when it comes to the motor finance story, but the rest is pretty strong.
Yes, and the number they're attached to that is smaller than for some of the others in that field. So £235 million in motor finance redress. That follows the high-profile court case, of course, on that front. Interesting, and they are guiding higher for 2025 in terms of their net interest income. So that a bit of a positive coming through then on the Barclays side of things.
I'm just trying to look through the trading numbers, just to make sure that I've got this correct, because it looks like they're both a little light. Equities revenue 689 versus an estimate of 766. I just want to make sure I'm looking at all the right things here. FIC revenue 1.26 versus an estimate of 1.22. So it looks like FIC's ahead. Equities probably aren't. My understanding going into this was that the estimates were seen on trading as being actually low. So if we haven't matched, I need to just double check this, but if we haven't matched these, then that may be perceived as not necessarily a good thing.
That third quarter equities revenue number is below the estimates. So, certainly a point of conversation with CS Venkatakrishnan when we speak to him.
Absolutely. It's not the only other bank earnings that come out this morning. In the last hour, we had UniCredit that hit the wire as well. Strong numbers across there as well. And remember, they've just come off of a series of banking bids that were unsuccessful. So they have a lot of cash to do something with. Looks like they're reporting third quarter profit and revenue, beating estimates across the board. Net income rising to about 2.6 billion euros. Andrea Orchel, the CEO, saying they're on track to deliver their best year ever and confirming their guidance. So I think it's fair to say that we might just expect some pretty decent gains in the banking sector when in the opening trade.
There's consolation for the fact that, I mean, they're getting dividends from all these investments that they are making. And so in that sense, those investments, as they are at the moment, they're not deals. Those investments are paying off. But he has been thwarted on the deals that he's been trying to do. But maybe this is some kind of compensation.
So if you talk to your shareholders and go, look, we can hold these things, they're okay, they generate a return that is kind of a fairly decent return, that's a good use of capital, is it? And I think that's the question that I think investors will ask going forward from these. Are these going to transform into deals, or if they're not, what are you going to do with them? Or do we just see them as investments? And what does that mean?
Yeah. Should we talk about markets more broadly?
Yeah.
Shiny things.
Yeah. So I think shiny things are a useful kind of sidebar to what is happening, I think, in the wider market story. We've talked already a lot this year about what's happening with momentum. You can track this stuff on your Bloomberg. It's fairly easy to do with the factors to watch functions. Momentum has been by far and away the biggest trade.
Yeah.
And yesterday we saw potentially a crack in that narrative emerging in terms of gold. We can talk about the debasement trade. People have a view of the debasement trade. Is that what has been driving it? Possibly. But there's also been an awful lot of momentum in the gold trade. And if that starts to come out, does it come out in other assets? And I think that's what a lot of people are going to be watching out for. Momentum has been super strong. It had a very bad day yesterday. If this, as a key driver of markets broadly, starts to falter, then potentially other asset classes and the correlations. And you look at the correlations at the moment, everybody's in the same trade. So if one goes, do we start to see maybe effects being felt in other ones as well?
Yeah, absolutely. I mean, and looking specifically at the shiny stuff, because that did dominate a lot of the headlines yesterday with these, most in years drops that we saw 6-8% at one point for gold and silver prices. I mean, it's just impossible to say right now whether this was just a pullback based on positioning and whether we're back to the races again. Because right now, gold and silver actually have stabilised, haven't they? And they're on the rise just a little.
They are. And I think it's fascinating. We had Peter Kinsella yesterday join the program. We were asking him, and he was very bullish on gold. He said, we're using gold to hedge a lot of our macro positions, especially when it comes to a frothy equity market. But he said that it was an equity downturn that could be what triggers a massive sell-off. Now, a couple hours later, of course, we had a 6% decline in the gold picture. You brought up the correlations. I'm just running it on my terminal here. On a 3-month rolling correlation between the S&P 500 and gold, it's actually negative, down 0.3%. It's not a significant enough correlation to draw a conclusion from, but just the fact that it's negative, to me, is interesting.
Everything's been rising recently.
Yeah.
Everybody's in the same trades. Everybody's been pushing these things pretty hard. Are there relationships between them? Maybe on the kind of basis of what you're seeing in terms of the correlation trackers, maybe not, but it feels like there is. Kind of just naturally, it feels like there are relationships between these trades. And it feels like liquidity is a big factor behind all of them.
Yeah, and we're asking questions on a number of fronts, whether we're seeing bubbles in equity around AI, whether we're seeing bubbles in gold, whether we're seeing a bubble in private markets. And the links between all of those three are interesting to watch. And Peter was flagging one of them, which is what we've seen in the past, isn't it? When you see, margin calls on stocks, people sell what they can, not what they want to sell, and they sell gold, and we see it drop. But that wasn't yesterday's story, but the links between them is something we'll certainly
But people
watch.
are pointing out, and I think it was Goldman Sachs yesterday, talking about the weird relationships between the various asset classes and the fact that we're in a weird market. This is a sort of a new market with different correlations and different kind of relationships between asset classes. And that, I think, is the interesting bit going forward from here is when things start to kind of wobble in one, what are we going to understand and see maybe in others about what is driving them? What is the real rationale behind some of these trades? And I think gold, we're guilty of this. Journalists like to tag narratives onto things, and I think the market does as well. And we've got this whole debasement trade. But is it a debasement trade, or is it just a liquidity trade? And I think we're going to find out.
Yeah. And we're going to have a lot of interesting earnings conversations to help us do some of that.
Yeah. We should probably just mention as well the Bank of England. The Bank of England's warnings over the last few days have been really amazing. Yesterday, Bailey was sensational in terms of what he had to say. And the warning we got a few days back on the AI trade was amazing too. We've got lots coming up on the show. 2 earnings interviews coming up. CS Venkatakrishnan from Barclays is going to be joining us. Gregory Guillaume, Axo Nobel's CEO, is going to be joining us as well. We'll also be speaking with Maria Weidmana, State Street Equity Research Head, very, very long equity tech, but also kind of a barbell on that. Adam Dent, Santander CIB UK Chief Rate Strategist. We've got inflation data, and Ollie Hansen, Saxo Bank's Commodity Strategy Head, is going to be joining us very shortly to talk gold as well.
Lots of data, auctions, earnings coming up ahead as well. Plus, of course, some speak from the ECB. Christine Lagarde due to make some comments in Frankfurt about 1:25 p.m. UK time. Very specific there. The earnings front, though, as Anna was mentioning, is probably what's going to be driving the story this week. We do have carrying earnings after the bell. This is really crucial here. Remember, luxury very much in focus. They're talking about a big makeup deal with L'Oreal as well, something that LVMH is starting to. We're getting reports that LVMH might be looking at as well. It's interesting to see where carrying has to say on that front. Plus, of course, in the States, 6 p.m. UK time, $13 billion auction. Is there demand for the long end of the curve? We will find out today. And then, of course, the earnings story continues over in the States. IBM, Tesla, and SAP, that's relevant to our region.
Yeah, absolutely. And when we're thinking about tech, we can look back to Netflix earnings. We can look ahead to the numbers that are coming out that were just on that day book there around IBM and Tesla. We can also think about OpenAI news. We'll be talking about that later on in the program. But Texas Instruments stood out to me as well as one to keep an eye on. They had numbers out last night and a bit of a sluggish outlook, and the stock dropped 8% on that. And I wonder whether we keep an eye on some of those European chip names as a result.
OK, we'll do all of that as we work our way through the morning. What else do you need to know this Wednesday morning? OpenAI, as we've just been mentioning, launching a browser that it hopes will challenge the likes of Google and Microsoft. The browser, called Atlas, will include a ChatGPT interface and features a mode that will allow AI to take control of the mouse and the keyboard. You ready for that? It will complete tasks on the computer. Alphabet shares down on this, certainly down when OpenAI teased the launch. Heineken has narrowed its profit outlook on lower consumer demand. The third quarter beer volume fell by 4.3%, more than expected on weaker growth in Europe and the Americas. And L'Oreal's ADRs fell after disappointing sales growth in the last quarter as weakness in the United States outweighed signs of improvements in China. A pickup in demand for high-end beauty products in mainland China helped lift sales by 4.2%, but analysts had been expecting a gain of almost 5%.
Whilst we're talking about all things beauty and luxury, perhaps let's talk about Hermès. Third quarter sales at constant FX up by 9.6%. So come in a shade above the estimate of 9.3%. We are ever alert to what they have to say about what's going on in China. And actually, the Asia-Pacific number for revenue just a touch above the estimate. But, you know, maybe that's enough, 6.2% higher against an estimate of around 6%. And they've appointed somebody new for menswear. So there's lots going on at Hermès and lots going on within the luxury space. And we'll get to some of those themes later.
It's fascinating because when we talk about luxury, we tend to talk about, to your point, the China effect as well. But there is a massive French political situation hanging over these companies as well when it comes to the tax hit, when it comes to the currency hit as well. So I'm curious if that's something that starts to show up more and more.
Yes, and mostly these businesses are much bigger than the French economy, aren't they? Yeah. Or much detached from the French economy. But when it comes to tax, that quickly unites the two. Let's tell you what's coming up on the programme. A lot of talk about tech then, including a look ahead to some of those earnings from SAP, Tesla and IBM. Plus, has gold lost its shine? We'll certainly discuss that. Up next, though, we'll catch up with the Barclays CEO after the bank's latest earnings print. If you want to get involved in any of these conversations, IB plus BBTV Go. That is the function to use this beautiful morning here in London. This is Bloomberg. Welcome back. This is the opening trade. Some of the earnings stories might weigh on the non-UK market, but the FTSE 100 looks like it could stand out to the upside this morning. Futures elsewhere in Europe pointing a little lower, but here in London pointing a little higher than Guy.
OK, let's talk about Barclays. Out with numbers this morning. Group pre-tax profit, $2.08 billion. That slightly beats estimates this morning. The bank is setting aside $325 million in terms of compensating customers impacted by the UK motor finance scandal. It looks like there's going to be some pushback there. The bank is going to launch a $500 million stock repurchase scheme. So let's talk about the details and exactly what has happened here. CS Venkatakrishnan, CEO of Barclays, joins us now. Venkat, great to see you. Thanks for the time. We always appreciate it. In terms of what stands out here, what are we looking at? I'm looking at trading being fairly mixed. I'm looking at a pushback when it comes to the motor finance story, and I'm looking at a raising of the net interest story going forward. Which one of those three things do you think investors should be focusing on this morning?
Well, I think they should be focusing on the broad performance of Barclays. We had a top-line beat of 11% growth year over year to $7.2 billion on the top line. We've had 9 consecutive quarters of tangible net asset value growth. Importantly, as you said, we've increased our guidance for NII from 12.5 to greater than 12.6 billion pounds, increased our ROTE estimates for 2025 to greater than 11%. We are accelerating our share buyback program by announcing 500 million pounds this quarter and moving to a quarterly cadence. And then importantly, we continue, we've announced that we're going to come back to our shareholders 1 year ahead of schedule and then give them and talk about our new set of financial targets in February from 26 through 28. So I think it represents the broad good performance we've had for many, many quarters now.
Yep. OK, let's dig into the details of what is happening here and talk about what's happening with trading. FIC looks pretty solid and certainly ahead of estimates, but I'm understanding, I think, reading my notes, that the estimates were maybe a little low for what people realistically thought you guys could deliver. So FIC outperformance, but equities not. What happened in equities, Venkat?
Yeah. So I'm very broadly happy with what the investment bank has been doing over 7 quarters. And, we've had 6 quarters in a row of top-line growth, of earnings leverage by having what we call positive jaws and improving profitability. The investment bank produced greater than 10% ROTE, as did all our divisions. Now, within that, I've always said we're running our own race, and we're running our own race and producing the numbers we wanted to. Quarter by quarter, some things will do better and some things worse. We are obviously pleased with our FIC performance, and we'd like to understand better how we can improve in equities. But I view this over many quarters, and so, we take the long-run view. Okay. But, we will look to do better in every segment every quarter.
What do you think the answer is in equities? If that's the question you're asking, what do you think the answer could be?
I think we need to continue to deepen our client franchise. We've been working on it and improve the breadth of our products. We've been at it. We're going to continue, and we will see the results as we've seen in every other part of this bank.
Venkat, it's Kriti in London. Thank you for your time this morning. Let's pivot from the equity picture to the credit picture, if we can. There's been lots of warnings coming from the big U.S. banks around cracks in private credit that could ultimately have broader effects. You have been in multiple seats at Barclays, certainly as the chief risk officer. What are you seeing? Are those worries warranted?
Look, credit is something that you do over the cycle. I think you have to be extremely careful at all points in the cycle about, who your client is, your client selection, the terms under which you lend, your concentrations, how much you lend, industry sectors. We take this very seriously. We take this over the cycle. I mean, we had an exposure to Tricolor. I'm obviously not happy about it. We're looking at what lessons we learned, and, we have looked at it and applied it across our portfolio. But I think credit is one of those things that you take seriously. It doesn't matter whether it's so-called private or credit and who the lender is. It is a full-time specialized job, day in and day out.
But Venkat, is it a systematic risk or is it still isolated? How should we be thinking about investments in private credit when firms like the one you just mentioned go bankrupt?
So in that particular case, there seems to have been fraud. Now, I should say that Barclays had no exposure to First Brands, although we were approached multiple times by them. The thing about fraud is you wonder whether it is one bad actor or it is some effect of circumstances that are stretching the company's finances and making them take risks that they otherwise should or would not do. That's the kind of thing we look for, and that's what I think investors should be looking for over the next, months and quarters.
Venkat, good morning. It's Anna. Sticking with this theme and channeling in some of the thoughts that we got from Andrew Bailey at the Bank of England just yesterday, he and his team say that they're worried that the market is slicing and dicing loan structures like it's pre-GFC, pre-financial crisis. Do you see similarities?
Look, I think securitization technology has been with us for decades. Obviously, the governor and the central bank have a view of, where and how much. And they're talking about a broader review, which is, I think, a good and prudent thing for any central bank to do.
And they talk about alarm bells ringing. It doesn't sound like you're hearing alarm bells, Venkat.
Look, as I said, we pay attention to credit with what we hope is the same amount of dedication all through the cycle. And when you do that, you try to be very disciplined about it.
OK, but How easy is it to be disciplined at the moment, CS? You talk about the fact that Barclays is delivering on that, but this is an industry-wide issue, and we've learnt in the past that there can be problems in strange parts of markets that are hard to determine, and that they can have significant ripple effects into more mainstream banking. Are you being extra diligent right now? We've had years in which liquidity has been easy. We've had years in which underwriting standards have come down. Are you paying more attention? Are you looking at what you're doing more carefully now as we come to the end of this process? How much due diligence are you doing?
So we do a lot of due diligence at all points in the cycle. And I think I would separate two things. Every time you make a lending decision and you monitor those loans, whether it's in a good time in a cycle or a bad time in a cycle, assuming you knew it, you would always apply similar standards. So I think the important thing is to maintain standards through a cycle. And then if there are periods when you're worried more, then you may increase the frequency of your diligence and start looking at signs that you might otherwise have thought were normal. And so, as I said, what you're looking for at this point is our business model stretched, and what are the quality of financial controls in companies and the independence of financial controls. These are the things you worry about all the time and you pay extra attention to in periods of heightened concern, let's say.
Venkat, I feel like every time we have you on the program, we always have to ask you about the IPO market in London. I'll do it again this time, but perhaps with a little bit of a twist. Connecting it to the private credit space, we're seeing deal making, we're seeing M&A activity start to pick up in the States. We're not seeing that same enthusiasm on this side of the pond, but we are seeing more mobilization when it comes to private credit because it feels like the IPO route isn't one that's available to everyone. Does that make Europe more vulnerable to a risk in the private space than the public one?
Well, I think the amount of private credit is, of course, much greater in the United States because it's a more advanced industry and developed there. But I want to sort of not talk about private versus public. Credit is credit is credit. I think as far as the IPO market goes, we on this desk behind us took part in an IPO yesterday of a UK bank, Shawbrook. I think you're seeing some signs. It's obviously not as strong as it is in the US. And I do think in Europe, as in the UK, and in fact the governor mentioned this yesterday in the House of Lords, there has to be a continued growth in the equity risk culture of the country. And hopefully with that, you'll see more IPOs.
Venkat, thank you very much. Thank you for joining us. The Barclays CEO, CS Venkatakrishnan, with us to talk about the numbers and the credit market. Really interested to get his take on things we've heard from the US banking sector and indeed from the Bank of England governor, his concerns around AI, of course, and certainly yesterday talking about credit markets. Coming up, we'll stick with the earnings stories. While AkzoNobel meets most of the third quarter estimates, paints and coatings are down on the year. We will talk about the details of doing business right now, doing global business, as they do at AkzoNobel in the tariff environment. That conversation is next. This is Bloomberg.
Wednesday the 22nd, 30 minutes to the start of the opening trade here in Europe. Got a lot of corporates on deck this morning we need to focus on. European equities, certainly the futures picture negative this morning, but it's interesting, S&P futures are a little up, not by much, but holding their ground right now. Gold futures are a tick higher, but it's not as if we're buying the dip in sort of big fashion this morning. The market's kind of drifting sideways. We're just north of 4,000. Do we get more buying coming in a little bit later on to carry on the momentum we've seen? We're going to wait and watch. What does the bond market look like?
Yeah, well, just the fact that we're talking about a 1% move in gold and that is drifting sideways tells you everything about this market. In the bond market, we're looking at a 10-year over in the States at 395. Not much action on this side of the pond. I think I'll leave it at that, and I think that kind of sums it up.
There we go. Moving on. Let's get back to the earnings stories, because then we do have some news. AkzoNobel's third quarter adjusted EBITDA and the revenue numbers seem to come in line with estimates, and the company has left its full-year guidance unchanged. But there's a net loss to talk about in the third quarter and a provision related to a court case. So let's bring in the AkzoNobel CEO, Grégoire Poux-Guillaume, who's with us this morning. Grégoire, very nice to speak to you this morning. Thank you so much for joining us. So just tell us a bit. What can you tell us about the underlying business? Because I look here at this third quarter net loss, 194 million. I add back in the provision that of course is for a court case, and that still doesn't get me quite to where the estimates for the net profit level were. So what can you tell us about the underlying performance of the business?
Yeah, for Q3 we are at consensus in terms of EBITDA. We delivered 385, which was the consensus. The provision for the court case is non-op, non-cash. It's for a project from 10 years ago on which we're adjusting our risk coverage. But what's important is the underlying business, and our markets are soft. There's not a whole lot of growth currently in paints and coatings. There are pockets like marine protective, where the big backlogs are aerospace. But if you look at the global market, the local businesses are doing quite well, essentially our decorative paints businesses. And the global businesses, the B2B businesses, are mostly suffering. And then there's a geographical imbalance where we are performing well in China, but we're suffering on a depressed market in the US.
Okay, so suffering in the US, well in China, it's the global part that suffers and the local part does okay. So some really interesting dynamics that tie into the big global themes. No doubt we'll get to some of those in just a moment, Greg. Can I just ask about the court case, though? This 300 million euro provision, there were provisions and there were provisions. How much certainty do you have around that kind of number? Could it be a lot higher, a lot lower? What's the context?
It's an ongoing court case. It's from a project from 2013, 2015. The proceedings started in 2021. The court proceedings are still ongoing. So it is really just our reevaluating our risk coverage and making sure that we're up to date on our disclosures. There's not a whole lot more I can say because it's an ongoing court case.
Gregor, good morning. It's Guy. B2B. What are you hearing back from customers? What are they telling you? What does your supply chain look like? What are your customers telling you? Just in the United States, in Europe, and over in China. Can you just give me a bit of colour on that?
Well, the trade issues that we're seeing currently, the tariffs, don't really have a direct impact on us. We're mostly local for local. We've got 130 plants around the world, so we can work our way around that and make sure we're not exposed to tariffs. But our customers are struggling, and they're struggling because they're trying to figure out where they should be producing and where they should be investing, and that is having an impact on essentially holding back investments, particularly in complicated industries like the auto industry. And that's going to continue until there's clarity. But we're working our way through that, and we're doing it by making sure we are increasingly efficient.
OK, so there's no sort of direct tariff effect, but there's an uncertainty effect that comes from tariffs. Is that the right way of looking at it?
That's exactly the right way to look at it.
So what does that mean in terms of how you see the business progressing from here? Do you see that uncertainty persisting? Do you see a moment of clarity coming? Or is this something we're going to have to live with for the rest of the Trump administration?
Well, there's no signs that the question marks will be lifted anytime soon, but I guess customers are getting used to living with uncertainty, and as they do that, then I think some of the investments will be unlocked. We see that a little bit in the automotive industry, where there's areas that were on hold, like Mexico, that are picking up a little bit. But it is an uncertain world, and customers that are running local for local businesses do a lot better than the customers that have to contend with global flows. It's just a more complicated way of running businesses, and as much as it doesn't impact us directly, it does impact our customers, and therefore it weighs on our ability to grow.
Gregor, speaking of that kind of complicated way of navigating this geopolitical environment, let's talk a little bit about the currency picture, something you bring up in the earnings. On Wall Street, there's a big question right now of whether or not we see some sort of swing back in the dollar, or we see sustained weakness in the dollar relative to currencies around the world. How are you thinking about the FX picture? How are your team modeling maybe just the next 12 months when it comes to that currency strategy?
Well, given the AkzoNobel model, we don't have a transactional impact. We have a translation impact. What I mean is essentially we're naturally hedged because we have 130 factories around the world to generate 10 billion in revenue, which tells you that we have a strong local presence in most countries. That allows us to have a good match between our revenue and our costs. Where you see the impact for Exo is really the translation. We report in euros, and the euro's been strong versus our basket of currencies. And for us, from a translation impact, it has a 30 million euro impact per quarter, pretty much, which essentially forces us to update our view on currencies and on the basket on a regular basis, but it's not having an impact on the profitability. It's